Ladies and gentlemen, please silence all mobile devices. The program is about to begin. Ladies and gentlemen, please take your seats. The program is about to begin.
TechCrunch Disrupt.
Ladies and gentlemen, please welcome TechCrunch Chief Operating Officer Ned Desmond.
Good morning, everyone. At Disrupt, we have a very special program called the Custom Disruptor Award. We work with our partners on this award. And the lucky attendees at this show who participate can win some pretty interesting and lucrative prizes. And they also get recognition if they happen to win a Disruptor Award at the end of the show, just before we announce the winners of Startup Battlefield. This year, we have 2 companies that are participating in this program, and I just want to give you some quick details on what they're after and how you can participate. First is Profit.co, which is launching Execute, a startup pitch competition using OKRs and KPIs at Disrupt. Winners will receive cash awards of up to $15,000, and the first place winner will be recognized and awarded at the closing keynote at Disrupt, meeting on day 3, Friday. You can visit their booth in the expo hall to learn more details if you aren't already onto it, because I know they've been promoting this across the event. The second is Magna, and Magna's proud to present something they call Future Mobility Disruptor Award. Magna's going to grant $10,000 prize and the opportunity to meet with the Magna R&D innovation team to the winner of this program, which will also be announced and the prize awarded at the end of day 3, just before we announce the winner of the battlefield. If you'd like to learn more about Magnus Prize, you can find them up next to the hackathon in room 208 on the second floor of the South Hall of Moscone. Thank you very much.
Ladies and gentlemen, please welcome TechCrunch Editor-in-Chief, Matthew Panzarino.
Hello, everyone. It's wonderful to see so many people in your seats this morning. It's always nerve-wracking coming out to these things. We know it's a little early, so we always creep out just to see if there's anybody in the audience yet. And there is. It's great. There's so many here. It's awesome to see. You know, we've got a fantastic show over the next few days. We have 42 sessions just today alone, and of course we'll have sessions over the next couple of days. You'll see many people here on the main stage, but we also have the Extra Crunch stage and Q&A stages as well. And we fleshed all 3 out with what we think is a really great cross-section of content that covers all the important kind of sectors and questions and things that you might be looking for about what's happening right now in entrepreneurship and the startup universe. So we've done our best to kind of go high, go low, bring you ground level information that's actionable that you can take to your next meeting or your next business decision, kind of decide where your company needs to go from here. And then we also wanted to bring in some people who have had some success and had some kind of view into what it takes to build successful companies, and we'll talk to them as well. So we wanted to make sure to bring you this full spectrum analysis of the industry, and hopefully you like what we've provided for you. Today we're going to be talking about a variety of things, including space, and media, and AI. Joseph Gordon-Levitt will be here. Neil Mohan from YouTube will be here. Jennifer Tejada of PagerDuty. Ray Dalio, Will Smith and Ang Lee, Stephen Curry. And we have an amazing selection of speakers on the Extra Crunch stage as well, once again bringing you those actionable insights, which is one of our big aims for the show. So we're really glad that you're here. We also, in addition, have the Startup Battlefield. We've selected a group of companies that we think represent kind of a section of the hottest and most interesting spaces. We've brought them to the show after extensive training. We're going to put them on stage in front of some esteemed judges and panelists, and they will ask them questions live on stage. None of this is scripted. You're going to get to see them pitch their heart out. You're going to get to see the judges grill them, and you'll be able to kind of see how they react to that on the fly. And of course, we'll hold the competition over 2 days, and the finalists will be announced at the end of the second day, and they'll go on stage, and we'll pick a winner on the last day. So that's very exciting. I would like to personally thank the events team. Just right now, they've worked around the clock, many sleepless nights, not figurative, actual sleepless nights, getting this event ready for you. So please, let's give them a hand. It's a big undertaking. It's a big undertaking. Well, thank you very much for being here. I'm going to let us get on to the show. It's a fantastic set of programming, and I hope you enjoy it. Thank you.
Ladies and gentlemen, please welcome TechCrunch Managing Editor and Disrupt MC, Jordan Crook.
What's up, squad? How we doing? Yeah, thank you, TechCrunch staff. Appreciate that. As the voice of God said, I'm Jordan Crook. I'll be your host for the show. You may know me from previous Disrupts and literally nothing else. So I'm really excited to be here. I hope you guys are too. I know you're antsy to get started with the show, and Panzer pretty much just said everything I was going to say. So I'm just going to cover the nitty-gritty housekeeping. If you want to interact on social media, one of the best ways to do that is just go to @JordanRCrook and press the follow button. Love to see you there. No laughs? I'm going to get you eventually. Don't worry, I'm coming for you. We're going to get all kinds of laughs in here. No, for real, just go to #TCDisrupt and interact. We're going to be watching that and monitoring it. If you have any questions, concerns, compliments, go ahead and hit that up. We also have an amazing app this year, and as you can tell, there are like 40 things going on at any given moment, so the app is a really great way to navigate the show. Check that out. If you are an investor or a founder and you're looking to make a deal, get a check signed, something like that, use Match. It will match up investors and startups and let you guys kind of connect in special rooms that we've set aside. And then if you want to check out a transcript of the show, any of the panels that are going on, we're going to have one of our partners, Otter AI. They're providing transcripts of everything happening so you can get the play-by-play. Make sure to check that out. On the Extra Crunch stage right now, we have how to build a billion-dollar SaaS company. So if you want to check that out, it's probably time to go. Neeraj Agrawal from Battery Ventures, Jody Bonsall, the CEO at Harness, and Whitney Boak from HelloSign will be talking about that. But now, on the main stage, we're going to space, folks. So with that, I'd like a warm welcome for our very first guest of the day. Please welcome CEO of Blue Origin, Bob Smith, and your moderator, Daryl Etherington.
Ladies and gentlemen, please welcome TechCrunch senior writer and your...
This is a weird.
All right, we're gonna get this event started, right? I think we're going to watch some rockets launch, right, Bob? I think we brought a video. We got some of Blue Origin's successful launches to date, and we're gonna take a look right now. No.
New Shepard was named after Alan Shepard.
Mike is not live.
Oh, we're having a mic. We'll just watch the rockets. They're great.
Yeah, exactly. Now we go. So now you just saw 11 successful launches. And what you can see now, we're also having escape tests. Why? Because this is a human-rated reusable rocket. And what you're seeing is our ability to actually get away from the booster at any time and land safely every time. And what you see there is a little puff of dust that comes up every time. We land about 1 to 5 miles an hour, so it's like sitting down hard in a chair. And it seats 6 people. You get about 3 minutes of zero-G experience. We've done that now 11 separate times, and we're getting very, very close to flying humans for the first time. Because fundamentally what we're trying to do is change the overall cost curve and availability of spaceflight, because we know that everything else goes from there. We have countless business plans that are on the shelf that are just waiting for reusable launch vehicles to actually improve the cost, the overall safety and availability of getting to space. And once you get to space, everything can become possible.
Nice. So a couple things there.
Yeah.
When is that first person going to go up? I know that the target is 2019. We got
It's this year.
It is this year?
So it's targeted for this year. It's October 2nd.
It's getting close.
Yeah, yeah. So honestly, we're in the position of where we've actually tapped the brakes a little bit. One thing that may not be obvious to a lot of people here is that when you go in a safety-critical environment, getting functional readiness is different from verifying something.
Right.
And so verifying that you actually have something that's safe and ready to go is where we are. We're just going through all of our systems and making sure that we actually have all those systems right. And we have 2 flights that we're going to do before we actually go fly, at least 2 flights, before we go fly humans on that. If those flights go really well, then we may be able to actually get people up relatively soon. If not, we're just going to methodically go through that and make sure that we're only going to fly when we're safe.
So you're saying there's a chance for 2019 still? Or?
I think I'm never going to give up pressure on the team to actually try and go get it done this year. Is it likely? Probably not, because 2019 is rapidly coming to a close. But again, we're not going to be date-driven. We're going to be driven by when we're ready to go fly.
Great. And then the other part of that is, can I be on that one?
Yeah, absolutely. Well, you have to get in line. Okay. There's a lot of people that want to get on that first flight.
Like, what do they have? Money?
They do.
Money.
They do.
Okay.
They do.
All right. That's great. So let's talk also about kind of New Glenn too. So
yeah.
What has the progress been on New Glenn? Where are you at with that?
Yeah.
That's your orbital class
Right.
rocket.
Yeah. Just to back up a little bit to what you saw, since my mic wasn't on, the New Shepard vehicle is to do a couple different things. It's to get space tourism and suborbital payloads. But it's also there to actually demonstrate all the fundamental technologies that we need to actually go fly New Glenn, which is our orbital vehicle. So you have hydrogen, oxygen, engines and tanks. You have the ability to vertical takeoff and landing, all the guidance that you need to go do that, all the rigor that you need to actually go fly humans. We're taking all of that and that operational experience and applying it to our New Glenn vehicle. The New Glenn vehicle is a massive vehicle. It's well over 300 feet tall, Just the first stage is larger than most rockets on the market today. And we're going to land that first stage, much like you saw here, on a moving ship, which actually gives you a little bit more stability and allows you to actually get a little further cross range. But at the end of the day, what we're trying to do is the exact same thing, which is to actually change the cost curve in a very substantive way associated with reusable rockets. And 75% of a cost of an expendable rocket is actually that first stage.
Right.
So if you actually reuse that first stage, you actually have fundamentally changed what you're actually be able to provide. So we're in the design process now. We've got production hardware, flight hardware now down in our factories. We've built our factories down in Florida, as well as we're in the process of standing up our launch pad. We're going to have our critical design review, which locks in the design at the end of this year. So just 2 months. We have a series of reviews going on right now, and we're still targeting 2021 for that first flight.
That's the first test flight or first commercial flight, or both for that year?
It will be a commercial flight.
Okay, great. And what are we looking at for costs for that, like especially the initial ones? Because I imagine the cost curve will go down.
Yeah. So the cost curve is going to be based on the fact that we have a couple different things. One, that we have a reusable as opposed to an expendable first stage. And the second thing is that we have the ability to actually dual manifest. So one of the things that we have a 7-meter fairing, which is larger than anything else that's on the market, which means we can actually take 2 very large ComSats and put them stacked together.
There's a lot of space words here. I don't know if everybody is
I'm sorry.
space expert.
So you can actually get 2 geosynchronous communication satellites and put them on there, 2 very large satellites.
Gigantic, yes.
And therefore be able to actually effectively give the same price for
A 2-for-1 deal.
2-for-1 deal, exactly. As well as the fact that fundamentally our costs, our economics are different because we're using the first stage. So it's going to be incredibly cost competitive, much better than what's on the market today.
So why are some legacy players still aiming for kind of fully expendable vehicles?
Yeah.
And a lot of, I know that Mitsubishi Heavy Industries, for instance, their next rocket, they're targeting a $50 to $60 million launch cost, which is on parity with what Elon's doing at SpaceX, for instance, right? And yet a fully expendable vehicle. So what's the disconnect? Why is that going on simultaneous to Blue Origin saying we need full reusability to get the cost curve down?
I think we're in a period of transition where the business models are actually going to have a different risk posture. So what I mean by that is that you have, in one case, a reusable architecture. Reusable architecture, by definition, will be cheaper because effectively you're not throwing away this exquisite hardware every time. So eventually, it will get there.
Right.
The question is your timing right, and is your willingness to actually go invest in the infrastructure to get high-rate production? So the way that you'd actually get an expendable architecture actually to work well is you produce a lot of them, right?
Yes.
You invest in the fundamental the infrastructure to actually get that done and produce a lot of them. Get down the learning curve, have a very good run rate associated with it. So you produce a bunch of widgets, they're going to be cheaper. So people have to go figure out whether they can actually have enough market share to actually support that infrastructure on an expendable model, or do they need to flip over to a reusable? Obviously, we think the reusable path is the longer path, and that's the one that we're actually strategically focused on.
Right. So that brings up another interesting kind of area of the whole space business and the emerging space business, right?
Yeah.
Like that's a lot of upfront costs you've just described, right? And Blue Origin is lucky in that Jeff Bezos is obviously a passion project, and he's willing to fund it.
Right.
I think he's on record saying like, "Oh, this is the priority funding," right? So, what are we looking at for the next, like, say, 10 years in terms of access to building new businesses around space?
Yeah.
Is it going to have to subsist on this kind of like patronage model? Like, do we need the King and Queen of Spain to sponsor our journeys?
No, I don't think we need the Queen of Spain. But we are very fortunate to have Jeff as our founder. Right. No question. Having that level of private equity is a nice place to be. But I would say that what we have seen, and I think there's a less than clear recognition that the launch volume is going up and has been going up for quite a while.
Right.
If you actually go look over the past years for U.S.-based addressable market for U.S. providers, it's been going at about 3% a year. And so you're running roughly around 36 or so per year, and that will actually go up by 3% at least a year.
Mm-hmm.
Projections actually show it going up to 50 to 80 as much. So right now, the launch volume continues to grow, and so more launch providers are going to be able to actually come in and get those kind of rates that they need to support their overall infrastructure investment.
You're talking about on the demand side.
On the demand side. So the demand side continues to grow and is expansive. And that isn't even including some of the mega constellations that are actually being proposed. So you're seeing a number of constellations being proposed by large tech companies and others that are actually saying the world needs more basically connectivity. And because of that, they're going to need a lot of launches relatively soon.
Right.
And so the launch volume is really looking very attractive over the next 10 years, whether you're talking about whether that's privately funded, have government funding, but it is fundamentally shifting to a more commercial model. Even now, only about 20% of the overall volume for US-based addressable market is actually to national security providers. So it's already commercial. It's already commercially dominated. That's a big change. I mean, if you think about it, 10 years, even 20 years ago, it certainly was not that way. It was actually dominated by governments that were funding space programs.
Yeah. So you're saying then that from your perspective, from the rocket business perspective, it's a viable business relatively quickly, right?
Yeah, absolutely.
But what about kind of like other people wanting to build startups, or like how accessible is it for a new company starting out that doesn't have, isn't the brainchild of Jeff Bezos? For
Exactly.
instance, right?
Exactly. That's been the fundamental problem in space businesses to date. And I always like to make the analogy to Amazon. And what Amazon was able to go do is actually go build on infrastructure that already existed. And the infrastructure that existed was, they didn't have to invent the internet. They didn't have to invent the credit card. They didn't have to invent the personal computer or a bunch of other, the shipping, UPS. They didn't have to do the postal service as well. That doesn't exist in space. So the fundamental infrastructure and the fundamental infrastructure that's needed is how do you get to space? And then once you actually have that access to space that's routine and capable and cheap, all those business plans start coming off the shelf. And that's what you're seeing now. That's why there's so much private equity actually coming in to the space industry, because people are recognizing, oh, that cost curve is shifting and it's shifting quickly, and I can actually get some first mover advantage by actually investing into space now.
Right. So but the investment is going into what kind of companies, right? Like it's not going into launch providers, or is it theoretically possible that you would see more we've seen a few, like Relativity Space just announced some funding, but is that an area for now, or is the area of focus and not easy opportunity, but the lower hanging fruit, different parts of that kind of picture?
I think it's going to be variable. So I think you now see a large number of small launch providers, and I think that's going to be a really good place for a lot of rocket companies. I think there is going to be, with these particularly distributed constellations, there's going to be a lot of opportunity to do replacements. They won't launch the constellations all at once, but they'll do replacements, and they'll also be able to do smaller ventures. So I think those smaller launch providers are going to do very well. I think there's room in the launch market for 4 or more large US-based launch providers, in addition to the ones that are around the world. But then if you think about what else is out there, you're now seeing fundamentally different business models, which is kind of interesting, because you're starting to see people understand much what they saw with the computer, where there was a shift from, hey, we really care about this hardware, to, no, I don't care about the hardware as much. I care about the information that's coming off of that piece of hardware. And I think people are figuring out how to monetize space resources much better than they ever have, whether that's Earth observation or communications or other kinds of even navigation. There's a lot of value that's there that people are starting to understand those business models now.
Yeah, and so that's another part of kind of the Blue Origin vision, right? Is like opening up access to these resources, space-based resources, and then making businesses around those. Yeah. So can we talk a little bit more about the longer-term vision and sort of
you bet. So one of the things that people don't recognize that our name is Blue Origin.
Red destination, or is that the thing?
Yeah, it's not. We didn't just pick a color.
Right.
It really is about the Earth. That's the reason why we actually call it Blue Origin, and we're actually committed to the idea that you have to go to space to benefit Earth. You can have an argument about how long our resources are going to last, but you can't argue that it's finite. Right. You can't argue. We're going to run out of resources at some point, and so humanity needs to preserve this jewel. We're not abandoning Earth. We're doing just the opposite. We want to protect and preserve Earth. And to do that, you have to go somewhere else and use resources from elsewhere to actually relieve the stress that is on Earth and hopefully restore it to a much better place than actually what we're seeing in production in terms of climate change, et cetera. And so one of the things that we're passionate about is not only getting operationally reusable vehicles, but then also being able to actually go utilize other resources. And then one thing that we talked about earlier this year was this idea called Blue Moon, which is a cargo lander that we're actually developing to actually go land on the moon and get us to the point where we can actually start utilizing lunar resources to build that infrastructure that gets you millions of people living and working in space. Because we believe in this multi-generational view of how do we actually get millions of people living and working in space, that this generation has the responsibility and, quite honestly, the exciting obligation to actually build that infrastructure. And if we build that infrastructure, it'll give us a much better future for our children and grandchildren.
And that sounds great, but it also sounds like, well, then how do you incentivize that, right? Like, how do you incentivize that work to happen now for that future goal, especially when typically our economic incentives are not that long term?
That's right. That's right. So we do have a much longer horizon at Blue Origin than most companies could or should, and that's purposeful. That's being very thoughtful, even down to our motto of what we talk about, which is Gratitam Ferociter, which is the step-by-step approach, that we're going to master certain things step by step. So we break it down to, okay, we're going to master how we actually make suborbital flight work and work reusable, make true operationally reusable. Not let's go inspect it in after the flight or trying to mess around with it. No, truly make it so that you can make it, simply fuel it up and go fly it. And we're going to master that, and we're going to master the engine technologies, and we're going to master it at the orbital scale. So we break down that longer-term horizon into smaller steps, and then at the same time make sure that we are making a self-sustaining business, because Blue Origin is going to become a self-sustaining business. Why? Because customers make you better, and actually self-sustaining businesses last longer.
Right.
They outlast their founder.
Yeah. And is a consideration in there also bringing others along for the ride, or are you primarily like, we'll take care of our own house, and then hopefully the other businesses will come once we establish this?
No, I think there's clearly going to be an ecosystem that develops around all of this, because as you build those capabilities and you provide that type of access, people start recognizing what they can go do. Again, that kind of idea of business plans coming off the shelf, they went, oh wait, we tried this before, we thought about this before, it was never feasible. And there's literally dozens and dozens of very good and profitable ideas that just literally need the capability to actually get to space.
Right. And so then another sort of concrete part of the Blue Origin vision that I find really interesting is this concept of the space stations being a more practical kind of habitation for outer space, rather than like a base on a planet or something like that.
Yeah, I think what you're referring to is Gerald O'Neill had this idea called O'Neill colonies, and it's a fundamental premise that he put in front of his students and said, let's think about this more broadly. What is the best place for humans to live off the Earth?
Right.
And when they asked that question, the answer came back that it's not planetary surfaces. And Isaac Asimov had a funny quote in an interview saying that we've all become planetary chauvinists.
Right.
And it's actually quite a counterintuitive discussion, which is that living on Moon, living on Mars, living on any of the habitable surfaces that we see, it's not a very good environment. It fundamentally isn't in terms of 1/6 gravity or 1/3 gravity in case of Mars. It really doesn't have much of an atmosphere. So living there is like living on some of the worst places on the planet here, right? I mean, it'd be much, much harder than what you have here today. But if you actually have a manufactured world, and that's what O'Neill colonies are, a manufactured world that would have environments associated with the kind of gravity that you want, the kind of atmosphere that you want, could be a very, very good place to live. And those kind of islands that would be at Earth radius to the sun, and close to home, so that you can actually go back home, because everybody's still going to want to come back to the old country. That's going to be a very appealing vision. And it's one of many visions, but it's the one that seems the most reasonable to me.
Well, that's interesting, because there's obviously the argument like, well, there's a massive resource spend, and if you just redirected even a fraction of those resources to more immediate short-term fixes, you could make a lot of people's lives a lot better, a lot quicker.
Sure. Yep.
But it sounds like that's again the longer-term view of that Blue Origin has.
So I think in any portfolio, and whether you're talking a business or your personal investment strategy, you should have both things, right? You need to have short-term and long-term. So I never look at this as a dichotomy. It never looks as you can only do this immediate thing or this long-term thing. You should do both. And we should do both. We have immediate, really critical things that we need to address in terms of climate change, poverty, justice, a whole bunch of things that require our resources and our attention right now. We also need to protect what's going to happen to our children and our grandchildren and what their future looks like.
Right.
And that's one of the reasons why we have Blue Origin.
Great. All right, so we're getting close to time, but just a couple quick questions. So what's your next planned launch activity?
Our next launch product, we're going to have actually a payload launch coming up here relatively soon. This will be, again, trying to exercise the overall system and make sure that we actually have it verified to the extent that we need it to be.
Great. And then also, what's the price tag on that first commercial flight?
Well, we're always going to have a price tag that we actually have listed, and right now we haven't published that yet. I would say that fundamentally that we have, it's going to not be cheap. Any new technology is never cheap. I mean, whether you're talking about the first IBM computers or what we actually see today, but it'll be actually in the hundreds of thousands of dollars for people to go initially. But we're going to get this down to the point where middle-class people can actually use it.
Amazing. Thanks very
it'll be
much.
fun. Oh, thank you, Daryl. Appreciate it. Thanks. Thanks much.
Uh-oh. Almost lost something important there. Okay, you may know our next guest from 500 Days of Summer, Inception, Snowden, or one of my personal favorite movies, 10 Things I Hate About You. But he also happens to be an accomplished entrepreneur. Please welcome to the stage from Hit Record, Joseph Gordon-Levitt.
Hello, everybody.
Welcome, welcome.
Thanks very much.
It's always so awkward when you first sit down like you haven't been talking for 20 minutes back there, you know? It's like,
Yeah, so how are you?
yeah, oh, I'm fine, how are you? I thought we could just start, raise your hand if you know what Hit Record is.
That's
Okay.
good. That's the point of being here.
Why don't we start with that? You started it
Sure.
as a hobby.
Yep.
Now it's this whole big thing. Why don't you explain to the audience kind of what Hit Record is?
Yeah, I'll try not to tell the super long version of the story, but yeah, it did begin long ago, not as a startup at all. It was at a time in my life, so I'd been acting ever since I was a kid, and then I quit for a while to go to college, and then when I got back into it, or wanted to get back into it, I couldn't get a part. No one would cast me, and this felt fucking terrible, really painful. If you're an artist or you know any artists who want to do their thing but aren't getting the outlet to do it. And so I realized at that point, okay, I need to take responsibility for my own creativity. I need to be able to do this on my own. And Hit Record was just this sort of turn of phrase I came up with to be like a symbol for myself. Like, I'm going to be the one to push the button. And it's a bit of wordplay on hit record and sort of how the media is changing from an object into an action. And my brother helped me set up a little website where I was posting little videos and songs and stories that I was making. And we put up this message board. We put up the message board in 2007. It was this little PHP, out-of-the-box message board. And what we noticed with the people that started coming to this message board was some of them wanted to check out what I was making, but what a lot of them wanted to do was make things together. And we thought, now that's legitimately new, because you can watch a video on the internet and that's basically the same as watching television. You can listen to a song on the internet, that's basically the same as the radio. But using the internet to collaborate, to have people be able to make things together they might not have been able to make on their own, that's new behavior that wouldn't have existed a few years ago before this technology. So we thought that was really cool, and we leaned into it, and my brother was a coder, and we started building little features on top of this message board, still completely as a hobby. But the community grew and was so much fun and vibrant and really positive and kind of different than what you see elsewhere on the internet, because I think when people are making things together, they have a common goal, they treat each other differently than when they're like competing for attention and popularity. And so after a few years, my friend Jared, who's here, Jared Geller, said, could this be something more than a hobby and a little message board, could this be a production company? And in 2010, we launched it as a production company and said, let's use this process where people are making things together online, and we made a list of goals. Could we make a short film like this that could play at a festival, or could we put out a record? Could we publish a book? One day, maybe we'll make a TV show. And then over the years, we managed to do all those things. And we figured out the IP and the terms of service, and we figured out how to pay people when productions were monetized. And we're really proud of the community that formed, because like I said, even as it grew, it maintained this kind of positive feeling that felt different than other places online. And so now, just recently, we started thinking, okay, it's been great as a production company, but there's a limit to how many people we can really include in this creative process with the production company model, because in the production company model, it's always us leading these collaborative projects, and that doesn't scale. Only so many people can really be included if we're always the leaders. So what if we could take what we've learned doing this for years, leading these collaborative projects, and build tools to let anybody come and lead their own project? And last year we came up here to Silicon Valley and pitched that idea and raised some venture capital with some excellent partners. Javelin led the round, Crosslink came on, Advanceit, some excellent angels, David Rogier, the co-founder of Masterclass. I'm going to say all these names because they're awesome people. But
I want to know, though, like I had this vision. We have celebrities come and join us at Disrupt, and more often than not, they're investors, not founders. Right. And I just love the idea of Joseph Gordon-Levitt on Sand Hill Road. Were you tell me about fundraising? Like, were you intimidated? Like, what was that? That has to be a little bit outside your comfort zone.
Yeah, it's funny. It's a mix of very much inside my comfort zone and very much outside, because what's inside my comfort zone is going into rooms and relating to people and being able to tell a story and get other people to feel how I feel. That's what acting is and storytelling is. What's new is backing up those feelings with something more scientific, data-driven, the math science against the humanities, I guess you could say, although I think that dichotomy is problematic. But
we're going to come back to it.
Okay. But yeah, so that actually, what I think the biggest benefit I got, and that I should say I and my team got from raising money, even beyond the capital, was in order to raise money, we had to really put ourselves through the paces and really figure out what we were doing in a way that was far more disciplined than we ever had been before. As a production company, we had been cash flow positive for 5 years. All of our gigs had been inbound, but it's just because we were, not to pat ourselves on the back, but I think we were good at what we did. We were doing something kind of unique. People would come find us, and we would do jobs. And that paid the bills and allowed us to grow, and we were 18 people. And but then, like I said, when we started saying, like, how can we include a lot more people? Okay, well, then we have to lean into technology. Okay, well, if we're going to lean into technology, that's going to cost a lot more money. Yeah. Where's that money going to come from? And figuring out what, a business model is. But I didn't know what, I had never heard the term KPI or things like that. I started coming to conferences like this and meeting really smart people, and they would ask me questions about data. And I'd be like, we don't pay attention to that. We just we make art that we like, and we make enough money to pay the bills, and that's what we've been doing successfully for years. And they would ask questions about retention and, monthly active users, and I didn't know the answers. And so we had to start tracking those things, and it's really been educational and I think grown us up a lot and made us a lot more effective at what we do.
Yeah. Also, there are no conferences like this, by the way.
Right. Other conferences that were not as disruptive as this one.
There we go. Thank you. Speaking of some of these business model-y type things, what is the revenue split between Hit Record and the creators on the platform?
So in the production company model, there's a couple different ways we do it depending on the production. If the production is turning a profit, then we split those profits, and half go to the contributing artists and half goes to Hit Record. And it's important to note that usually in these productions where we're monetizing, half the work is being done by creative people in our office. We're working with people who, most of whom are not professionals, but who love
To create.
Yeah, they love their music or writing or drawing or whatever it is, and the idea is to include a lot more people and have that creativity end up resulting in a collaborative effort that is of the kind of quality that we can deliver it to a buyer. And so half and half always felt fair. There are other productions that don't turn a profit. For example, when we do a TV show, TV shows don't usually turn profits. And if they do turn profits, it's because 5 years later or whatever, it goes into international syndication and blah, blah, blah. So we wanted to make sure we could still pay the contributing artists, even though we probably weren't going to see a profit per se. And so then we just earmark a line item in a production's budget. We say what that number is at the beginning, and then we split up that pool amongst the contributing artists.
Recently, you struck a deal with Ubisoft, right? For
Yep.
10 songs for one of their new games, 10 original songs created on Hit Record for $20,000, which is $2,000 a song. Let's say there's 5 collaborators on each song. That's $400 a piece. And there have been some critics that say, this isn't enough, right? How do you respond to that?
Well, first of all, I would say I don't know that it's clear that a lot of that work is being done by people in our office. Like I just said, I think the critics are assuming that people are submitting finished songs all by themselves,
Right.
professional grade finished songs that we can just pluck out and deliver to Ubisoft, which is really not at all what happens on our site. On our site, it's professionals in our office, music producers, going out to the world and saying, let's lead a collaborative effort, and whoever you are, wherever you are, whatever your skill level, we're going to find a way to include you in this, which is, I think, what Ubisoft ultimately wanted, was a way to include not just professional musicians in the game. Their goal was not to hey, we'll find a cheap way to have music get into our game. They're not spending any less money. They're not cutting any costs. They are not paying any fewer people. The goal for Ubisoft was to include as many people as possible, and Hit Record allows for a much more inclusive collaboration because, like I said, you don't have to be, not that many people have the capability to deliver an entire song all by themselves, but a lot of people want to sing along or want to play a guitar part or want to write a few lyrics and have those lyrics be combined with a whole bunch of other people who wrote lyrics and a whole bunch of other people who played parts, and have that all end up into a collaborative song that can be good enough to deliver to Ubisoft. And so that's the service that we're providing. And the people, we've also, we've been paying people in this exact way for almost 10 years now. We've paid almost $3 million to different people. The criticism that you're talking about is the very first time we ever got criticism like that.
pretty good since
And to be honest,
2007.
it's from most of the critics didn't have all the facts, and it's happening on Twitter, which is not so good at delivering facts.
You're not wrong about
yeah.
that. Can a creator come and make Hit Record a viable career?
No, and we never position it that way.
Okay.
No, look, there's a lot of, I think, messaging out there that will say, we can be your entree into a career as a professional creative. And I think, frankly, most of that is not entirely honest. And even a lot of the big giant platforms, I think, are somewhat guilty of that. YouTube presents a narrative of hey, you can be a star, you can become an
Right.
influencer. The amount of people who make a living on YouTube is minuscule compared to the number of people that are uploading videos. On Hit Record, we really don't emphasize this is your entree into a career. What we talk about is there's more to creativity than money and show business.
Right.
Creativity is something that I think is human universal. I've been very lucky to have a career, and when I say lucky, I mean lucky. I happen to be born and raised in Southern California. I happen to be a
Really
straight
cute.
white male. I happen to have a lot of different advantages that Not everybody has, and but that doesn't mean that everybody shouldn't have that urge to be creative met in a fulfilling way. And I think that a lot of the media tech platforms right now don't really come through on fulfilling that side of creativity because they put so much focus on, like, you could be a star, build your subscribers, like, get famous, get attention, because that's what drives their ad-driven business model. We try to emphasize, like, what I have experienced in my life is actually what brings me a lot of joy and happiness about the creative process is not the red carpets, it's not the, box office, it's not those kinds of external validators, it's the doing it. It's when I get to actually do the art and especially do it with other people.
Yeah. Do you think that, speaking of YouTube and Instagram, we're actually going to have Neil Moen here soon. Do you think that YouTube and Instagram are a net positive or net negative for humans' creativity?
I think they're a net negative. I think, and they're two different platforms.
Yeah.
YouTube in particular, and I should say both, YouTube and Instagram, there's tons of beautiful things that you can find on both of those platforms. So you asked me net.
Yep.
So when I say net negative, I don't mean absolutely negative. I mean, there is tons of incredible stuff, beautiful communities form, all kinds of creative human expression. It's not to say that it's all bad, but I do think that in general, the basic business model of we're going to offer a quote-unquote free service in exchange for the right to conduct mass surveillance and then apply these incredibly expensive, sophisticated machine learning algorithms to this massive data set to optimize for not the benefit of the users, not what's going to make the users more creative or more informed or more compassionate or anything, but optimize instead for the agenda of these third-party advertisers. I think that's a basic business model that we all as the world should get off of entirely. We shouldn't be monetizing software or businesses that way. There's a great comparison made by Jaron Lanier, who I recommend reading all of his books. And he says, if you were going to work with a hypnotist to help you, there's lots of good things that hypnosis actually, I think, can do, and this isn't woo-woo. I think there's some study about some efficacy of hypnosis. It can help you quit smoking, help you get over a fear or something. And that makes sense if you're the one paying the hypnotist. If you're the one who's saying, like, okay, hypnotist, I want you to help me do this. But who would agree to get hypnotized by a hypnotist who's getting paid by someone else? You don't know who that someone else is, and you don't know what that someone else is asking the hypnotist to get you to do.
Right.
No one would agree to do that, but that's what we're all doing, and I include myself in that because I am on Instagram and YouTube and Twitter as well. But it's not a business model that I think is probably beneficial in the long term. And there's a lot that other experts have said about how it impacts economics and government, et cetera, which I'm much less an expert on, but what I think I can speak on with authority is the creative process.
Yeah.
And I do think that this business model is bad for people's creativity, especially young people. I think if you are setting out to make a short film, for example, and you already have on your mind what's going to get me the most likes, followers, subscribers, et cetera, that is not the creative process that's going to make you the most happy as a creative person.
Okay, a couple more things. We're running short. I want to talk about Netflix a little bit. Netflix has essentially been collecting so much data about what we like and what we don't like, and how we consume content, that they are able to make very data-driven decisions. They don't pay $1 over what they need to for the content that they want, and they can optimize it algorithmically so that you click on it and that you watch it. You, I think, operate in a very different world where it's really creativity that drives some of the decisions that you might make. How do you approach that? Is data something that is going to be more and more involved in the hit record process?
Yeah, I don't have any problem with using data. I don't have any problem with machine learning. The question is, what is the machine learning algorithm optimizing for? Whose agenda is it serving? I think Netflix is a good example of what we should be doing. There's a direct billing relationship between the customer and the service. The customer's like, hey, Netflix, I want to watch stuff that I like. Netflix is like, cool, we're going to
Here.
collect a bunch of data on you and try to, give you stuff that you like. If that's what you want, great. If there's there are meditation apps, there are fitness apps that like use data to try to help you achieve the goals that you want to achieve, great. And what we're trying to build with Hit Record is, hey, we think that we can build an app that will help you be your best creative self by pairing you up with other people to collaborate with, because it really oftentimes helps if you want to be creative to be doing it with other people and not just trying to do it alone. I'm all for using data to accomplish a goal that the user has signed up for. It's when the user is being subjected to these algorithms not in their interest, but in the interest of some third party behind the curtain. That's,
Right.
I think, where you get into danger.
So it was recently announced that you are going to be on an upcoming project called Mr. Corman that's going to be on Apple TV Plus. Apple TV Plus has not launched yet, but the company reportedly spent upwards of $6 billion on content, and I'm just wondering how much of that $6 billion is going to you?
A fuck of a lot of it. I mean, I'm getting to make a show, and I'm really, really delighted. Apple has been fantastic so far, and I'm really, really excited to be working with them.
Is Hit Record involved in any way in the Mr. Corman project?
No, other than always, whenever I've done stuff in conventional show business, it's really impacted Hit Record. Because probably if I weren't in conventional show business, you wouldn't be having some dude who raised a Series A
Don't say
sitting here
that.
talking to all of you right now.
Don't say that. My final question is just like, why Apple? I'm sure this was shopped around. I don't know how involved you were in that decision, but why is Apple a good prospect for something like Mr. Corman?
I mean, first of all, their reach, and that speaks to actually the impact on Hit Record. When Apple drops a show, the reach is going to be really incredible, and I think it's going to be reaching. I think there's actually a lot of overlap in the culture of what Apple is and who Apple appeals to with who I think kind of my audience is and who Hit Record's audience is people who are creative. There aren't any other tech giants that are making GarageBand, that are making iMovie, they're making Final Cut Pro. Apple has a history of making the best creative tools ever. Mm-hmm. And that's exactly who I want to be connecting with. And I do think that there's exciting overlap between that and our target for Hit Record.
Joe, thank you so much.
Thank
It's
you.
been a pleasure. All right. So on the Extra Crunch stage right now, we have a panel called Could the U.S. Government Be Your Next Investor? Government has a bunch of money, our money, so that could be fun to check out. It's with Steve Isakowitz, who's the president and CEO of the Aerospace Corporation, and Raj Shah, who is co-founder and chairman of Archeo.ai. Here on the main stage, we're going to be talking a little bit about getting to IPO. So with that, I'd like you to please welcome our next guests. From Box, co-founder, CEO, and chairman Aaron Levy, and from PagerDuty, CEO and chairperson Jennifer Tejada, as well as your moderator, Frederic Larnounois. Big round of applause, please.
Following a movie star.
Yeah. Ooh.
Obviously, now it's time to talk about enterprise software. So that is
Now it's going to get hot.
Yeah, it's definitely the act to be following.
Totally. Nobody's leaving, so we'll be fine.
Okay, good. Now stay in, please. We're going to talk about SaaS multiples.
It's going to be awesome.
Valuations, people, valuations. I was actually thinking this would be fine because we'll talk about IPOs, and 2019 is going to be this great year for IPOs, and it'll be really exciting. We'll talk Uber and Lyft and how great they're all doing, and everything will be awesome. And that just didn't quite happen. What happened this year?
Why are you looking at me? I would say there's sort of a tale of two stories on the IPO side. You have I think companies that were previously valued on a pure revenue multiple in the private market that ultimately didn't translate into revenue multiples in the public market, and then you've got companies like PagerDuty, Zoom, Slack, and others where actually you're seeing pretty durable business models that translate very well into the public market as software businesses. And I think you'd have two very different type of IPO stories and public market stories from that standpoint.
Sure, their stock price didn't quite rise over the last year.
For what? Yes. Well, I think that
all of them, basically.
Yeah, I think, and Jen, as the most recent IPO, should probably talk about this. But I think we have too much of a fixation on sort of the IPO moment, and versus just building durable business models and how do they end up translating into valuations. Like the valuation that you get at an IPO is due to a variety of factors. What did the bankers price things at? What this is why direct listings is obviously a pretty big topic. So I would more look at sustainable trends on sort of how are these businesses being valued,
Sure.
And how are they performing.
I think it's really important to think of the IPO as the beginning, not the end. We all live in Silicon Valley. It can be a little bit of an echo chamber, and you talk about exits all the time. The IPO is an entrance, right? It is part of the beginning of a long journey for a durable company that you want to build a legacy around. And so it is a moment. It's the start of you really sharing a narrative backed by financial data to help people understand your current business, the potential for your business, the market that you're in, et cetera. And I think we tend to talk about it like it's the be all end all. And I think it's really important to think about like why enter the public markets? What are your motivations and your reasons for going public? And in our case, a big part of the reason we went public was to extend our brand platform. PagerDuty is a technical company. It's a platform for real-time unplanned work that's well understood by the developer and DevOps community, but less well understood by your traditional generalist financial investors or even retail investors. And so for us, it was about getting the story of PagerDuty to every enterprise, every business, every modern worker on the planet, and helping them understand how we could change the way they work, how we could help them improve the fact that most of the work that happens to you during a day now is unplanned, it's spontaneous. Something breaks down because of all the complex technology sitting behind it, and yet you've got a consumer that will give you 1 minute to get it right. And being able to sort of take a very technical product and distill that narrative down into something that the financial community could understand was a really important part of our journey. But it also was a story that was actually easier to tell with the numbers. When we were private and we weren't sharing that information, people would say like, oh, little old PagerDuty, oh, what does that little company do? And so when we actually came out and shared our business model, which to Aaron's point, an enterprise SaaS business model is very different than a consumer app business model. And we shouldn't try and compare the gross margins between the two because it's a very just entirely different business model to work from.
But the PagerDuty story has gotten a lot more complicated over the years too, from being this notification platform to being this really complex real-time operating system for the
yeah, I mean, I'd like to think
infrastructure.
the technology is complex. The story is actually simple. So we've moved from being a single product that used machine signals from software environments to detect and understand issues that were taking place instead of waiting for a person to feel the pain and raise a ticket or call customer support. So you've really consolidated that detection and identification period. We then have built on top of that platform of intelligently routing the most important insights to the right people in an organization, so you don't have this situation where customers can't use your products or service, can't download their playlist, or can't order their coffee, and yet it's going to take IT 4 hours just to even figure out who they should have on the call. And so that's what we mean by the orchestration of real-time work. And yes, there's a lot of complexity that sits behind that in terms of managing distributed architectures and data coming at you from thousands, hundreds of thousands of resources. People are in distributed teams and don't know who's who in an organization or who has what expertise. But at the end of the day, what you're trying to do is close the gap between the customer experience, the perfect customer experience you want to deliver, and the technology outcomes that you need to make it happen every time, all the time.
Let's talk about getting to that point, though, where you actually get to tell that story on a roadshow, for example, right? You came in, about 3 years before the IPO as the CEO. What did you have to do to get the company ready to get to that point?
Well, it's funny because we talk a lot about getting the narrative ready and the roadshow, but getting a company ready for the public markets is all about really understanding your business, understanding the predictability of your business, where the strengths are, where the weaknesses are. And I think we spend a lot of time as executives with our boards, as private companies, thinking about like, okay, do I have 606 down? Am I SOC 2 compliant? Will I get through the audit? Do I have 2 years of audit financials? But what we really should be talking about is, do I have the right leadership team for the next 3 to 5 years? Have I really thought through how the competitive landscape is going to evolve? Do I have the right people in the right places? What does my strategic workforce plan look like? Have I prioritized the right opportunities? Because I can't do everything, and experimentation in the public market can be a little challenging. And so getting ready is about, it's about the leadership, is about team readiness, it's about, do you really understand, and can you see the leading indicators in your business, et cetera. And none of those things are easy. And yet, what we tend to talk about is the story, right? And so I think you have to do all those things. There's the inside the company work that you're doing to test whether or not you're ready. And I said to our company all the way through up to the day we launched, we can pull the pin on this at any point in time if we don't feel like we're ready. And I think we shouldn't bemoan people who make that decision, because it's probably ultimately the best decision for the business. And I don't think there should be a ton of shame in going, hey, I've taken another look, new information's available to me, now we're not going to do this, we're going to stay private, we're going to do the things that we need to do.
Well, we got somebody here who spent a little bit of time thinking about
I am
that.
that case study. So we did pull the pin in it initially. So we did a filing, and it turned out that our view of our losses was different than the rest of the market's view of our losses. And anytime you have that asymmetry,
Totally.
where your cash burn is maybe more impactful than you thought to what investors were thinking, that becomes a challenge. And then we got really hit by a public market correction where SaaS multiples dropped by like 30% overnight. So
Don't
really,
know what you're talking about.
yeah. So not a good time to issue a new filing. So we actually paused and we said, you know what, we're going to go get the business into a much better state, show way better financial picture, and drive way more on the cash flow front. But it can be totally challenging inside the organization. We ended up pausing our filing and stayed effectively then private another 10 months longer than we had expected, so we could get the business model in order. And to Jen's point, I think the right time to go public is when you have the predictability, the operational rigor, the team to be able to go and drive a public business. I think what we've seen in some recent case studies or examples where on the masked by the private market story, companies, we're not operating with the level of maybe rigor or efficiency or economics that the public market, would be able to go and value and make sense of, and we're seeing how that plays out. So I think the lesson for any entrepreneur or founder is the numbers are not going to lie, and you have to make sure that the business model, the fundamentals of the business model, are as strong as possible. And I think this is why everybody, I'm sure, has read, retweeted, or written about the Fred Wilson piece this weekend. Yep. Bill Gurley has written a lot on this subject. Ben Thompson around sort of what is a software company and what is not a software company. And I think that it's probably less interesting to decide what is a software company and more interesting to think about what is a software business model. Mm-hmm. And to Jen's point, what are the gross margins of that business model? And the only reason why you care about gross margin is because that eventually translates into operating margin and cash flow. And so what is the durability and leverage in these businesses, and how should we be valuing them, and do you think about them? And I think that we've sort of broadly said, as every company is going to be a tech company, then every company should be valued like a tech company, but that's not actually accurate. Every company might be a tech-enabled company, but the valuations that you ascribe to them might end up being different depending on the underlying business model. And both companies could be fantastic, but you have to run them differently, and you have to think about operating them in a very different way.
Where would you draw that line between the tech company and there's the company that uses tech?
I think we probably spend too much time thinking about drawing the line and the semantics of it. I think it ultimately, if you can use technology as an enabler for your customer experience and for stickiness and for differentiation in the product experience, then frankly, you're a tech-enabled company. Mm-hmm. But after that, we should probably move on from the idea that means something about your company that is different, and then just focus on literally then what are the fundamentals of the business model. Do you have a subscription revenue stream? Is that subscription revenue stream one that is of a high gross margin? What is the stickiness of the customer base? What are your retention rates? Do you actually have a moat that software is actually applying and increasing? And these are the things that really start to define whether your business model is a little bit more on the software continuum or more in sort of the maybe traditional business continuum. Both can be fantastic businesses, but you run it differently, it gets valued differently, the cash flows are generated in different ways, and it's more that you just have to know which type of business you're in and run it in the appropriate manner. I think WeWork is a great example of sort of thinking that the tech would mask the underlying economics of the business model, and it doesn't. Tech is for a customer experience. It doesn't change your business model.
Yeah, I think there's a sensibility. I get asked a lot by CEOs that are thinking about getting ready to go public, what was your playbook? How did you do this? And I think instead of thinking about what's the playbook, you need to be intellectually honest about what does your business look like and what are the key leading indicators of your business that you want the market to understand, and how do you describe your business so that the market has, I think, an objective understanding of what the upside and the risk is. And I think that's one of the challenges of the IPO roadshow is you're selling, and at the same time you're setting expectations, right? And you want to make sure that the market understands where you think the business can go and gets excited about it, but that they don't over-rotate in their expectations, because dealing with really high expectations creates a lot of downstream difficulty. And I think we saw that, this year from an IPO standpoint is a year of two halves. In the first half of the year, we saw really heady numbers and really high expectations. The back half of the year has been very different, and I think a lot of that's been driven by externalities, the political environment, the China tariff wars, the challenges every day that have created volatility in the market as we think about what does it mean to be in the longest, bull run in the history of mankind, right? And so that's the other thing I would say to executives that are thinking about this. You have to be mentally ready for the externalities that you cannot control, and that people will expect you to be able to explain them.
Well, you just dealt with that last week, I think. You had news on Monday, I remember writing about it, and your stock went down 9% that same day. And
totally, and I think the only way you can sort of survive in an environment like this is you play the long game. Like, I'm going to be here in 5 years and 10 years. I'm building a business that I think is going to change the way people work alongside of Aaron's business and Slack and others. And I think the way I think about it is I know for myself, and I try and explain this to my employees, that we could be having the best day at work and the worst day on the stock market. And likewise, we could be having the worst day at work and get a huge uptick in the stock market. The two things are not correlative, particularly in a real-time basis, and the bots are running the markets, so there's not a ton of human empathy floating around in it either. And so you have to try and focus on the business, stay focused on the long game, but make sure that you're managing the rigor and the operations of the near-term business.
Yeah, and I think and this is in Fred's piece this weekend, but I think the thing that it's all theoretical until you go public, but as a private company, you more or less control to a high degree your valuation, because you get to choose when you take funding and thus what your valuation terms are at, and you could choose not to take funding and thus not change your valuation.
And you get to choose who values you.
Yeah, exactly. And then what are they?
The best one.
Right. And so it's a very company-friendly market in terms of the narrative and being able to ensure that you have the right story for employees and whatnot. And again, we have many private companies that have perfected the art of driving that. The moment you're a public company, within 30 seconds of pressing the button that launches the market, which, by the way, doesn't actually launch the market. They have backup plans in case you press the button poorly.
Were you eager to press the button?
I was. I thought that I was launching the stock market that day, and then I was informed that even if I fell off the podium, they were still gonna launch the market, and so I felt like I had less control of the world economy than I had hoped for on our IPO day. But I would say that the moment you go public, within seconds, other people control your valuation at every single transaction, and so they're gonna be driving what your employees or what the market thinks of as your valuation, for a variety of factors that have nothing to do with maybe what you're doing internally, but in many cases, are driven by the things you're doing internally, and those do converge. The great thing about the public market, and I'm actually a really big fan of the public market, is reality and how you're valued do eventually, at maybe over weeks or months or quarters, converge. And at times there is a differential, and you're working to make sure that differential is as limited as possible.
Sure. And let's be clear, there are benefits of participating in the public markets. We're an enterprise software company. We serve more than half of the Fortune 100 and a third of the Fortune 1000 or Fortune 500. Sorry, I always get those numbers wrong. And I think it's important for our large customers to understand that we're a viable business that's going to be around for a long time, that's compliant, et cetera. And so going through the IPO process is a part of demonstrating your mettle, and that you can be a long-term partner with those customers. So I think that's important. The IPO process can be fun too. I mean, it's quite a rallying cry.
Did you have fun?
So we did have fun. I mean, I have a high level of intellectual curiosity, so I like breaking things down and figuring them out and then building them up, et cetera. But for us, the real challenge was telling a very technical story to a very non-technical audience and still being able to refine the value proposition and help people understand it. And the financial analysts and investors, they're pattern matchers, right? They're like, are you the Uber for this or the Box for that or the this for that? And we would have to say like, no. And so I think the challenge is when you're creating a category, there's that much more onus on you to really help them understand what are the problems you're solving, who are the people you're solving those problems for, how big is that market, and why are you uniquely positioned to serve that market? And I think we're still on a journey of learning. I think the financial community and the industry still underestimates the opportunity for SaaS and how early these markets are. Like the market that PagerDuty is in, digital operations management, real-time work, it's a very nascent market. There's a long runway there, but no one ever heard of it, so it's unfamiliar. So you have to actually convince people of the market, the category, your product, your leadership, and if you like a challenge, then that's fun. If you want it handed to you on a plate, probably not so much.
You agree with that it's still very early?
Yeah, I mean,
the markets are much bigger than.
The thing that I get really excited about, and when you look at companies like PagerDuty or Zoom or Slack or whatnot, is I think a lot of times we have thought about disruption as, okay, I'm taking a current market, making it more efficient, faster, cheaper, better in a way that the incumbent can't do. What we often underestimate is when you do those things, how much bigger is that market? Not 2x or 4x or 5x or 10x, sometimes even 100x. Yeah. And what's actually been holding back the market size is the inefficiency of the prior model. And so if you think about something like PagerDuty, where only a very small set of large enterprises in the world had their operations fully tuned, fully automated, with all the right alerts, all the right notification, all the right machine learning around what's going on. And it would be the companies that could afford millions and millions of dollars of enterprise software projects inside their data centers. And now you move to a world where any developer on the planet can use that exact same technology. We're not talking about a 10x change to that market size, but maybe 100 or 1,000x change in that market size. So I think we're insanely early, and when we look at just even the numbers of customers that all of us collectively work with, we're in the earliest of innings in terms of what the cloud is going to be able to do in terms of the businesses globally, the businesses of all sizes, more of the end user adoption that's going to still happen in these organizations. I think the business models that we're now seeing as this sort of next era of enterprise technology, where it's more bottoms up, more self-service, where your audience is measured in the tens or hundreds of millions of people as opposed to thousands or tens of thousands, it's going to completely continue to change the landscape.
Is that true for Box as well?
We hope so. So we've been doing this for 14 years. So in many sense, like we got our start in the very, very, very first wave of cloud, and we were able to ride the first wave of cloud and mobile. But when I look at our own data and when I look at the customer base, just as an example for us, we'll do a little over $690 million in revenue this year. And the total market, the total spend on technology that we think we can disrupt or replace is somewhere around kind of $40 to $50 billion. So we're actually still very, very small relative to the size of the market, and most of that market is going to be moving to the cloud over the coming 2, 3, 5 years. So even though for me, and I have the gray hair to prove it, like we've been doing this a long time, and we feel like we've made a lot of traction, we know that we're actually still in the very earliest stages. And when we go to businesses, again, globally, and the amount of analog business processes, on-premises systems, legacy ways of working that still exist in those organizations that are going to all still move to the cloud. I mean, we're in like the single-digit percentage points of the journey at our stage.
Do you think that's true for you?
Can you validate what I just said about my business?
Well done.
Okay, thank you.
I agree with everything you just said.
Positive because there's like activist investors.
You have to be super optimistic to be in either of our jobs.
Completely. Yeah. I mean, because as a CEO, everybody tests your conviction all the time, whether it's your employees or your family or the investors, et cetera. And there's this huge desire from the external community for something new every time you open your mouth, something fresh, something new, something bigger, something better. And you have to hammer away at the same fundamentals, because most adults can't learn something unless they hear 3 to 7 times over and over again anyway. And so you're fighting this tension of remaining consistent, staying your course, getting people to adopt your narrative and align with your thinking, and yet they want something new and fresh and smart and fun, et cetera. And if you're an optimist and the chief selling person, the chief storyteller, you also want to give the people what they want, and you can't always do that. It's treacherous to do that, I think, in a lot of ways.
Yeah, and I think the balance of all this is extreme optimism with a high degree of rigor and scrutinizing the business, because you have to make sure that the gap between your optimism and reality is as limited as possible and as narrow as possible. But you have to be optimistic in our jobs because of the markets that we're going after and what we have to go create. And to the activist point, for us, it comes with the territory of being a public company. We're going to have lots of different investors. Our investors are going to have lots of different sort of views on the business. We actually agree with most of the views that we hear about as sort of the views of driving more operating profit, driving more growth. And so I've found very few times ever where we've been misaligned with public investors. We might have different views of time frames around when they want to see certain results or execution, but in general, I think public investors have a pretty good understanding of at least our side of the business models on sort of cloud and SaaS. And in our case specifically, there's just different views around the speed at which we want to get to different profit levels. And again, in many cases, we do share those views.
And I think it's important you build resilience as well, and you get your team ready for being resilient. You get your employees ready for being resilient and staying focused on what's out in front of them as opposed to what people say this week or last week or the next week, because that can be very distracting, right? And we're in a really tight talent market. I find myself reminding our teams and our employees about how unique the opportunity is that we're in the probably top 5 to 10% of SaaS companies of all time, that the chances of them finding a career opportunity similar somewhere else are less than the chance of being struck by lightning twiise. And yet I ran the numbers, I ran the odds on that for the last town hall.
That's incredible.
Be careful walking out
And I think the challenge is also dying by slipping in the shower. That was another low odds opportunity. But I think that the challenge is there's a shiny, optimistic new startup across the street on every block, right? And so you also have to be constantly reminding your team of the mission you're on, the fact that your values have not changed, that going public doesn't change that it's the start, not the end. And if you look back over time, particularly in SaaS and cloud companies, they have all created far more value post-IPO than they did pre-IPO. And yet our employees tend to think that the IPO is the exit. Like after the IPO, it's all done, I gotta go find another new hot, sexy startup.
But you're dealing with that. You're dealing with those employees who want to leave afterwards.
So
right?
culture matters. I care deeply about our culture. It is a priority for our entire leadership team and the board, having a diverse, inclusive community, giving back. We took the 1% pledge 2 years ago. We committed 1% of our equity, 1% of product, and 1% of employees' time to non-for-profit. That is going to fund when we come out of our lockup in the coming days, actually. It's going to fund nearly 20 million, maybe a little more than $20 million of opportunity for the community around us. And it's these kinds of things that fulfill the mission of the employees that you're working with and give them purpose.
And I think the struggle that we all share, and many folks in this room, is when you're building a company that starts private and again it's going well and it's growing, and maybe you don't have employees that have been through difficult periods because you're past that point. Our first 3 or 4 years of the company were the hardest, grueling years ever, and there were hundreds of times where we could have gone out of business. And so you have people that come in and maybe didn't experience that, and they only experienced the rocket ship in the private market. And then the reality sets that, okay, now we have to continue to run this business as a healthy public company. And so it's really important on that ride up that you get people in for the right reason. You get them for the culture. Totally. You get them for the mission, and the valuations and the sort of private market stories is as hopefully you're able to abstract that away as much as possible from why people are joining the company, what the mission is that you're doing, and why people are going to be along for the ride.
And I think you've got to be honest with them too. I always say to our team, there's no business class on the rocket ship. It's going to be uncomfortable. It's going to be bumpy. You might feel like you're going to throw up every now and then, but it's going to be fun. It's going to be interesting. You're going to learn a ton.
And based on your stats, you could say the alternative is slipping in the shower. So it's which would you rather have?
Not good.
Great.
All right, nobody threw up on stage, so we're good. We're out of time. Thank you, guys.
Okay, thank you.
Thank you. Good to see you. Thanks, man.
Good job, guys. Okay, we're about an hour in. Take a little temperature of the room. How are y'all feeling? Silent. There, okay. Mildly enthused. We can work on that as we go. Raise your hand if you've heard of YouTube. Yo, come on, guys. I'm out here giving myself to you fully. Yeah, thanks, Kirsten. So we're going to have this guy from YouTube. No, I'm just kidding. Please welcome to the stage the Chief Product Officer, number 2 at YouTube, Neil Mohan, and your moderator, Matthew Panzarino. Warm welcome, please.
Thank you.
Absolutely. Thanks for being here.
Thank you for having me.
Absolutely.
Hello, everybody.
I made this interview 20 minutes and 1 second long so we could fit in 4 ads.
All right, perfect.
That's a YouTube joke. If you're a YouTuber, you got it. Okay, let's start off with YouTube Music. So I want to talk a little bit about that. It's one of the major products that YouTube has announced that are kind of, we're informed sort of by the way people started to use the platform, right? So what's the current state of YouTube Music, and how's it going to compete with like Apple Music and Spotify for its share of that market, that music listener market?
Yeah, sure. So I think as everybody knows, music has been a core part of YouTube really since the days of the founding of the product, when the product was first created. Lots and lots of users come to YouTube to discover new music, to listen to their favorite music. That's always been part of the history of YouTube. And a few years ago, we basically decided from a product standpoint to really lean into that and figure out ways that we could actually serve that music lover on our platform. And it started with the idea of, well, what if we actually had a subscription service that was built for music lovers on YouTube? And we started with something called Music Key that some of you may remember 4 or 5 years ago. That was a service built on sort of the core app. And what we learned from that is 2 things. One is the mode that users are in when they're listening to music on YouTube is often different. It's lean back. It's maybe oftentimes driven more by the audio than the video, although the video is an important part of it. And then also, music lovers on YouTube also love the rest of YouTube. And so that's where we designed our YouTube Premium subscription service, which is a music subscription service, but also brings the best of YouTube with things like background, no ads, offline play. And really, the reason why music lovers come to YouTube is for a few reasons. One is the catalog. Of course, it has everything that other platforms might have, but then it goes much deeper into live tracks or B-side tracks, etc., and all kinds of just
and like
depth.
artist access is part of it, right? Because you can have the same, like catalog is almost achieving parity between a lot of services.
But then the depth of our catalog, of what we have on YouTube, is just dramatically deeper, and really it's something that music lovers have told us over and over is what they truly appreciate about the YouTube platform. And then it's our job to really help them discover that in a way that's effortless, easy, where they're listening to their favorite music and artists, but then also discovering new music along the way. And oh, by the way, something that we think is sort of truly unique to the YouTube platform, given our heritage of connecting creators with fans, is a way to actually connect music lovers with their favorite artists too.
Mm-hmm. And so what are you're doing some new playlists on YouTube. What's that?
Yeah, so our YouTube Music app has been out now for a couple years. We've launched the YouTube Premium service and the app in now 71 different countries. And as we've rolled it out, we've gotten lots of feedback from our users about what they'd love to see. And one of the things that they tell us repeatedly is they love the fact that, and through a combination of things like machine learning and human beings that are music lovers, we put all this great music in front of our users in the YouTube Music app. And so what we're announcing today are basically 3 new ways for users on the Music app to enjoy and discover new music. So we're introducing new playlists on the platform. One is going to be what we're calling the Discover Mix, which is a way to take your personalized preferences, what you listen to, use that as a seed, and help you discover new music on the platform.
And it uses historical viewing data, listening data as well?
Uses all the listening data on the YouTube Music app, as well as yours on the main app of YouTube. We have another mix that's going to be called New Releases Mix, which is a way to discover every week there's new music drop, primarily on Fridays. So it's a way to discover new music that we think that you will enjoy based, again, on your historical preferences. And then sort of really sort of making it effortless when you're really want YouTube to just basically play music that we know that you're going to like, help you discover some new music and artists along the way, but really focusing on what you truly love is something called Your Mix. So Discover Mix, New Releases Mix, and Your Mix are 3 new ways in the YouTube Music app, directly on the home screen, that users will be able to enjoy music on YouTube.
So you're fleshing out this product. When is it going to replace Play Music as like the default listening experience for users?
Yeah, so for those of you that may not know, we merged the YouTube Music product and engineering teams and the Google Play Music engineering teams about a couple of years ago. And back then we said that we were going to combine the best of those products into a single product called YouTube Music. And we're well along the way in that journey. As I said, YouTube Music is now available in 71 different countries. We're going to continue to roll it out throughout the world. But we're going to only sort of cut over completely to YouTube Music when we know that we've satisfied all the use cases that many of our users loved about the old Google Play Music. Things like being able to support your locker of music, being able to play music and play audio files on Android devices, and be able to bring over all that work that you did in terms of your favorite playlists, etc., from Google Play Music to the YouTube Music app. And so those are kind of the 3 core features, if you will, that we want to make sure that we support as first-class citizens in the YouTube Music app before we make that cut over.
So no exact timeline yet on that?
We're going to be driven really by making sure that we address these use cases, and we'd like to do it in the near future, but that's we want to make sure that we nail that for all of Google Play Music music lovers before we make that cut.
Okay, cool. All right, so let's shift gears a little bit and start talking about some of the other content on YouTube created by vast array of different creators. So one interesting development recently is Lily Singh debuted her talk show on YouTube and on network TV at the same time. And so how did that deal come together?
Yeah, I mean, so Lily Singh has been incredibly successful YouTube creator on our platform for many years. Her story is an amazing one where she just basically started to tell stories about her own life in a very sort of humorous, down-to-earth way, and then very clearly her authenticity and kind of her putting herself out there came through, as it does for all successful YouTubers. That's kind of a core ingredient of what makes a successful creator on YouTube. She did that. She built a following of millions. And obviously became very popular on YouTube and kind of throughout sort of mainstream sort of media culture as a result. And when they were looking for a replacement of host for that late night show, it made sense in a couple of ways. One is Lily just has this natural way of connecting with audiences that just is very clearly apparent. You spend 5 minutes watching any of her content and you see that. But also because the nature of a lot of that late night content in particular is that it's often viewed not sort of when it's linearly being broadcast on those channels, but the next day or the next morning in sliced up chunks on YouTube. So lots of those late night hosts,
That's how I watch SNL.
like Jimmy Fallon, SNL, et cetera, are great examples of where their YouTube channels are where they get broad distribution and consumption and where their fans can interact, comment on the videos, et cetera. And so that sort of aspect combined with her just authentic connection with fans was the reason why I think she was such a natural choice for this. And as you all know, she kicked that off 2 weeks ago.
Yeah, and it looks like it's a hit already. So those big YouTubers, the people that gain some popularity and traction and build out a robust audience on YouTube, how do you stop them from just jumping ship to a network or doing something? What are you offering them that's better for them?
So I'd say a few things, and I spend a lot of my time talking to YouTube creators, and every time I've talked to Lily herself, her example, I think, is something that carries across to other top YouTubers like her, which is she knows that her core audience, her most engaged fans, her most passionate fans are on YouTube. She's told me that repeatedly. She tells us that repeatedly. Think about even the way that she launched her late night show. She first broke it on YouTube because she knows that's where her fans are, her most authentic fans are. She's obviously going to continue to build on that core fan base with her new show and all of the other projects. But whether it's a creator like her or other creators who might go on to things like writing a book or
founding a makeup company
in Hollywood, or founding a makeup company. We have creators who have found kitchenware companies, etc. They know that the essence of what they do is the content that they produce on YouTube, and that connectivity that they have between what they're doing and their fan base on YouTube. And they tell us repeatedly that that's ultimately their home. And so it's never about them sort of going on and doing something new and sort of leaving YouTube behind. It's about how do they enhance what they're doing on YouTube with some of those opportunities that come about because of their incredible success on platforms like YouTube.
Okay, cool. I mean, let's talk a little bit about, we'll start it off with the creator discussion in that vein. Let's talk a little bit about the way that YouTube uses machine learning and human curation. But first in this one way, with many creators, I think one of the big cries or big fears is being demonetized, right? So they say they publish something on their channel, it violates a policy, or an algorithm decides, hey, we really can't sell this to advertisers. Explain how that breaks down to me, and maybe I'm misinterpreting it. It's like, what causes a YouTuber to be demonetized, and is there a way you can be more transparent with them?
Yeah. So one of the things that's great about YouTube, and frankly I think is the magic of an open platform like YouTube, is it's a place where anybody with a creative idea or a story to tell can create a video and upload it and share it with the world. That's been the case since the founding of YouTube, and remains sort of the magic behind why YouTube creators have enjoyed the success that they have. So that's a core piece, and we would never want that to change. Having said that, we've always had a set of community guidelines that govern the type of content that is allowed on the platform versus not. So things like hate speech and harassment and graphic violence, etc. They've never had a place on YouTube, and we want to be crystal clear about that, and we try to be as transparent as possible about those policies. In addition to that, we also have something, in addition to our community guidelines, we have something called our advertiser-friendly guidelines. Again, that's something that we publish. We try to be as transparent about for both creators as well as for advertisers that are running media campaigns on YouTube. And those are the set of rules that govern what type of content is eligible for monetization versus not. And so, but we want to make sure that we're doing this in a way that's as stable as possible for our creators, as transparent as possible. So we try to publish those rules. We also have an appeals mechanism so that when creators believe that a video was wrongly demonetized, they can appeal that decision. There's an SLA, turnaround time, in terms of processing that appeal. And we're actually testing out a new program, which is based on the premise that creators themselves are the ones who know best what's in their content. So it's a self-certification program where creators can actually tell us what's in the video, whether there might be swear words in the video, whether there might be some controversial content in it. They can tell us that ahead of time, and we will use that in a way where we trust the creators. And of course, there's audits, and if somebody sort of violates that trust, then it's hard for them to be part of this program. But we want to move more to that type of a model because we think that will be transparent and stable for our creators, but also make it so that advertisers know where their ads are running, that they're comfortable with that as well. But one of the things that advertisers and brands really love about YouTube is the fact that it is different than other places where they run, whether that's television or what have you, because of this authenticity of creators. And the reason why engagement is so high from users on our platform, and the thing that advertisers love more than anything is this engagement, is because of the nature of content. Sometimes that content can be edgy, but it's always authentic, and it always is something that represents a connection between creators like Lily Singh or whoever, and their fans.
So let's break down. I would love to get from you a window kind of into the process of how you like build algorithms and human curation a bit to take care of content on YouTube. So one of the things that kind of stories that just came out recently is that YouTube channels, Nerd City and YouTube Analyzed, they published a list of what they claimed were trigger words that would get you demonetized flat out, like gay or lesbian or a host of other words. And I know YouTube responded to this, and they said there's no such list of words, and the videos were improperly caught up in an algorithmic dragnet. So could you break down for us how the algorithmic detection and policy enforcement works, and kind of how you come to those decisions internally?
Yeah, so you know, I'll sort of give a general answer in terms of how this works from just a broad product philosophy standpoint on a platform like YouTube. And the short answer is it's a combination of both of those things. And so we have, so you know, just to give you a sense of the scale, about 500 hours of content is uploaded to YouTube every single minute of every single day. So the corpus is enormous, and the scale at which we have to enforce our policies, our community guidelines, or our advertiser-friendly guidelines is quite large. And so we have to use you know, machine learning algorithms, classifiers that can enqueue content that might be either policy violative or may not be suitable for advertisers. But then we also oftentimes combine that with human reviews. So we announced a couple years ago that we were going to scale up to 10,000 human raters of this type of content. And just to give you sort of a concrete example, you know, machines are good at potentially finding potential candidates of content that might be violating a policy. Let's say it's, you know, our violent extremism policy. So they can maybe identify videos that depict graphic violence that might seem like, you know, videos that, you know, let's say a terrorist organization puts up trying to recruit people, but only humans can make the nuanced decisions in terms of whether that video in fact is actually doing that or not. And,
or maybe it's like an activist saying, hey, this is a bad thing, we should watch out for this.
Exactly, what is the context of the
it.
video, et cetera. And so that's the means by which we use a combination of machine learning and humans, and you know, we try to be as transparent about the results of this as possible. For example, in our most recent transparency report, which was in Q2 of this year, we said we took down 9 million videos. Sounds like a lot. It's a very tiny fraction of less than 1% of the engagement on the platform. But over 80% of those videos we were able to remove through a combination of machines and humans without any external user actually seeing those videos. And so that, for us, is a real success story, which is protecting our user ecosystem while maintaining sort of the magic of this, of an open platform.
Mm-hmm. And the one of the features I think that has become sort of like a crux of discussion about this topic, about how YouTube does its best to kind of guide people towards good and supportable content, and how away from content that's potentially like hateful or whatever, is the watch next, right? So like watch next is a very powerful tool that allows people to kind of skate through topics. I know I've used it to like skate through like how-to topics or topics about a particular obsession of mine at that moment, whether it's model airplanes or shoes or whatever, and it works out really great in those instances. But sometimes it can run you into a thing where you fall into kind of like a rabbit hole of content that gets sort of worse and worse. Are you thinking hard about how to kind of prevent that and pull people out of that nosedive if they get into areas of content where you're like, hey, we're about to flag this video?
Yeah, I mean, I think the first thing that I would say is and your examples illustrate this, which is the vast majority of consumption on the platform are those topics that you love. Helping people discover new topics, things like, your favorite Latin music artist or K-pop artist or Afrobeat artist. Creators, like I said, of Lily Singh, or another creator who actually joined me on stage when I was at VidCon earlier this year, Molly Burke, who happens to be blind but is an inspiration to, young women and girls all across the world. Like, those types of stories are what the magic of YouTube is about. But back to your question, and that's what's discovered and often what users are consuming in their Watch Next feeds. When we go and look at this much more closely, we see users, lots of users are recommended content that you would call sort of more mainstream. Sometimes it's in the other direction. So every user's journey is different. And one thing that we want to avoid is sending users down paths to more and more extreme content, especially when that content might not be quite policy violative, so it still exists on our platform, but is borderline in nature, or maybe it's spreading, harmful misinformation in some way or the other.
Right.
And so we've had a very concerted effort. We announced this actually back in January, where we are actively trying to reduce recommendations of that type of content in people's Watch Next feeds, in their home feeds, etc. And it's really changes and improvements that we're making to our recommendation algorithms. We've actually had over 20 of those changes since we announced this back in January. And as a result, there's been a 50% reduction in user exposure to content that we would deem to be in that bucket of sort of borderline or maybe harmful misinformation. And we're going to continue down that path. So that, that content sort of represents sort of a needle in a haystack, sort of back to this point that I made of like a fraction of 1% of content. But we're going to continue to sort of improve our recommendation algorithms so that we can drive that as close as possible to zero for our users as we possibly can.
Thanks. And as a heavy user of the platform, right, I appreciate it. So thank you. The last question I have is, there's a lot of people in the audience building sub-content, subscription content. YouTube is one of the people that has actually had some success in that arena. So if there was a piece of advice you could give them, AKA us, who launched a sub-product several months ago, what advice would you give us?
Yeah, I'd say a few things. And as I mentioned at the beginning of the conversation, our core subscription product is called YouTube Premium, which is made for music lovers, but sort of brings the best of YouTube, background, ads-free, offline. And we've had that in the market now for a couple of years. We actually have another subscription product called YouTube TV, which is meant to be a replacement for cable. It's sort of like television done the way that we'd want television to be done. And my I'd say two key learnings for me from a product development standpoint around both those subscription products. The first is really, really focus on being crystal clear and as simple as possible about what the user value proposition is. What are they getting when they're paying, when they're actually paying you, $12 a month or whatever they're ending up paying you for whatever your subscription product is that you're building. Try to be as clear and crisp about that as possible. That's point number one. It sounds obvious, but it's where I think you should spend the most time about being able to articulate that value proposition very clearly. So really think about that. And then the second thing that I'll say, which is I think a little less obvious, is a lot of what matters, especially in the early days as you're trying to build up that ramp to growth of subscribers, is are all the blocking and tackling type issues around how you optimize that funnel of acquisition, retention, churn management. How are you actually measuring and monitoring how much churn there is in the first week, the first month, and then when does it actually start to stabilize it? Is it after the second week or the second month? So really understanding your customer acquisition funnel, not just from a cost of acquisition standpoint, but really how you manage that funnel and how well you understand the leakiness of that funnel. Do you support all the FOPs that you need to support if you're a global product and you want to be in all the markets of the world? Do you support, how do you actually handle the cancellation flow? How do you remind users that are already subscribed of the value proposition of your product? All of these sort of blocking and tackling and maybe not so sexy things in terms of product development really do come into play in terms of really getting your subscription business off to a nice start. But those are secondary after really making sure you nail that core value proposition.
Excellent. Thanks. I'm sure somebody took notes. I'll review those later.
All right,
Thank you very
great.
much, Neil. Appreciate it.
Thank you, everybody.
Thank you.
Okay, like I said, we have a million things going on at any one given time in this venue. One of those things right now is happening on the Q&A stage, how to make your media strategy. That's with Cindy Gallup, who's the CEO and founder of Make Love Not Porn, and Brooke Hammerling, who is the founder of Brew PR. You can find that on the Q&A stage right now. Also at 11:45, we have how to evaluate talent and make decisions with Ray Dalio, who's the founder, co-chairman, and co-CIO at Bridgewater. He'll also be doing a book signing afterwards if you're interested in that. But now, on the main stage, we are joined by Lockheed Martin. Unfortunately, Marilyn Houston is not able to make it due to a last-minute emergency, but we are very, very excited to be sitting down with the Vice President and General Manager of Commercial Civil Space at Lockheed. Please welcome to the stage Lisa Callahan and your moderator, Daryl Etherington.
Hello,
Hi.
welcome. All right, back to space. That's great. So I think one of the interesting things that we were talking about is a lot of the technology that Lockheed has built actually like enables a lot of the consumer technologies that we hear about with geolocation and stuff like that. So like talk a bit about kind of the breadth of Lockheed's business and especially the commercial kind of space side of the business.
Yeah, so in our space business, we're building satellites for military intelligence, commercial applications, so commercial communications, sort of providing connectivity across the world. In addition to that, in my business, which is the coolest job at Lockheed Martin, we build spacecraft that explore our solar system, both robotically, and we're building Orion, which is a deep space spacecraft that's going to take humans to the moon, onto Mars, and potentially beyond.
Nice, yeah. Orion, so you've made significant progress for Orion even just this year. I think in the summer you had a key milestone, which was, do you want to explain a bit about that?
Sure. In July, we had a milestone that was a testing of the launch abort system for Orion. So the launch abort system will sit on top of the capsule, and when the vehicle is on the pad to launch, and as well as when it's accelerating during launch, we could take, if there's an anomaly that goes on, some sort of accident that occurs, the launch abort system kicks in and it pulls the crew module safely away from the rocket, and then it will jettison itself, and the capsule will deploy its parachutes, and then deploy or just softly land in the ocean there, so to bring astronauts out of harm's way.
Right.
So it's a really, really important system for crew safety. We hope to never use it,
right.
But we've done a pad abort test, and we just did in July the ascent abort test. So we just proved out the system, and it's now ready to fly. So we're really excited about that.
That's great.
Yeah.
So ready to fly, when you say that, I don't know that everybody understands necessarily like space timelines for how does that mean that you've got people going in it tomorrow and they're going to go up?
Yeah, so you know, I think Bob Smith talked earlier with you. I think he talked about safety, right? And safety is our #1 priority, especially when we're flying crew. And so there's a lot of testing and validation that we do to convince ourselves and our customers that we're ready to fly and that it's safe for crew to fly. So we've done the launch abort system test, which is a emergency, exit, if you will. And next, we're going to be flying Artemis 1, which is an uncrewed mission. It's about a month-long mission where we'll be orbiting around the moon. And it's really to test out all of the systems and make sure that they can withstand the radiation environment, and that when we come back into re-entry, that the heat shield is sufficient enough to protect the astronauts inside the capsule from the extreme heat that they'll experience as they enter the Earth's atmosphere, that the parachutes deploy correctly, and that we can get the crew out when they return to Earth. So that mission is in late next year. The crew module for that has been completed. Actually, we had the privilege of having the Vice President down at Kennedy Space Center for an Apollo 50th celebration, and he declared Artemis 1 crew module complete. And that is now stacked on top of a service module, which actually comes from the European Space Agency, so it's got an international flavor to it as well. And it will be going to NASA's Plumbrook Station, which is just a huge thermal vacuum chamber where we actually test the capsule in the environments that it'll see in space. So we're excited to go through the TVAC, and then it'll come back and get put on top of the Space Launch System rocket, and off it'll go.
Nice. So that's, you mentioned that the Artemis, right? That's Artemis 1. So this is the Artemis program that NASA is running to go back to the moon, to bring how do they put it? The first
The first
American
female.
woman. Yeah.
And the next man
yes,
to the
next
surface of the moon by 2024.
That's right, by 2024. That's the key thing.
Yep.
So that date, I hear a lot of skepticism about that date when I talk to people and when I see people talking about it kind of in social communities and stuff. So how do you feel about that? You know, NASA Administrator Jim Bridenstine repeats it very frequently. How do you feel about that date? What's your confidence in that date?
You know, I think it's really exciting to have a deadline to get humans back to the moon and then beyond, right? And it's not just going to the moon and then we're done. It's going to the moon and being there in a sustainable way and really using what it takes to get to the moon and what it means to be in deep space so that it helps us to bring humans further into our solar system onto Mars because they have to be self-sufficient.
Right.
There's a lot of autonomy that's required, AI that would be required in our systems because they can't just phone home and say, Houston, we have a problem when you have a delay in terms of the latency and comms. So I think 2024 is extremely doable, but there's some conditions for that. I think one, you know, we need funding to be able to support that, and two, we need to reuse what's already been developed. And you know, at Lockheed Martin, we're really proud of the crew life support system as well as the crew equipment, displays, controls that we've built for Orion. And we think all of that is transferable onto the lander that will be required to take humans to the surface of the moon. So what people may not understand is that Orion's going to fly to the Gateway, which is an orbiting platform around the moon. The astronauts will get off of Orion and they'll go onto a lander, and then they'll get into the lander and they'll take the lander to the surface of the moon.
So it's not a direct flight. They have a connection.
It's not a direct flight, and neither was Apollo.
Right.
They had a LEM, lunar exploration module, that they used to get down to the surface of the moon. And then that ascent element of the lander will go back to the Gateway with the astronauts, and they'll get back in their Orion and come home safely. But when you take your astronauts out of an Orion and you put them into the ascent module of the lander, wouldn't it be great if it was the same systems and you could train them once and they knew how to use that? So think about when you rent a car, and let's say it's a model that you're not used to, how long does it take you to figure out, like, how do I turn the windshield wipers on, or where's the light controls? You don't want astronauts to be worrying about things like that.
Yeah, that's great.
So we call that Orion Inside.
Oh.
We're really excited about using those systems into other elements in this architecture.
And that gives you cost benefits too.
Obviously, yeah. You've already done the development. You've qualified that. So it's a lot of testing, as I said, that we have to do to convince ourselves that it's safe for humans. So if you've already done that, why would you spend the resources to do it again?
Sure, that makes sense. And then it also that leads into kind of the other recent news for Orion is NASA has placed a large order for 6 to 12, I believe it is, right? 6 minimum, up to 12 Orion capsules through 2030?
Yeah, so just last week they announced that they awarded Lockheed Martin the Orion production contract. Yes. So you're right, it's for a minimum of 6 crew modules that we would be developing, and they have an opportunity to order up to 12 of them. And so it's for Artemis Mission 3, 4, and 5 was the first order. And Artemis 3 is critical because that is the crew module for Orion that's going to take the first female and the next man that'll up to the Gateway, and that'll be the landing mission in Artemis 3, so in 2024. So really excited about that.
Yeah.
And the team's been working really hard to look for ways to really reduce the cost as we get into production. One way that we're doing that is through reuse. So what people may not know is that quite a bit of Orion is reusable. And we've been qualifying the equipment for multiple uses to make sure that that equipment can be used over multiple times. And so there'll be reuse. There's been a lot we've done in automation. Augmented reality has been a really cool thing and really has had a big bang in terms of our productivity for our technicians on the floor that are building Orion. We actually give them goggles that they can put on with augmented reality. They can see their work instructions through those goggles, and they can actually see the placements of where they would put fasteners and other things on the spacecraft. So tasks that used to take 2 or 3 technicians 2 or 3 days to complete, we can do it with 1 technician in about 2 hours.
And so when you have that kind of technology, are you developing that all in-house, or are you working with partners, or how does that, like the AR stuff specifically?
Yeah, so we're using a lot of commercial off-the-shelf AR technology, but one of the things that we do with our spacecraft is every one of our spacecrafts we build a digital twin of. So think of that as we build our spacecraft digitally before we ever bend any metal. And by having that digital twin of the spacecraft, we can use it in the design process to make sure that we have the right clearances for equipment and things. We can use it during manufacturing, as I just highlighted with work instructions, as well as where do you put fasteners and technology. But then we can use it during the mission. We can actually run the mission on our digital twin here on Earth. So if there are issues with the spacecraft, we can see where and help to debug from here on Earth.
Right.
And eventually that digital twin could be on the spacecraft itself. So when astronauts are at Mars, hundreds of thousands of miles away from here, they can use a digital assistant and interrogate this digital twin to help them make decisions on where they look first for any problems that they may be having,
So
or how
maybe
to use a backup system that maybe they weren't as aware of.
Is that like if they wouldn't have to do EVA, for instance, without being informed first through something like that?
Yeah,
or-
yeah. And if they did have to make a repair, they could use this digital environment to train on how to make that repair before they actually test the actual hardware or touch the actual hardware.
So then, like, that seems like a great opportunity where, like, you can lean on partners who are more expert in that field to come in and help, right?
Yeah.
As providers, technology providers. Where else does Lockheed look to kind of industry, to startups, to younger companies to support the work that they're doing?
Yeah, we love, I'm excited to actually be here because there's so many great startup companies, and many of which are in space these
Yes.
days. So Lockheed Martin has a group called Lockheed Martin Ventures. Chris Moran leads that for our organization. And we make investments in startup companies and are really looking to try to help accelerate some of these startup companies because they've got key technologies that we need that maybe are used here on Earth, but we want to apply them into a space environment as well. So in the last 2 years, we've doubled the investment that we're making in companies. So our budget for that's grown to over $200 million now. We've got investment in small satellite companies and small launch companies, and we're continuing to work, in a mentoring way as well as in a financial way with these companies. So.
Great. And is that also like an acquisition funnel for Lockheed?
It could be.
Yeah.
Absolutely. It could be. I will mention on Orion that for every dollar that's spent on Orion, 60% of it goes to supply base. So we do have a huge supply base, and of that 60%, 30% of that is to small businesses. So we've got businesses across the United States, and almost every state in the U.S. is supporting us in that. And those small businesses, there's just one story after another of great ways where by companies getting into space and aerospace industry, they've totally reinvented themselves as a company.
And it has benefits to other aspects of their business.
Of course, and then it helps their business and helps them to grow over time.
Yeah, I mean, this is an interesting, because again, I asked Bob about this too, but there is a perception that this money is perhaps better spent elsewhere, right? So you don't see the ecosystem effects, I think, a lot of the time, but like, Lockheed must get that kind of criticism, right? Like, you're getting these very valuable contracts that are government contracts, right. So it's government money going into space, and people are saying, well, why don't you just spend that here at home, right? So on Earth.
Yeah, but the thing is for every dollar you spend in space, the benefit is exponentially bigger on what it means here on Earth. The technologies that we're getting out of space, like how many people here had to use a GPS to find the location of this facility? And that came out of the government investing in technology that's there. I lived in Florida for years. I had an ionization on my system on my pool. I didn't use chlorine, and that came out of the space shuttle system of how they purify water on station and in the vehicle. So we benefit from that technology. And then the other piece is space is really cool. It inspires the next generation. Yeah. And I'm so excited that we're excited about talking about space and sending humans back to space because we need more folks to be excited about science and technology and engineering and math. And the more we can inspire that next generation, it'll benefit all of us.
Yeah, I mean, that's an interesting point you bring up because I think that there's I've talked to a lot of people who have said, it's again, there's an excitement that hasn't been there necessarily since the shuttle program, right? And also, I was talking to an entrepreneur that we have in our battlefield, and he was saying, I can hear NASA changing on the phone. Like I can just hear the change happening about how they approach because of the entrance of private or new private companies, and because of kind of the enthusiasm around it. Have you noticed that? What has it been like to change through this, especially as you see competitors emerge, like a SpaceX, right?
Yeah.
Competitors and partners sometimes, right?
Yeah. Yeah, absolutely. I mean, again, the excitement. We're on the brink of a new space age. We've have more than 900, 1,000 startups that are coming in this area. You do have folks like SpaceX or Blue Origin that are getting people excited about it. And to your point, it's a discretionary expense. So if you can get the public excited about explorations and sending humans into the solar system, and all of it is to benefit what we do here on Earth.
Right.
The more we can learn about our solar system, the more it can benefit us in understanding how did Earth, come to be, where is it going in the future, what do we need to be doing to protect this planet, because we owe that to the future generations.
Yeah, I mean, that I think gets at, again, the problem of like, there's still the what's in it for me attitude, and not in such a selfish way, but even for the startup, the small business crowd, it's like, what does a mature space economy look like? And then where do I fit in? Where do I benefit from that? So what do you think about that? Like,
well, I think if you look at space, right, there is no infrastructure in place in space right now, other than commercial launch that's there. But how are we going to transport people? Once we get them there, what are they going to do? There's very limited bandwidth in terms of communication. So all of that, everything we have here on Earth, and as technology continues to explode and make our lives better, we need to take all of that into space. So I think there's a lot of opportunity to take the same kind of infrastructure that we have here and move that more into space. And that's where I think companies can continue to grow and expand, and how do they take those technologies and transfer it there. I think the thing about space is it's somewhat unforgiving, right? Electronics, things have to be hardened and reliable and self-healing, but once we can get past that, and we have for a lot of technologies, the sky's the limit.
right. But then what's the economic engine for that, right? Because it seems like it's, again, a lot of like upfront cost, upfront risk for long-term rewards. And our audience, our VC friends don't necessarily have those timelines in mind, right? So how do you drive upside now in order to build a kind of sustainable infrastructure?
Yeah, I think you have to start small. But I think the government's going to play a pretty big role in helping with some of that infrastructure. They already have, right? NASA has International Space Station. They've been offering it to commercial industry now for many years to bring technologies out there. They're giving them free transportation there. They're letting them, drug manufacturers are looking at new drugs. There's fiber optics that's being built in space. There's manufacturing in space. So there's a lot of new technologies, and NASA's providing that infrastructure to allow startup companies to try new technologies and see what it takes to actually perform in space. And I think you'll see that continue.
Right. And what about more near term, like you work a lot at Lockheed in robotics and robotic exploration. So can you talk just a bit about those programs? I don't know if you want to, we do have a presentation. We should probably bring it up, if we can bring up the slideshow, because it's super cool.
Yeah.
So I just want to look at it before we go.
So we've been exploring our solar system for more than 4 decades,
Yeah.
And probably longer than some people in this room have been alive. And so we've got 8 spacecraft that we operate for NASA right now out of our facilities. And I just brought a couple of cool images to share with you guys.
They're up there.
Oh, okay, perfect. So the first one here is, this is an asteroid, Bennu. So this is a near-Earth asteroid. It actually has a very slim chance of actually impacting Earth one day. But we have a spacecraft called OSIRIS-REx that is orbiting around Bennu right now, and it's made this image from its instruments that are on board. And we continue to learn things that we had no idea about. So we found out that Bennu is much rockier than we ever expected, and we're actually next summer going to tag this asteroid and bring back a sample to Earth. And the reason we want to know more about the asteroid is it helps us to understand how the solar system was formed, and even because it's a near-Earth asteroid, how Earth was formed, and that will help us understand our own planet better. But this asteroid is really rough, and so we've been trying to identify where we're going to tag it.
Right.
And on top of that, it's actually spitting particles at us, so we have to protect the spacecraft from those particles as well. So tremendous amount of stuff there. So again, next summer we'll be tagging that, and that will come back to Earth, so pretty exciting. These are just some more images of that Bennu. And how
does
rocky
this have
it
like
is.
a potential commercial applications? Like, do you think about that when you're
So
doing this stuff?
there are companies out there that are talking about asteroid mining, right? Yeah. There's a lot of minerals and precious metals that are in these asteroids, and if you could mine those asteroids and collect those metals, you could actually do in-space manufacturing. And one of the biggest costs to space right now is getting things off of Earth. If you could actually do things in space outside of the Earth's gravity well, it's a lot cheaper to move that, and the costs go down incredibly. Let's see what else. This is a picture of InSight on Mars. So that's an actual spacecraft that landed on Mars back in November, right after Thanksgiving. And InSight is really studying the interior of rocky planets. So it's not so much about Mars, but using Mars to help us understand more about planets like Earth and rocky planets. So it's got a seismometer on it, which is in the upper right-hand corner. And NASA just released yesterday, if you go out to their website, some new sounds that are coming off of Mars. So there's the sound of the wind, there's Mars quakes, which we're measuring on the seismometer, as well as you can actually hear it when the arm moves around. There's also a thermal probe on it that's going to dig deeper into the Mars to understand more about the core of Mars. So a lot of great science there. And then this is a picture of Jupiter. So we have a spacecraft we're operating for NASA that's called Juno. It entered Jupiter's orbit on 3 years ago in July of 2016. And that black spot on top of Jupiter is actually, we caught an image where we were seeing the shadow of one of Jupiter's moons shadowing down on the surface of Jupiter. So we are literally rewriting the science books around Jupiter with Juno. We are learning more about it than we ever thought before. We thought it had a really tight core with a lot of gas around it. We're finding that the core extends almost 50% of its radius, and it's very squishy. It's not really a hard core, and it's not uniform at all. So stay tuned. We're learning a lot about the solar system, and we'll learn a lot about what that means for Earth as well.
That's great. All right, thanks very much, Lisa.
Yeah, thank you.
Thank you. Okay. Coming up next, we have a special news announcement. So with that, I'd like to please welcome to the stage the co-founder and executive chairman of Foursquare, Dennis Crowley, and your moderator, Lucas Matney.
Hey, everybody. Well, today we've got a little news interstitial of sorts. We've got Foursquare co-founder Dennis Crowley. Foursquare has been up to a lot. What are you up to right now?
Well, first, thanks for having me here. Excited to be here. Yeah, we've been doing Foursquare for more than 10 years now, and in those 10 years, we've built all sorts of amazing stuff. We've accumulated all sorts of technology and data assets. I think we've done an amazing job trying to share a lot of the things that we've built with the developer community, really starting with the API when we released that in 2009, 2010, and all the places that we were learning about around the world. One of the things that we're most proud of in terms of our technology and data assets is this thing called Pilgrim. And Pilgrim is this piece of technology that has taken us, gosh, almost like 5 or 6 years to build. And it's a couple lines of code now that you can put in an app, basically. And then that app becomes aware of where it is, right? So we've packaged this up in something called the Pilgrim SDK, and we've been sharing it, we've been using it in our own apps, and we've shared it with a few select developers on the enterprise side. But it's a couple lines of code you can put inside of an app, and when that app goes into a retail shop, walks through a mall, walks through a city, it can understand, am I in a bakery? Am I in a Nike store? I am in a coffee shop called Starbucks. Have I been here before? Is this place familiar to me? And so we think this is one of the foundational building blocks of building contextual aware services. And the thing that we're here to announce today is that this piece of technology that we've worked so hard to build over so many years, and we've kept very, very close to us, we're finally releasing it for everyone to use as a free tier. So today we're releasing the Pilgrim SDK, available to all developers. People can jump in, start to play with this, put it in their apps. You're entirely free to use it, unlimited geofences, and free for up to 100,000 MAUs.
Cool. So this is a pretty central part of your company now. You're, out of the consumer space to some degree, and you're really focusing on Pilgrim.
Yeah, exactly. We've built so much technology and data over the last 10 years or so, and we kind of see this vision of the future of apps that change based upon where you take them, apps that change based upon where they've been, where your phone has been. And for a long time, we waited for other companies to build this technology before we realized, maybe 5 or 6 years ago, that if we wanted this stuff to exist, we were going to have to build it ourselves. It took us a long time to do it. We were testing internally. You see this stuff now in the Foursquare City Guide app and in the Swarm check-in app that we have, as well as a whole bunch of our enterprise partners. And so I think the thing that I'm most excited about is to take this technology, give it to as many developers as possible, and see what people end up doing with it. Whether they're making exercise or fitness apps, financial money tracking apps, health and wellness apps, game developers. There's just so many things that you can do in order to build apps that change based upon where you use them.
So you've been working with a lot of these customers for a while. Why did you wait until now to have a free product, essentially, to bring them in?
Yeah, there's a couple reasons. First of all, we wanted to make sure the stuff worked as well as we needed it to, right? We've taken a long time to build these products and build the technology. We wanted to make sure they really work as advertised, and we're testing these things all the time internally and with these other clients. The second thing is, there's this thing of with great power comes great responsibility. You can make all sorts of amazing things with the technology that we built, but we're also very aware that people could use it in ways that we don't want them to use it. And so, we spent a lot of time internally at Foursquare making sure that the technology that we build, whether it's through the API or the SDK, it has certain restrictions on it. There's certain categories that you don't want to make available to developers to understand where phones go, whether those are spiritual centers or a chemotherapy center, a divorce lawyer. There's categories that developers shouldn't have any business knowing that you've taken your device there. And so we've been careful to build those safeguards into the tools that we built so that people can still build amazing things, but not exploit them in ways. We wanted to make sure that they had the right infrastructure internally so we could build these things, yet still vet the developers that were using the software, and then having systems to be able to keep an eye on things.
Cool. How do developers get access to this?
Do we have a slide? I'll put it up here for a second. I'm going to go real quick because we have 15 seconds left, but hey, here's our SDK.
We'll get there.
You have access to all these amazing tools, technologies, dashboards, geofencing. And to sign up, just go to developer@foursquare.com. Again, totally free for all developers, up to 100,000 users, which is a really, really big deal. And a lot of this software hasn't existed before. We're just entering this era of contextual aware computing. There's a lot of building blocks that need to get built. We've built a lot of them, and we're excited to share it with as many developers as possible and see what people do with it.
Solid. Yeah, so Dennis and I are going to be chatting on the TechCrunch stage at 4:25, and we'll dig into this a little bit more, talk a little bit more about Foursquare and its journey as a company, but we'll chat then. So please join us.
Excellent.
Cool.
Thanks for having me. I appreciate
Thanks.
it. Thank you all.
Good job. Thank you. All right. So we are going to be breaking for lunch. Just a couple quick housekeeping notes. There's going to be a book signing outside the entrance to the main stage with Ray Dalio on his book Principles, if you want to check that out. Sweetgreen is $10 off. I didn't know about that until just now, so that's cool. And the transcription of all our main stage content is powered by otter.ai, so check that out there. I will see you back here at 12:50, please. Enjoy lunch. Bye-bye.
As companies transition to using microservices in their architectures, more APIs are created across the organization. With this increase, it can become more challenging for developers to find these internal APIs and reuse them when they're developing new software. That's where Rapid API for Teams can help. Rapid API for Teams enables development teams to publish their internal APIs into a private workspace. Developers can find any internal API, view its documentation, test it, and connect directly, or collaborate and share information about the API right in Rapid API. Team members can also subscribe to any public API available on the Rapid API Marketplace, and the entire team can see and use that subscription. This way, you only pay once for any API your team uses. Rapid API for Teams makes it easier to share and collaborate on APIs. Get started today on rapidapi.com/teams.
Our teams love building companies that create value and make a difference. As well as our investments in companies such as Tencent and Mail.ru, we're building meaningful global businesses in online classifieds, food delivery, and payments and fintech.
Bob and the team have great experience in operating and investing in large companies in India, be it fintech, be it commerce.
Because they are global and they understand consumer business, they have a very helpful and specific advice that they can give to us.
They think like entrepreneurs. They're a fantastic partner.
Our big vision at Movely is to make life better for 1 billion people, and I believe Prosus is the perfect partner to help us achieve our dreams.
Why did you come to this workshop? To learn. But quickly I realized I started unlearning some things which I've been doing very incorrectly in the past and which didn't really give me the results that they're supposed to get.
I want to be where we ask questions like why? And the big question I ask is what if? You know, it's a different way of thinking at Stanford than it is at any other university in the world.
I realized I was getting stale, so I said, you know what, it's time for me to move on and look for greater things and have more impact.
At Lockheed Martin, we're on a mission. Your mission. When millions of people are counting on you, you can count on us. To build the impossible, to invent the inconceivable, and solve every problem with speed and reliability. Every mission is an expedition of the greatest importance, both to you and to us.
We were actually inspired by the Terminator 2 video T-1000, and that idea, basically the idea that the mass for the object could come from the liquid underneath it. Carbon is revolutionizing how people design products, and we've cracked the code on how to make polymeric products at scale, and therefore unleashing the power of digital manufacturing, digital design, and all the opportunities that that has to make the unmakeable and have people's dreams on what they want to design come to fruition. So we figured out a chemical way to maintain that liquid interface and still grow an object. And we invented a very special window that is not only optically transparent, but it's also permeable to oxygen. And oxygen and light work in polar opposite ways to allow us to take the liquid underneath it, like the puddle, and have that become the mass for the object that's growing. It allows you to go really fast, and that opens up the opportunity for durable materials that can make end-use parts while you create these designs.
What you get out of the printer is the final product. Whereas in traditional 3D printing, a lot of it is prototyping. And also
We're outside of Portland, Oregon at Leica, one of the most interesting companies working in animation today. Unlike traditional studios, Leica uses a combination of stop motion animation techniques and things like 3D printing to create animated worlds that don't look like anything else out there.
Ah! Wait, I don't get it.
Lucky us, they've got a new film coming out and we got to hear all about it.
On the page, this seemed like not the kind of movie you should be trying to make in stop motion. It was huge. And I think that's why we decided to do it. I think all the skills that we've learned, all the innovations that we've made on the previous movies have kind of set us up to make this one.
You're the man for the job. How's my breath?
On this movie, there's so many little things that you might not necessarily notice, but together, they probably made this the most innovative movie that we've ever made. The facial animation on our previous 4 movies, we used a kit system of faces, so we would replace the faces onto the puppets, and we pieced together dialogue sentences using pre-existing faces. On this movie, we wanted more nuance, we wanted more subtle acting, and the way we ended up doing it was bespoke animation, so that each shot has its own specific faces that are just for that shot, and that allowed us to come up with performances that were unique to that moment, to that thought, to that line of dialogue. That's something we've never done before, but it has given the animation a lot more complexity.
We're using 3D printing in a really unique way. We're actually using 3D printing as sort of our mass production tool, where we are mass producing hundreds of thousands, actually 106,000 unique faces for the film Missing Link. Leica started a technique back on the film Coraline, where we had this idea of using this age-old technique of replacement animation, which was typically done by hand sculpting individual facial expressions. And our idea was to fuse it with 21st century 3D printing technology. We've actually gone through 4 different types of 3D printing technology. We started with polyjet technology made by Stratasys, which was essentially a single color resin printing. But at the time, Coraline and all of the faces that we produced on Coraline needed to be hand painted. So starting on Paranorman, we moved to a color 3D printer. And that color 3D printer was made by a company called Z Corp, and it was called the Z650. And it was powder-based printing. And that technology was our base technology for Paranorman, Box Trolls, and the human characters on Kubo and the 2 Strings. Starting on Kubo, we played around a little bit with this emerging resin color printing. It was a Stratasys Connex 3 machine, and that Connex 3 machine allowed you to mix 3 colors, which was pretty limiting. You couldn't print the rainbow. You sort of had to choose what 3 colors you were going to mix. Shortly thereafter, Stratasys released the J750, which allowed you to put 6 colors into a machine and mix them and come up with a huge gamut of color. And at that time, the software that Stratasys was building to run the machine was pretty limited. So we ended up needing to partner with a research institute out of Germany called Fraunhofer. And Fraunhofer had developed this advanced color 3D printing slicing software called Cuttlefish. And that unique combination and that unique relationship allowed us to produce the wonderful faces you see on Missing Link.
The requests for the performance of puppets as we move through each Leica film is incrementally more. We speak about sort of puppets taking a breath and living. The materials that we landed on, they work well for the reason of they've got range. They'll move beautifully. But that said, when an object is made of something, but it's supposed to be something else, ensuring that it doesn't look like that material is something that we dial in, and that has its own complexity. I mean, if we look at Link, for example, he has all those fur pieces. Well, he has a kind of rubber suit, if you like, for the main part, and if those fur pieces kind of fold or buckle, then that destroys the illusion and that destroys the performance. So even something as simple as that, to actually arrive at and then put in place for mass manufacture, because that's something that we also have to consider quite deeply, is really something. Yeah.
I believe stop motion is still relevant because it really is the quintessence of what filmmaking is, and that is, to me, it's real light on real objects. From an aesthetic point of view, there is something about the tactility of stop motion that makes it compelling. When we did Paranorman, Angry Aggie, the spirit girl at the end, and she was a combination of a stop motion puppet, and she had a CG dress, and her facial animation was 2D. So she was a real hybrid. And I remember sitting with people and they couldn't quite work out what it was that they were looking at. Was it a puppet? Wasn't it? That's what I like, is when people are kind of riveted to this image on screen and they're not quite sure how we did it, and there's something magical about that. I am not a stop motion purist. I love stop motion, I embrace it. I think it's my favorite medium. But in the end, what I want to do is put an image on screen that looks the best it possibly can. And really, filmmaking, certainly of this kind, is telling a story. And the hope is that you have an audience of people who are compelled by the characters, care about the characters, and are sucked into that story. And I certainly don't want the artifice to take them back out the story again. That is a valid artistic decision to make. You can do that by all means. I love movies that do that. But for me, that's not what we're trying to do. We're trying to tell a story and use whatever means possible to get the best image in front of the audience.
Bravo. Thank you.
I work at Lockheed Martin mainly because of the mission, right? It's not a consumer-centric company. It's really kind of your only opportunity in the Silicon Valley to push technology forward on a scale that you can't in a consumer environment. You're working with a very different design methodology, right? Because what you're trying to do is you're trying to make a one-off as opposed to making a million of something, and that one-off has to be as good as it can possibly get. So you're pushing everything you know, you're pushing all the technologies, and it's really just a much different problem set than you would get at a different company in the Bay Area. At Lockheed Martin, I help to develop new technologies in both active and passive sensing, as well as optical communications. Currently, imaging systems for satellites dominate your satellite. They become the dominators in terms of size, weight, and power, and they really become the whole portion of the satellite that matters. The goal with the Spider imager is to shrink the size of the telescope by 10 to 100 times. So SPIDER stands for the Segmented Planar Imaging Detector for Electro-Optical Reconnaissance. It means that you have a planar imager that takes images interferometrically. It infers what an image would be as opposed to taking the direct image. So the alternative to SPIDER would be more conventional imagers, which would be large, bulky glass optics like we've been doing in the past. Your satellite that took images for your Google Maps, when you click the satellite view, that satellite was equivalent to the size of a school bus. The SPIDER imager would be the same diameter, so it would still be very large in diameter because you need a certain imaging resolution. However, it would be much, much thinner, from 20 feet to probably a few inches, maybe 6 to 8 inches at most for a full instrument. All right, so this is where we generated the first SPIDER image. There's some lenslets, and they're coupled into the front of the photonic circuit.
We know that the engineering challenge is really how to do the electronics and how to be able to get them smaller, but it seemed like a lot to bite off at once, which is why we were kind of focusing on the front part, which is the technology piece.
In the future, what this means is that your instruments and your satellites going to places like Mars would be much more capable and provide much more science in the same space. It could also be used on a drone or in any sort of space, weight, constrained environment where you want to add imaging capabilities, but you don't want to detract from the overall mission.
My name is Nathan Kosla. I'm a researcher here at Lockheed Martin in Palo Alto, and we're in the nanocopper lab. What we're developing here is actually called nanocopper. We call it a nanostructured material. Currently, people use tin solders. They're lead-free. The problem is they create what are called tin whiskers, which are little outgrowths that come 90 degrees outside of the solder joint. What they end up doing is shorting two different solder joints and destroying your circuit board. One of the technical fellows here asked, what do I want solder to be made out of? He came up with copper. Everything else in the circuit board's copper. But also copper is the ideal conductor. It has better electrical and thermal conductivity. So this leads to the ability to make new designs to have fewer heat sinks. So what we have here is the nanocopper paste. This is what would be the drop-in replacement for solder, although we have many other cool uses for it. So I'm just going to put a little on your finger. If you spread it around and buff it a little, you'll see it maintains its shininess. It looks just like copper, and it's spreadable like toothpaste.
How long does it take to make this little bit?
Our lab scale process is about 4 days.
And how
in
much
terms
would
of
that yield?
the kilogram. So the other applications involve additive manufacturing, printing electronics and antennas specifically. We've done work making flexible substrate, and if you look at it, the chip right there, the connections to it, were printed with nano copper, because obviously regular solder is not ideal for flexible applications. Once the nano copper technology matured enough that we started looking for business opportunities, Lockheed Martin decided it would be best to help start up a second company, which is called Cuprion, and they handle all of the consumer, the non-space, non-defense marketing of the nano copper material.
We are at the Advanced Technology Center in Palo Alto, California, and this is my graphene workshop. Graphene is carbon, where the carbon atoms have arranged themselves into a two-dimensional plane. So you have a sheet of carbon atoms that's only 1 atom thick. It's basically atomic scale chicken wire. One of the quips about graphene is that it doesn't exist beyond an academic laboratory. It's not a real-world material yet, and we're trying to change that. We're trying to take graphene out of the laboratory and actually make real materials and real articles out of it. The amazing thing about the graphene, the reason it is the world's most efficient membrane, is that you can take this stuff, make it impermeable with the graphene, and then recover almost all of the permeability by putting those nanopores in. As we mature the technology, we can pivot and say, hey, look, we figured out how to make these nanomembranes. Along the way, we now know how to handle graphene. We can make chips and things like that. So here's an example. In the middle there's a little silicon chip.
Sure.
The graphene film is now your conductive surface instead of layers and layers of copper and things like that that you would normally make.
Lockheed Martin is one of the largest aerospace corporations, building satellites completely from the ground up for NASA or the military or the commercial industry, and Lockheed's been a huge player in that for many, many decades now. We do all this research for new satellites that Lockheed is building and moving forward in the industry. What we do is we expose new materials that people are developing to all the different environments that they would experience on orbit and make sure that they can survive the rigors of space. This is really our charging chamber, so we use it to charge up the surface, kind of like shuffling across the ground in socks. This actually gets the same charge as that, which can be upwards of 20,000 volts at times, which is always fairly exciting. If you make a material here on the ground and then send it up and it fails on orbit, you can't get these satellites back. You need to make sure it can survive on the ground before you can launch it up into space. See, the big solar simulator's in the way right now, so I'll scoot it over. Here, so the other system was really our charging system. This is more of our radiation system. This system, we have a 100,000 volt electron accelerator. 100,000 volt electrons are about moving around 60% the speed of light. But the really thing that sets this chamber apart is everything from here in the center back. That's all our linear particle accelerator. So we accelerate protons upwards like 2% the speed of light. So this is the only facility of its kind here at Lockheed, and one of very few that are actually used for this type of radiation simulation in the entire world.
We've really found that there are many opportunities for this type of material to be morphed a little bit into other uses. It smells disgusting. Do you want to take your gloves off?
I had this fun idea to make a video called Real Dog versus Robot Dog, where Henry and Iva would go head-to-head doing tricks like bark, high five, and play dead. But Iva arrived when I was simultaneously battling a cold and dog-sitting for my best friend. Since I only had 2 days with Ivo, I didn't have enough time to teach him tricks, so I decided instead to give him free rein to explore the apartment and to interact with the other dogs. I also treated him like he was a real dog. Good boy, Ivo. The dogs were curious at first, and they weren't quite sure what to make of Ivo. But shortly afterwards had zero interest despite his numerous attempts to interact with them. If this were elementary school, Ivo would be the smelly new kid no one wanted to play with. First of all, as expected, Aibo is incredibly cute and expressive. His eyes don't flicker in real life. My iPhone camera just sucks. Like Henry, Aibo is a total weirdo and does weirdo dog stuff. Like pretending to swim. He's super clumsy and he falls down a lot. But he'll get up by himself even when you tip him over. Aibo, get up. He also gets stuck sometimes. Go get your ball. Sony said each Aibo had his own personality, and this one was a defiant little one who only obeyed commands half of the time. He was also kind of needy and kept trying to get my attention, but unlike a real dog, I can just turn him off or tell him to go to his charging station. Aibo? I know his OLED eyeballs were meant to be expressive and to help mimic a puppy's endearing personality, but they're also a bit creepy sometimes, especially when he does that side eye or when his pupils dilate. I caught him barking at the wall. That was disconcerting. Bang, bang! Aibo can do a bunch of tricks, but he's so slow. So slow. He's impressive for a robot companion dog, but at $2,900 I kinda wish he had additional features, like maybe fur so you can cuddle with him, or a fart function, you know, so that you can blame your farts on Aibo. Sony plans to roll out a security package in Japan that uses Aibo's onboard sensors to keep your home safe. I'm not really sure what that means, but if Aibo's eyeballs could be used as cameras to stream video footage onto your smartphone while you're not at home and alert you when someone's there, that'd be pretty dope. This version, however, is available now.
For me, there was a space in the market that was missing, and it had to do with a really thoughtful, intelligent combination of both the premium technical construction that you tend to see in the outdoors industry, in the sports performance industry, and combined with that sort of metropolitan urban design sensibility. Here we are at Black Ember HQ, which, as you guys know, is sort of hidden in the bowels of a big warehouse that you kind of have to get through. We kind of like that. It's a little bit secretive. It's a little bit stealthy, which is sort of aligned to our brand as well. What happens here is that this is where we spend a ton of time focused on designing and developing products. The two kind of major workflows that happen here are, one, concepting, designing, developing products, which of course also involves a lot of travel to our factory base in Asia. And the other thing is really about that maintaining that connection to our customer. And it's really as simple as that.
Kickstarter at this point is a part of our DNA. I think the statistics are something like 12% of creators come back for a second project, and only 1% create 5 or more projects. And we've created 5, and I think we're going on to our 6th. For us, there are not a lot of reasons not to use Kickstarter. They're equal parts of market research, finance, and marketing. So on the market research side, we launched the first Black Ember modular bag on Kickstarter in 2014. And in 30 days, that raised $300,000. And after the campaign closed, we received an equal number of backer requests in the following month.
This is a new pack we're developing, actually, and it's codenamed the 3. So looking at this one on the inside, for instance, and just opening up, you can see that on the inside of the pack, it's completely unfinished. And we've done that purposely because we want to start by focusing on some of those key dimensions of the bag, key usefulness, that sort of thing. We have a pretty good idea for a pack like this, what consumers are going to want in terms of organization and that sort of thing internally. So that can come later after we get a feel for what this bag is like to use and carry on the outside, and then work our way inside as we develop through this program.
We don't go to a Kickstarter to put up a project with an abstract concept. When we launch a Kickstarter product, it's ready to go. So not only are we ready to push the button to launch the project itself, at the same time, we're also ready to push the production button. And this is how all Kickstarters should run. It's interesting in this day and age with the technology available to us that you can run a startup very lean and very mean. You don't need many people. You know, our core competencies here at Black Ember are design, development, and marketing, creativity, innovation. So we really focus on those activities, and the rest we outsource. So it really allows us to focus on activities like marketing and Instagram and social, which are so important for us. And for our brand, from the beginning, when we began running social ads, they converted. And it's been great for us. And I think that's the trend we're seeing as we're continuing to move forward into brands being able to directly speak to the consumer themselves.
So what is laid out here before me is actually the WPRT in its form, all flat laid out as it would be laser cut, bar tacked, bonded, all the elements that go into it right before the final process of bringing it together. So the first WPRT that I want to talk about is the minimal pack. From Fidlock, the V-buckle. This is a great magnetic buckle. You can see it instantly automatically attaches, and one pull it comes right off. It also unfolds, and then there's a secondary zipper. We have several waterproof zippers on the outside. One here, and then over here on this side, and then finally, there is also a dedicated laptop compartment as well. Now I want to move to the modular version. There's what we call a Hypalon load panel on the front. There is a combination of a mechanical lock as well as the magnetic lock. And so what I can do is rotate that mechanical lock off and pull up, and there it is. And so now I've removed both mechanisms, both the mechanical lock as well as the magnetic lock. This is also a minimal WPRT, but the difference here is this is our new black grid camo. We weren't really happy with the sort of number of stock camos that you see out there, mostly because they tend to be a little too bold. All of our textiles are specially prepared so that they can be effectively bonded as well as welded. And so this combines the best of both of those elements in this black camo WPRT.
We're a small startup, and we're a small self-funded startup, which is a really beautiful thing. We're really able to foster an environment of creativity and innovation here. Most of the products we make are cutting-edge products. And there's an inherent risk in that, and there's no one telling us to play it safe.
Hey Chris, navigate to disrupt.
I found several routes to disrupt. Would you like to take this route? This one is via Angel Stress and will take 7 minutes. Do you want to take this route?
Yes. Chris is the world's first digital co-driver for every car. So actually it's a digital assistant as a retrofit kit for cars. We developed this beautiful piece of hardware that is supported by an app that you download to your phone, Android, iOS, and that in combination gives this very unique experience. We expect that most people use it, first of all, for messaging in the car, and then we will see navigation and other use cases covered very well. Hey Chris, send a message to Daniel.
I found several contacts with the name Daniel. Do you want to send a message to Daniel Lewis? Daniel means?
Yes.
Okay, what do you want to say?
Hi Daniel, we'll be late by 10, calling you from there.
All right, sending Daniel will be late by 10, calling you from there. To Daniel reads his mobile number. To stop or edit the message, please say stop or cancel.
We really only have 3 gestures. It's far narrow, it's left, right, and it's high five, and people get it very easily. Clay Gorillas.
Cool.
User privacy and data privacy and protection, that's something that is extremely important from our side. We set the product and the platform in a way that it's completely anonymized, so all the voice data, etc., that we use to automatically train the language models, etc., cannot be linked to any single user. Anything else is permission-based. I mean, of course, if I want my assistant to learn how I behave, I have to share some data. So Chris absolutely is the start of what we're doing, what German Auto Labs is doing. It's something that comes with a very low entry barrier. It solves the immediate problem. But what we develop behind is actually a co-driver AI, which goes way beyond just talking to you. It understands your behavior. But as it is with AI, you need to train it and you need to iterate fast. So we decided to go to the aftermarket where we have a lot of cars, consumers around, to start the product, go smaller steps, iterating fast and training the AI. Chris is actually today available on our website, chris.com, and it costs 299 euros US dollars.
The DARPA Challenge is a new challenge that they've put out. We're one of about a dozen competitors in the program. So we're looking at underground terrains, one being a mine, which we are here at the Torred Mine in Pennsylvania. The robots are also going to be going into an urban environment, like a subway station or some underground terrain in a city. And then eventually we'll be exploring caves.
So what are the end applications for these robots?
The end application is mostly search and rescue. We've all heard stories around the world of miners being trapped. Sometimes it takes days, and sometimes it's too dangerous to send humans into that environment. Our system consists of ground robots that will be able to track and follow the terrain until it gets to a point where it may see various spurs going off, perhaps some levels above or levels below. And we also have an unmanned aerial vehicle consisting of a hexacopter arrangement. The drone element gives us access to places that the ground robot can't go. We may encounter staircases that could be blocked with debris. And the challenge is to be able to get through a 1 meter by 1 meter opening. The instruments that the drones are carrying are stereo cameras, real-sense cameras. Those provide three-dimensional space information back to us, photographic information. We're also carrying Velodyne LiDAR systems that can map three-dimensionally the areas that the robots are nearby. And those maps can be fed back to the base station so that the base station user gets a real-time map display and is able to send commands to the robot if it needs to either change course, to launch the drone. For the most part, we don't know what we're going to see. So we need those instruments to be able to do that, as well as to locate artifacts, humans, and other things that may help us once we're inside the mine. Both of the drone systems, the ground robot and the flying drone, are completely autonomous. They have an intelligent autonomy mode where they use the feedback from the sensors, from the LiDAR, from the cameras to stay on a track and a heading that keeps them from running into things. The idea of having smart robots, intelligent systems that can go in there unmanned, collect information about what's inside, provide that information to the rescuers, and give them options for proceeding with the rescue is a big advantage, and it could save lots of lives.
Scale Robotics is digitizing construction through the introduction of autonomous mobile robots, which are automatically doing progress monitoring for construction.
So let's break that down a little bit. What is progress monitoring? Exactly, literally, what do the robots do? How do they work in the construction site?
Our mobile robots are moving around and they're fusing multiple sources of information to build these maps of the world. So it's not quite as simple as just traditional laser scanning. We're adding a lot more extra information such as images, video, and also the data that the robot's producing inside.
So it's sort of like we compare to the Google cars that go around, mapping the world. You've built a sort of very dedicated version of that to work inside construction sites.
I mean, that's pretty much it. We're leveraging a lot of the technology that came from developing autonomous vehicles, but we're taking that technology and we're really refining it specifically for the construction industry.
And in terms of the data that you're capturing, the high resolution, granular, very sort of detailed data, there's literally no way that that would ever be a kind of a human job to do that. You'd need an army of humans to try to do that. So you're not replacing a specific kind of job role really with this sort of technology.
To give you a perspective of how a construction site recently was solving one of these problems, they wanted to know if all the ducts in the ceiling were above 2 meters. So they took a 2-meter stick and they just walked around to see if they would bump into things at 2 meters. So it's just impossible for a human being to do this without a tool. And people have developed tools to be able to solve this problem, like laser measures or tape measures or rulers, but you just can't do that for like 100,000 elements in a building. It's just not scalable or possible. So you need tools like this to solve that problem.
Now, your background is in architecture to a degree. I believe you worked designing buildings yourself.
Yes.
So talk us through how you came up with the idea for this business. You presumably identified this was a problem. So talk us through that process.
Essentially, it was really born out of this frustration of not having the tools to be able to actually build what we designed in the office. And this was something that kind of was born out of some
now. Eargo sells directly to consumer. So as opposed to selling via clinics, Eargo advertises and is basically presented digitally or online. There's not a distribution in the middle of it, meaning that we can actually offer products at a lower price and also have a much more seamless experience from product to wearing to rehabilitating your hearing and so on. So traditionally, you would need to book an appointment, wait a couple of weeks, you would get in, you would have your hearing assessed, and then you would sort of get into the whole counseling on what kind of solutions exist, how do you get it. You don't need a prescription per se. You'd be presented with a range of options and a strong recommendation from the professional. and then offer to buy it. The challenge in America is that it's an investment. There's no reimbursement for hearing aids. The average price point in the market is around $4,700 for a pair. That's the traditional process. There's a perfect solution out here for you, where you can actually improve your hearing. You don't have to go through the hassles of setting appointments, being tested. You can actually transact online. You will get your hearing aids, and you can literally try it on. Typically 2 to 3 days after receipt of the product for an onboarding or welcome call to make sure that we can address all the questions. Am I putting it in the right way? How do I change my programs? Any kind of issue that might arise, we want to make sure we tackle them head on up front. Our very first product, Eargo Plus, Eargo Max, and now also Eargo Neo, are all FDA approved.
So the Eargo Plus hearing aid and Eargo Max hearing aid look like this. And you see what I was talking about earlier in terms of the genesis of the design, which is really this flexi fiber tip, right? It's the medical grade silicone. And you can see that the miniaturization is really about taking the electronics and essentially shrink wrapping it with a small plastic shell. And most importantly, when inserted in your ear, it essentially completely disappears. Neo product, which is our latest product offering, you'll note a few design changes. So a lot cleaner look in terms of the charger design, the charger pockets, taking feedback from our end users. Right, we redesigned these pockets so it's virtually impossible to get them in incorrectly. And then finally, the hearing aid itself has gone through quite a few changes. What you'll notice immediately is a much more organic, smaller form factor. So we've moved the microphone to the back of the hearing aid, and then we have stainless steel contacts that are flush with the surface, in contrast to the first generation, where the gold contacts are recessed a little bit, right? So, and the design intent here was really threefold: improving retention in the ear canal, improving comfort, and improving the acoustical performance, right? So by moving to a palm design rather than the FlexiFiber design, we were able to achieve all three of those in one design. So you get a little bit more gain in the overall system, so we can fit more people with this device, and it in fact is more comfortable and better retention.
We offer products anywhere from $1,650 to $2,750. So it's still an investment. It's lower than the price of the market, but it gives people that, opportunity to really try hearing. What we really wanted to do is, you can almost call it democratize hearing. How do we make it accessible and get away from the medical environment, saying this is something about improving you and you taking action.
Ladies and gentlemen, please take your seats. The program will begin in 5 minutes. Ladies and gentlemen, please silence all mobile devices. The program is about to begin. Ladies and gentlemen, please take your seats. The program is about to begin.
Launch Disrupt.
Ladies and gentlemen, please welcome TechCrunch senior writer and your Battlefield host, Anthony Ha.
Welcome to the first round of the Startup Battlefield. So raise your hand if this is the first time you've ever been to a Startup Battlefield session. Excellent. So I'm going to tell you everything you need to know right now. So what happens at Startup Battlefield is hundreds of startups from around the world apply to participate. Our Startup Battlefield team, some of the folks sitting right over there at TechCrunch, they help narrow it down. We've chosen 18 startups plus 2 wildcards who are going to be presenting over the next 2 days. Each of them is going to present for 6 minutes, and then they're going to answer 6 minutes of Q&A from the judges. Now, these startups have been rehearsing for months. They're super prepared, but there's always an element of unpredictability because there's a live demo. There's a whole bunch of laptops over there, and the judges get to ask anything they want. What that means is that they're going to be very nervous. Things could go wrong. So what I would really appreciate from you guys is just when things go really well or really badly, just show your support, be generous, be supportive, applaud when it makes sense. I'm not going to have you do that now. I'm going to have you save that energy. But when the time comes, I want you to be ready to have these startups feel like this is the greatest experience of their lives. When the session ends, the judges are going to go backstage, and they're going to help us choose some finalists. Those finalists are going to present on Friday, and then the judges then will help us choose a winner. Now, how we choose the winner or what we're looking for in a winner, there's a whole bunch of different factors that we're looking at, but fundamentally what we want is for these finalists and the winner to be the company that 2, 3, 5, 10 years from now is the one that you can tell everyone, oh my God, I saw when this company launched on stage. They'll also get $100,000 equity free. So I've now told you everything you need to know, which means it's time to bring out our judges. First up, we have Brian Hirsch, co-founder and managing partner at Tribeca Venture Partners. Before starting Tribeca in 2011, Brian was founder and managing director of Greenhill & Co., and he also has more than 20 years of experience in the venture business. Next, we have Maha Ibrahim, general partner at Canaan Partners. Since 2000, she has invested in a range of companies with a current focus areas in consumer technology, enterprise cloud, and marketplaces. Next, we have Yuri Kim, a partner at Forerunner Ventures. Since joining Forerunner in May 2012, Yuri has led and supported investments in more than 40 early-stage companies. Next, we have Michelle McCarthy, managing director at Verizon Ventures. She makes strategic investments for Verizon's venture capital group focused principally on the consumer space. And last but not least, we have Patricia Nakash, general partner at Trinity Ventures. She invests in early-stage consumer and business technology startups in sectors including the sharing economy, real estate, and food technology. So let's give it up for all of our awesome judges. And that means it is time to bring out our very first Battlefield startup. That startup is Traptic. Presenting for Traptic are Lewis Anderson and Vin Fan. Come on out.
Manual labor. 200 years ago, we picked wheat by hand. Every single stalk. A bunch of people out in the field with hand tools doing things manually. Then we invented combines. Machines harvest quickly, efficiently, and at enormous volume. But they lack the delicacy and the precision necessary to harvest most fruits and vegetables. So, people are still picking more than $200 billion worth of fruits and vegetables by hand each year. Why is this a problem? Take strawberry picking. 20% of the strawberries grown in the US rot in the fields because there's nobody available to pick them. Labor is also super expensive. It costs $15,000 per acre, or 25 cents per pound, just for manual labor for harvest. This labor is getting even more expensive and more scarce due to an aging workforce around the world, national political dynamics, and California labor law. Introducing Traptic. Traptic's giant farming robots pick strawberries. Our robots are saving the world's food production system by automating the work people don't want to do. Our robotic platform drives across the field, while our vision system detects berries and figures out how to reach them. Then our patented gripper delicately extracts the produce from the plant. So what does this look like? Switch to camera feed of machine. Let's switch to camera feed of machine. The system's cameras take a snapshot of the scene. Our vision system detects the strawberries in that image, decides which to pick, figures out the position of that berry, and determines the shape of the bed and plant around it. It then plans a path to grab it, and our software commands the robot arm to move the gripper to the berry. The gripper then lifts the berry off the field and closes around it firmly but gently. We then command the robot arm to yank the gripper away from the plant, and because we have a firm grasp on the berry, the stem pops off. We finish by depositing the berry on the conveyor. Just in case you thought this was a lab experiment, let's play the video. Our system does all this in real time while hanging off the back of a tractor and moving continuously over real strawberry fields. It is robust to dust, dirt, rain, wind, vibrations, and the other aspects of the tough farm environment. And it operates all day, every day, for months and years on end. Our gripper is totally unique and patented. This gripper must extract berries from a crowded environment, hold them at a certain angle to help bend the stem, apply a great deal of force to break the stem of the berry, and do all this while being very delicate. We grab the berries with soft, food-safe silicone belts that we mold around stiffer materials. These belts give the gripper mechanical compliance, which allows it to grab objects across a varying range of size and shape without needing any information about the object's properties. We close the fingers with a defined amount of force, allowing it to grab objects of different sizes without crushing or dropping them. This lets the same gripper grab produce across a large range of size and shape without needing any information about the object's properties, without any hardware changes or any information from software. Built on a robust data set, Traptic's robot is capable of finding berries and determining ripeness with equivalent accuracy as people. And finally, it does all this locally. No internet, no offsite compute. Industry standard machines are not designed for delicate produce. Conversely, some startups target low-value activities like weeding, only worth $1,000 to $2,000 per acre. Or they harvest fruits like apples, where they are only needed a few months per year. Traptic focuses on year-round strawberry harvest. Finally, we don't require any change in the growing process, providing a smooth path for deployment. Our master plan: get $3 billion in revenue by picking strawberries, $20 billion in revenue by picking the other fruits and vegetables, then go after $200 billion in crop value by automating and improving remaining activities. Robots as a service. We pick strawberries, and growers will pay us 23 cents per pound. This is slightly less than the current spend. We provide all aspects of the service: the machine, tractor, driver, etc. Traptic has developed testing partnerships over the last 3 years with the largest commercial growers, including Nature Ripe and Driscoll's, and we have done daily testing over the past 6 months. Traptic will deploy commercially next year. VinFan, Brian Retopper, and I built big, fixed-wing autonomous airplanes for an AUVSI university project. Then Vin and Brian went to work at UTC Aerospace Systems, and I went to work at Microsoft. After starting Traptic, We recruited from UC Berkeley, University of Michigan, SpaceX, GM, and Driscoll's. Our advisors are globally recognized industry pioneers. Serge Boulanger in computer vision, Nathan Doran in agriculture,
Wrap it up.
Peter Beal in robotics, along with many others. The future of robotics is outdoors. Join Traptic and help save the world's food production system.
All right, so we have strawberries for the judges.
Thank you. Thank you.
Does anyone want to maybe start asking a question while these are being distributed?
Can I eat first?
Sure. I can jump in.
We won't judge you for asking with your mouth full. Oh, I get something sweet.
I smear strawberry all over. So, Louis, so you talked about the cost of your robot relative to labor, manual labor. What about the speed? Like, how quickly can your robot harvest an acre, say, relative to manual labor?
Yeah, that's a great question. It's something we think about from two angles. So the first angle is what the growers care about. And they really care about the cost to harvest a pound of berries, which is very straightforward because we just decide how much we're going to charge with the service model. And they care about the quality of the berries. And we've recently had one of our customers do a detailed evaluation of the fruit we were picking, and they told us that the quality of fruit was equivalent to what humans were doing. So we know we're solid there. And then the other side is the side we care about, which is the economics of the machine. So one of our production machines will do as much work as about 20 people. And because we're also able to harvest and run the machine year-round, we actually get really great economics. And so we're going to be able to pay back the capital expense of the machine in around 7 months.
Okay. Thank you.
Are you doing the driving yourself because you need to have somebody staffed near the machine because it takes some level of expertise or because it requires regular servicing? Is that why you're doing the driving?
So we have a human driver in our machine, primarily because we don't need to automate it. So we have focused on the aspect of this. We have started with the aspect that provides the most value, which is being able to pick the strawberries. And we found that even with a human driver, the machine will be large enough and will have large enough scale that we can pay a human driver and still have really great economics. We really don't need to build that self-driving capability. And this allows us to get into market a lot sooner.
But why isn't the farmer driving? Why aren't you just renting the machine or giving or selling him or her the machine?
I see. Yeah, the reason that we want to provide all aspects of the service is to make it very much a turnkey solution. So the grower doesn't have to think about it. They don't have to train anyone. They don't have to think about how to run the service. We just provide everything. We say, we'll show up, we pick your strawberries, they pay us kind of the same way they've been doing already. It fits very nicely into their business. And the idea here is to provide a really smooth path for deployment.
And to that end, how do growers think about the CapEx that they've spent on their existing equipment, much of which I'm guessing is financed, or they might have long-term leases or whatnot? How do you think about the decision of throwing out all that CapEx spend and the existing equipment they might have that they're growing with and adopting a solution like this?
So the way they think about that, the important aspect, because we're running this as a service, of course, they don't have to pay a big CapEx up front. They're just paying kind of as they use it. And our system fits really nicely into their existing practices. So we don't require any change in growing process. So they don't have to throw away any of their machines. They don't have to change the way their strawberries are being grown or the shape of the beds or anything like that. We just say that you continue growing strawberries the same way you always have been. We add our machine to the field, and it fits really nicely into their business.
So you won't retrofit their existing tractor. It'll be used for excess capacity, or I guess what happens with the existing machinery?
So basically, they continue to use their existing tractors for the other activities that they need tractors for. So they're using tractors to till the field and to spray things on the plants and things like that. And they'll continue needing to do these things. And so they continue using their existing tractors for that. And then we just kind of add our machine to that field, and we're providing the tractor and the machine and everything, so they don't need to go out and get anything else.
What's your market entry plan? And are you already doing beta testing right now? Are you doing pilots? Are you working with specific growers yet?
Yeah, so we've been doing all of our testing over the past 3 years in commercial farms run by the largest growers in the world. So we've been spending a whole bunch of time in their field, including running every day over the past 6 months. We've been picking berries every day, running the machine all day. So we're working with the largest commercial growers of the last 3 years, and our commercial deployments will be most likely with one of them.
What percentage, I'm sorry, but what percentage of the market do those growers represent that you're currently working with or that you're in discussions with?
On the order of half the market.
Louis, you had a slide that was talking about the expansion of the technology from berries to strawberries specifically to other berries to other crops. What's involved in adjusting that system to expanding the products you can actually pick, and what's the general timeline of that technology advancement?
Yeah, that's a great question. So we're starting with a $3 billion strawberry market. And what we found is that because we started with one of the hardest crops that we could think of, the gripper that we developed for this actually works really well for a lot of other fruits and vegetables. And so we've tested with a whole bunch of different fruits and vegetables, and it works really well. So as we expand from strawberries to the other fruits and vegetables, we can reuse about 80% of our gripper technology. And we will also be able to retrain our vision system to detect other crops. So we're using maybe 75% of that tech from strawberries to other crops. And then we will also develop 2 new form factors of robotic platform. So we have our current machine that harvests stuff that's based on the ground, and we'll develop 2 more, so one for vines and one for tree fruit, which will even then share a lot of components, but basically have kind of 3 different machines. And that'll allow us to really easily expand from the $3 billion strawberry market out to the $20 billion of harvesting the other fruits and vegetables. And then even at that point, we will have machines running in all these different fields, all these different customers, and so we'll be able to do other things as well.
All right, give it up for Traptic. Great job kicking us off. So before we bring out the next company, I'll just remind the judges that you should eat some strawberries, although it's a little messy, so be careful. There's also a table behind you in case you don't want to carry it in your lap. Okay, let's bring out our second startup, Delos. Presenting for Delos are Kevin Stein and Shauna McIntyre.
Hi, everybody. This is Stan. Stan is 70 and built himself a retirement home outside of San Diego. Fortunately, his home didn't burn in the devastating 2017 and 2018 wildfires. However, his insurance company refused to renew his coverage, and the only other option that he could find charged him $24,000 a year with a $100,000 deductible. And Stan's not the only one. There's many articles that discuss many people that go through the exact same problem as Stan, hundreds of thousands throughout California. So why is this happening? Well, after the 2017 and 2018 wildfires, insurance companies came to realize that the third-party data models, the wildfire models that they were buying, were incredibly inaccurate. Because of this inaccuracy, they decided they simply can't write anywhere near wildfire areas because they don't know which homes are low risk and which homes are high risk. This creates a huge opportunity for a company that does understand that risk. Let's go ahead and take a look at a set of homes that burned in 2017 and 2018. And let's look at the model that most insurance companies buy, the industry-leading model. And let's see how that model rated the risk of these homes before they burned. As you can see, they incorrectly thought that these homes were at a low risk of burning. And again, all of these homes burned. Because of this, insurance companies simply decide that they'll stay away from anywhere near a wildfire region. They don't know which homes are going to burn, which homes are not. Delos takes advantage of this opportunity. We're launching a property insurance company that writes insurance specifically for low-risk homes within catastrophe regions. We're starting with wildfire, and we'll handle hurricane next. But the key is the fact that we have created our own proprietary wildfire models that vastly outperform the models that are available in the industry. We use this model to be able to understand what areas are low risk and offer insurance to homes that other insurance companies simply would stay away from. On top of this, our policy comes along with an active risk mitigation service. We reach out to every homeowner once a month, tell them exactly how their risk has changed and the top things they can change about their home to protect themselves from wildfire. Okay, let's go back and look at those homes that burned in 2017 and 2018. This time, let's see how the Delos wildfire model rated the wildfire risk of these homes. As you can see, we correctly predicted that these homes were likely to burn. We use this accuracy to understand which areas are less likely to burn, to go into those areas and build a profitable portfolio of homes. And we're not the only people that understand the value of our model. The rest of the insurance industry also sees that value. We've sold an analytics side product to 3 different insurance companies in California. Okay, how are we able to understand, to create a model that performs this well? Well, for that, let's look at our team. I'm Kevin. I have experience in aerospace management and a master's in aerospace engineering from Stanford. This here is Shanna. She's a physicist with experience in predictive modeling. David and Max are wildfire science professors, some of the top in the world. They have co-created the California Firefighting Department's wildfire model. Chow is a PhD in actuary. Paul ran home insurance at Mercury for 10 years. And Tom has sold over $1 billion of insurance in his lifetime. Let's take a look at our model. There's many different data input layers that go into our model. This includes temperature, wind, satellite imagery, a variety of micro prediction models. That includes a fire weather model, wildfire simulations, as well as a probabilistic ignition model. All of these are layers that go into an AI algorithm. That AI algorithm is trained on decades of fire history and outputs a fire risk map. That risk map tells us where to write insurance, but also how to price that insurance. Now let's go ahead and move to the demo. I'll show you how it works. So Shanna's going to pull up our website. This is where a homeowner or an independent agent will come to get a quote. Put in an address, then put in information about themselves and their home. Once they do that, they'll get this screen. We're working to get a quote to pop up on that screen. But let's look at what goes into creating that quote. Shanna's now going to pull up our map modeling software and show you the data input layers like the satellite imagery and the micro prediction models. Again, those go into an AI algorithm and output this. This is our wildfire risk map of California. Those 2 dots that you see there are addresses that have been put into the website. They immediately get imported in that table, as well as the information that's put into the website. And the risk score from the wildfire risk map is immediately appended. That goes to our actuarial model, and that actuarial model outputs a price that gets posted on the website. Back to the presentation. There are 36 million homes in America that are high risk for hurricane or wildfire. We see half of those as lower risk than the rest of the insurance community. That's the market created by our modeling. 18 million times 3,000 creates a $54 billion premium potential. We're launching as a managing general agent, or MGA. It's one of the standards in InsurTech used by Hippo, Metromile, and many others. The idea is the MGA writes the insurance carrier pays out the claims. We're selling through independent agents. We actually have 5 agencies that have invested in Delos. They have a combined book of $150 million in California. We are currently looking for insurance carrier and reinsurance company partnerships. If you are one of those companies, please come talk to us. Thank you.
All right, judges.
So is any of the data that you're ingesting into your algorithm proprietary?
Yes. So some of the data we're using is from government, but we have quite a few layers that are proprietary submodels that our team has been building over years. And so a lot of, those data sources, they include some simulations, et cetera, that we've done on our team.
Okay.
You mentioned there were 36 million homes at risk, whether it's fire, hurricane, and 18 million of them are lower risk where maybe they wouldn't have gotten insurance before, but you would be able to provide them insurance.
Exactly.
Ultimately, if there's a high-risk home, there's just no one who's going to insure that one, because at this point, you're really bifurcating the market to be able to show who isn't going to be getting insurance.
Yeah, there's plenty of homes we will say no to. There are homes that are too high risk, and it's not a good financial decision. We want to help people, right? The entire idea was we want to reduce loss through sharing information about people's risk. And for a lot of people, we'll be able to do that and provide an insurance policy. But you can't insure every home. That's just not smart.
That was going to be my question, is trying to understand the mission of the company. Is the mission to get more coverage for more homeowners, or is it to increase profitability for carriers? Because I have the same question, which is if you identify a low-risk house as high risk and a high-risk house is low risk, it's a shell game, right? You're just moving the risk from one house to another. Do you think it's net adds in terms of coverage, or is this really about higher profitability for carriers by sharper underwriting?
It's a great question. Yeah, the fact that we are able to produce a profitable portfolio sort of shows the advantage of our model. But the reason why we got into this, so Shanna and I started this company originally to reduce wildfire losses. And we found that the only way to create a large profitable company that gets enough revenue to sort of continually turn the wheel of innovation and understanding of wildfire. Wildfire's changing, right? And so you have to constantly update models, understand the new peril. We wanted to be able to take these large models and explain to each individual what they can do to protect themselves, right? When a climate scientist says the atmosphere is warming 2 degrees, what does that mean to you when you leave your home every morning? We wanted to be able to take this data that we were gathering and use it to impact each individual. For people that live in wildfire areas, we are giving them the information to be able to protect themselves. And there are homes that are too high of risk, but we're going to ensure the ones that we see are lower risk to be able to create the company we need, and then give them this active risk mitigation service so they can, as a population, slowly move homes towards wildfire hardened in California and in the rest of the United States.
So I have 2 questions. They're somewhat related.
Yep.
Can you talk about the competitive environment? And 2, in not making this data public, do you feel like you have a moral dilemma? And this kind of goes to Brian's point. Do you want to educate people on where they're living and what the risks are?
But the moral dilemma question is something that we've talked a lot about internally. We're very close to CAL FIRE, the firefighting department, and so we've had a lot of conversations about that. Since I'm on that, I'll just address that quickly. Our professors have worked in NGOs and civil governments for their entire careers as academics. And while it's a very noble effort, they've created amazing technology in order to really have the resources to be able to change people's homes, help them with things. Being private in some way is necessary. However, we have a close relationship with CAL FIRE, and we have been in a lot of discussions about new construction in wildfire areas that we can participate back by showing them exactly the best way to construct their homes, and then we'll have an opportunity to ensure these homes that were built in the correct way. So it's an advantage for both of us. The competitive environment. So after these 2 years, almost every insurance company really did pull out. There's a few non-admitted carriers that do right. The average premium currently for a non-admitted policy is $8,000 per home. The average in California is $1,000 for non-high-risk homes. And so those are very sort of old school, been around for a century type of companies that write all types of high risk. We are taking advantage of new data, new technology to be able to really focus on wildfire and hurricane. We have some hurricane models that we've already gotten under works to be able to understand that specific peril and make it a profitable portfolio in that area.
We have time for like a really quick question if anyone has one. We good? All right, give it up for Delos.
Thanks, guys.
And that means it is time to bring out our next Battlefield startup. That startup is SendMe. Presenting for SendMe are Paul Proctor and Jeff Tidd.
Are you going for Q&A? Yeah. Okay.
Previous slide, please. So for years now, my wife and I have been sending money abroad. My wife came to the United States when she was just 1 year old, and so a lot of our family lives internationally. We've experienced every problem imaginable as it relates to sending money. Lost funds, delayed delivery of funds, high cost, low transparency. We've been part of this $600 billion a year problem, along with 232 million people that have family living around the world. We have solved for this problem. Many cases, people will get a paper check, drive all over town, and give up 10% of their money before money gets home to mom. Today, we launch SendMe, a mobile app that allows for serving a non-consumption market. SendMe is a global flex-pay solution that integrates with an employer's payroll system and allows employees to send payroll funds cross-border, top up mobile phones, and pay international bills. With each 1% reduction in the cost of international transfers, $6 billion goes into the hands of recipients. What we've created is a solution that is high transparency, lower cost. We charge as little as $1, where our competitors are charging $5, $15 and up, and a much more efficient process. So let me show you how this works. Cue demo, please. So you'll notice here that I've authenticated to my employee account, and I did that via dual-factor authentication. At the top of the screen, you'll notice an account balance. Now, that balance is held at a financial institution and is FDIC insured, which puts employers at ease. Each pay period, a portion of my income flows over into this wallet and allows me to send funds abroad. So I'm going to go ahead and send funds to Juan Rodriguez Moreno, who is our employee of SendMe, also sitting out of Monterrey, Mexico. He has a bank account at Banorte. We have built a direct connection to the Central Bank of Mexico, which allows us to do an instant transfer to Mexican bank accounts. So I'm going to go ahead and send $53 to Juan, which equates to 1,010 pesos and 18 centavos. Now, I'm only going to be charged $1, which is only 20% of the industry average for sending funds abroad. When we hit send, you'll notice a little spinner pop up in the bottom right-hand corner. Once that completes, the funds are sitting in Mexico. So let's go ahead and rope in Juan, who's sitting in Mexico right now via video conference, to verify that he's received the funds. Hey, Juan, how are you?
Hey, Paul, fine. You?
Doing great. Hey, we're here at TechCrunch Battlefield in San Francisco, and I just sent you some money. I'd love for you to pop into your Banorte account and let us know what you've received.
Sure thing. I actually logged in ahead of time, and I'm refreshing my transactions list. You can see that I have a 1,010 pesos and 18 cents transfer from Paul Proctor at 3:32 p.m.
Central Time.
Central
It's
Time.
just that easy, folks. So, back to the presentation. We allow for, thank you. We can also send funds to a network of over 10,000 BBVA ATMs in Mexico. With a 16-digit code, a recipient can show up at an ATM and retrieve funds. Now, it's important to note that there's virtually no interoperability between banking networks. We're creating that interoperability by building partnerships. We've partnered with the Central Bank of the United States. We have a direct connection to the Central Bank of Mexico, and we're working on additional connections. What we're doing is creating a new category. We combine payroll with money service business, and in so doing, shift user behavior, reduce regulatory costs, and reduce customer acquisition costs. We tap into the $33 billion that's traveling between the US and Mexico as our beachhead market, but this is easily extensible to the $134 billion market that's outbound from the United States. And that's just the beginning. We charge between $1 and $4 up front and 2% in foreign exchange, but ultimately, we're driving the cost of the international transfer to zero. We offer value-added services like cross-border bill pay and phone top-up services, insurance services, so that gets reduced to nothing. We also shift the payer from the employee to the employer. We distribute the products through banks, payroll providers, and direct to employers. And we're currently in active conversations with some of the industry's leading players in these verticals. Now, I've lived in Mexico. I've lived in Argentina. I have a rich history in financial services, a couple founder experiences, and an exit. My co-founder, Paul Ahlstrom, is a serial entrepreneur. He started the first tech fund in Mexico and has had multiple exits. Every single member of our team have deep experience with this particular problem, and we're the team to solve for it. So, employers, diversify your benefits offering by partnering with SendMe. Employees, demand that your employers participate with us and save money. And banks and payroll companies,
partner with us to bring global flexible payroll to the world. Thank you.
Judges, who's got the first question?
Who's the decision maker at the employer when you're trying to sell in and convince them to have SendMe as part of the HR solution?
So it's most typically the head of HR, but oftentimes we're talking to any of the C-suite, and that decision gets pushed down to head of HR, and then that's the decision maker.
And are there any usual sort of hurdles that they have concerns about? Anything that would cause them to feel?
You know, the
there's a risk?
fascinating part is that we're early, but we have gone out, and as we've sold this product, when we get to a decision maker, we have a 100% hit rate. The most tepid response that we've gotten was from a plastics company, and they said, hey, come show up, spend some time at our facilities on a Saturday, and if you can sign people up, then you can offer it with us.
Yeah, he said, I don't think anybody's going to want this, but they might once you come present to us. And so we're really the only group that's ever approached them with this new payroll benefit.
So the value proposition to the employer is a retention, or how are you thinking about proposing
exactly.
it to them?
Employee retention, it provides an opportunity for the employees that are cashing a paycheck, leaving work, sending money home to actually save a little time, but it also gives them a little pay raise, but it also brings them inside the financial system. So there's no reason for their paycheck to leave the financial system, leave it inside, and it becomes a financial inclusion product that provides other benefits to that individual.
How did you acquire the deals with the U.S. Fed and the Central Bank of Mexico, and is that a moat?
Years of pain.
It is absolutely a moat, by the way. I mean, there's a spectacular amount of work that has gone into kind of what we've created here. People don't understand how difficult it is to do that.
Could you talk a little more about why that is so difficult or
Well,
unique?
we started by using the existing financial rails, saying, well, let's just use cross-border ACH to send money. On our first test, the money didn't actually make it to the recipient, and there's nobody to call. And so cross-border payments is actually a very, very difficult area, and it's expensive. So the U.S. financial system is not connected to the Mexican financial system, so we're the glue that puts them together. And so we had to build an API connection into the Central Bank of Mexico. We have an access to a Fed line in the United States. And so we take those services so we can move money around the United States and we can move money around Mexico, and we're the glue that creates the digital wallet. So all of the money goes into an omnibus account for the individual, all the employees, and we manage the sub-accounts and we can move it around cross-border.
How are you building and managing and prioritizing your sales funnel into the employers? How are you, what's your first target set for employers to getting this into their payroll?
Well, so if you think about what we're doing here, we're attempting to bring clean funds into the system. And the reason we tap into payroll is that instead of just taking money off the street, we're building a natural barrier and saying, well, we know exactly where these funds are coming from. They're coming from Marriott Corporation, or they're coming from somebody else. And so we go to the top end of the market, because the top end of the market makes the most sense to make sure that that integral system stays intact, and then we move downstream from there. So to answer your question, it's the Fortune 1000 that have various thousands of employees that are foreign nationals working for them.
And what's the size of your sales team, and what do you?
You're looking at it.
It's tough in 6 minutes to get a deep understanding of the business, but maybe this question could help frame it for me. How do you compare or contrast yourselves to Payoneer in New York, which has been focused on payroll solutions cross-border for, I guess, over a decade? Where do you start and they stop, or what's the differentiation?
Question. We're not cross-border payroll per se. You're paying an employee in an emerging market. You're paying a U.S. employee. And so you're now enabling that U.S. employee to then pay bills back home for their mom, send money home, send money to an ATM, get a loan. So you're putting that person inside the U.S. financial system, and as opposed to just being a pure payroll process.
Right. Okay.
Does that make sense?
Yeah. And some of the same use cases, though, out of country, some of the similar use cases, right? Payoneer is in your business, and maybe I'm not following that aspect, but.
Well, we're not paying people cross-border. They're actually in the United States.
In the United States,
yeah.
But okay.
But if,
maybe we'll talk
I'll
more
chat
about
afterwards.
offline.
But if I understand the solution correctly, the recipient has to have a bank account.
Well, so that's the interesting thing is, if somebody's getting a paper check, basically all we're saying is, hey, you can continue to get that paper check. We'll carve off a portion of it, direct it to the wallet, and then they can operate it there. And because we sit...
Oh, I'm sorry, I meant the cross-border recipient. At least in the demo you showed in Mexico, it was actually deposited into a Mexican bank account. And I guess I was trying to understand what % of the market in this global transfer market, which we know is enormous, the recipients actually have bank accounts.
Right.
Answer quickly.
So certainly for demo purposes, it makes more sense to show that we can send to a bank account.
Yeah.
The ATM network is a great way for Mexicans to be able to retrieve funds. Okay. And then we're in conversations with some major players that would allow us to get into the top markets around the world. So all of Latin America, Southeast Asia, et cetera, et cetera.
So our physical cash out, you can pick up money at an ATM. You don't have to have access to a bank account. You can pick up money at a pharmacy in Mexico. You can pick up, or you can pay your mom's bills directly. So the bank is just one of 4 mechanisms in terms of how we transfer value into emerging markets.
Got it.
All right, one more round of applause for Send Me.
All right.
All right, let's bring out our next startup, Render. Presenting for Render are Anurag Goel and Adrian Duong. Come on out.
Large public clouds like AWS are worth over $500 billion, but using them is like pulling teeth. Every year, businesses spend billions of dollars in engineering costs just to manage servers on AWS. I saw this firsthand at Stripe, which I helped launch and grow to a $5 billion company, but not without a massive DevOps team. After Stripe, I built a lot of apps to figure out what I was going to do next. Building these apps was easy, but hosting them was agonizing. I had to spin up VMs, install networking, set up SSL, and a ton of other things for every single app. It was tedious, it was error-prone, and it had to stop. This is how Render was born. Render is a completely automated cloud provider. Render lets you deploy anything from a simple static site to complex application clusters. And you can do it faster than on any other cloud and without managing servers at all. And Render fits into your existing workflow. Simply push your code to Git. We automate everything from there. This involves building and deploying your code, updating and securing the underlying software, scaling your apps, and automatically load balancing between them, and finally, alerting you to potential problems. Now, I realize I'm making a bold claim, so let's see this in action. You may have heard of Mattermost. It's like Slack, but for companies who want to host chat themselves. Now, typically, Mattermost requires a whole team of DevOps engineers to manage, but Render makes it effortless. All I need to do is to click the Deploy to Render button on this GitHub repo, which brings me to my Render dashboard listing all the services it's going to deploy. I click Approve, and that's it. Render is now deploying my Mattermost cluster, which includes a database, an object store, a search engine, and multiple web servers. Render is also provisioning SSL and load balancers behind the scenes, and I don't have to lift a finger for any of it. Now, these services can take a few minutes to spin up, and we have limited time, so we're going to switch over to an existing Mattermost instance on Render. Right now, it's running on rendermost.com, and you can all go there right now to sign up. It's ready to scale to thousands of users. Let's talk about what we just saw. Installing Mattermost on Render requires minutes, but it takes days of setup and constant ongoing maintenance on AWS. And it isn't even possible to do this on Heroku. But Render makes it instant through 3 major innovations that we're launching on stage today. 1, every render service gets built-in service discovery, private networking, and load balancing. 2, Render is the first fully managed cloud to offer SSDs with automatic backups and one-click restores. And 3, you can define all your render services in just one file. You can update your infrastructure by simply pushing this file to Git. How cool is that? Let's look at the competition. Clouds like AWS claim to be developer-friendly, but just ask any developer and they'll tell you just how frustrating they can be. On the other end, managed clouds like Heroku have stagnated under Salesforce and are missing essential features like SSDs and private networking. They're also much more expensive. Just 2 gigabytes of RAM costs $250 a month on Heroku, compared to $25 a month on Render. So we truly give you the best of both worlds. Amazing ease of use combined with tremendous flexibility. And we're doing it in a market that is massive and growing quickly. Right now, we're focused on the platform as a service market worth $20 billion. Longer term, we're targeting the entire cloud infrastructure as a service market worth $100 billion just 3 years from now. But let's talk real numbers. Render's revenue has grown by over 50% month over month for the last 6 months straight, and this growth has been entirely organic. We're now serving over 100 million HTTP requests every week. Leading open source projects like React, Vue, and Gatsby have all selected Render as an official hosting option. And we're also one of just 4 official cloud partners for GitLab. We have thousands of amazing users, including a leading presidential campaign that's using Render for all of their infrastructure. So if you're a developer or founder who's frustrated with AWS or Heroku, and you're looking to save big on engineering costs, automate your cloud hosting today by signing up on render.com. Thank you.
All right, judges.
At what point in a company's development does the automation start to fall apart and customization start to become more needed?
We have not found that point yet. And this is only possible now because of the advent of things like containers and Kubernetes. Because containers let you encapsulate not just your application, but all the dependencies along with your application. So back when Heroku was started in 2009, they didn't really have anything like this. And so Render's using the recent advances in technology just over the last 2 or 3 years to make things really easy for people who can containerize their apps.
So this is a giant market with very deep-pocketed competitors. What's your market entry point? I mean, where are you going to... I mean, right now, as described, it sounds like you can be all things to all people, but I'm sure that there's some segment for whom the pain point is just more extreme than others. And so what is that market entry point for you?
So we're not looking at giant enterprises right now. We don't want people who are running thousands of machines on AWS to switch to Render. That's not going to happen. Also, it's going to break everything for them, so they shouldn't. Our current market is developers and startups. And we're, in many ways, skating to where the puck is going because everyone else seems to have lost focus on this particular segment. And we're making it really, really easy for developers. Just like with Stripe, I worked with the team to make it really easy for developers early on to integrate payments. And what ends up happening when you do that is some of these startups end up becoming Airbnb and Snap and Dropbox, and that's how you get the large companies.
So you hope to scale. You hope to scale with some of your startups.
We will, yes.
Yeah. And to that end, what do you think the biggest challenges are going to be for you to scale?
For us to scale? I think that we need to be up at all times for our users and make sure that we're not moving fast and breaking things, right? That's not what you do when you're a hosting company. And so our biggest, not just challenge, but also something that we hold ourselves up to as a standard is making sure that our user workloads are always stable and reliable at all times.
So your competitors like AWS over the years or decade have built so many bells and whistles into their service. And I can go on AWS and I can go into their marketplaces and get their partners' products and services. Are you going to copy that effectively? And how do you provide the
We never want to
comprehensive-
copy AWS because the UX is just
Fair, but
yeah.
how do you provide all of the ancillary services that they've done?
So we actually have an add-ons marketplace. We launched it last week. And we're partnering with a company called Manifold that just started offering an add-ons as a service as a product. And so they're doing all the business partnerships, and we're integrating with them technologically. And we already have companies like LogDNA and Scout, or these are our first two add-on partners. And so we'll continue to build out more developer partnerships with tools like that, best-of-breed solutions, which might even include tools on AWS.
Yes, great, thank you.
I know you're early on, so this answer might be pretty quick, but how much churn have you seen, since you've launched in your customer base, and if there has been churn, what are the main ones?
There hasn't been. Like I said, I mean, so the thing that we're seeing is actually the opposite. So once you start using Render for just one service, you end up bringing all your services over. So that's what we saw with the presidential campaign that is using Render for everything. They started using it for one tiny service, and they're like, this is so much better than Google, which they were using earlier, and now they're using us for everything.
What are the initials of the presidential candidate using your product?
Say it again?
What are the initials of the presidential candidate using your product?
I'm not at liberty to say. But it will be public on October 15th because they have to file their financials, and Render is going to be part of that.
Other questions?
Can you just walk through for a typical customer what the ROI is, like how what they would typically spend on AWS or on Google Cloud versus using Render?
Sure. Render is not going to be cheaper than AWS or Google in terms of infrastructure costs, specifically servers, VMs, raw compute. But we're going to save you hundreds of thousands of dollars because you don't have to hire expensive DevOps engineers. And that's one of the biggest things that we're seeing across the market right now. DevOps engineers are the highest paid amongst all engineer segments in the market, and they're also really hard to find. Those things are related. So what we're saying is, look, you don't need to build out a large DevOps team. You don't need to hire some AWS consultant to set up all of this for you, and then they leave you, and then you're like, what am I going to do with this giant thing that has been set up? We're automating all of that away, so you don't have to deal with any of it. And that's where the biggest ROI is.
All right, one more round of applause for Render. Now let's bring out our final startup of the first round of the Startup Battlefield. That startup is Mutiny. Presenting for Mutiny are Jaleh Rezai and Nikhil Matthew.
Mutiny helps B2B companies personalize their website for each visitor in order to convert the 99% of their traffic that bounces today. For example, one of our customers, Amplitude, uses Mutiny to tailor their website's customer case studies and logos for every single visitor based on their industry. Someone coming from the consumer tech industry will see Twitter and Instacart, whereas a B2B company will see Cisco and Box. The result of this personalization is a 54% increase in leads because people want to know how their peers are using Amplitude. We founded Mutiny in just a little over a year ago, and already the fastest growing B2B unicorns such as Segment, Brex, Carta are using Mutiny to tailor their websites. Nikhil and I, my co-founder, built Mutiny after our own horrible experience trying to do personalization in-house. We were both early employees, and I led marketing at Gusto since the seed stage. And what we realized as we grew our customer base from 500 to 50,000 customers was that even though our product was a really great fit for a lot of different businesses, the same marketing message didn't necessarily resonate for everybody. But when we tried to tailor our message for everyone, we learned just how challenging that was. To personalize our website for each user, we needed to know who was coming to the website, prioritize between all of the different groups that were coming to the site, change their experience, and measure the impact so we could keep iterating. To do that, we needed lots of engineers, data scientists, UX designers, and analysts. The average marketing team does not have access to these technical expertise. And that's exactly why we built Mutiny, to solve all of these problems in one place with software. Mutiny identifies the visitors to a website via pre-built data integrations. It analyzes the website's traffic and conversion data to recommend the best audiences for personalization. It has a visual editor that lets any non-technical person change the experience of their website, and it has built-in analytics to measure the results so the company can keep iterating. Now let's take a look at how Haley from Carta uses Mutiny to optimize Carta.com. Switch to demo, please. Let's start with recommendations. Mutiny analyzes Carta.com and based on the visitors and their conversion data, makes a series of recommendations to keep Haley focused. The first recommendation is to personalize for seed stage companies because they convert at 51% lower than other segments on the website, despite having a really high conversion rate in Salesforce. Another recommendation here is to promote the referral program to existing customers. This is a great way to get more organic leads from an audience that today is completely untapped on the website. Let's click into the first recommendation. Here, Haley can see additional information about exactly why Mutiny has recommended this segment to her. She can see how to personalize different parts of her website based on the tips that we have provided, and even look at examples of how this segment has been personalized in the field. Let's click to actually change the experience for this group. You can see it's already pre-selected this segment as companies with 1 to 10 employees, which Haley can edit if she wants to. But we'll go ahead and click next to change their experience on the site. So here we're loading their site via our visual editor that lets them change any element of the site, whether it's text or CTA or images. Knowing that this particular group is new to equity, we're going to highlight Carta's ease of use, and we'll change the call to action from demo to something a little bit more hands-on, such as get started. And hit launch. And just like that, that segment will now see the personalized content on the site. Let's take a look at experiences that Haley had launched previously. We'll go into one specifically for venture capitalists that highlights Carta's new product for this audience. The numbers that you see here are from our analytics product. We don't show personalized content to everybody that's part of a segment, and we measure the difference in lift between personalized and generic. And as you can see here, this particular personalization has increased their conversion by 129%. Switch back to presentation. The results from Mutiny are incredible. 200% increase in outbound leads for Brax, 40% site-wide increase in leads for Amplitude. As a point of comparison, for most B2B companies, the most common channel is AdWords, and that channel typically generates less than 10% of their qualified leads. So there's virtually leads with less time and effort. So stop paying for leads, go to mutinyhq.com/disrupt, and learn how to convert the traffic that you already have. Thank you.
Okay, judges, who has questions?
So thank you for that. It was wonderful. Tell me why this isn't a one-time consultancy engagement, as opposed to something that is SaaSified and will live with me for years.
Yeah, so if you look at the market for personalization today, you kind of run into two types of personalization players. One is personalization is just a small feature of a larger platform, which doesn't really generate much results. And then there is personalization products that enable the plumbing of personalization, but they still require a ton of expertise and best practices to figure out how to actually get value out of it and operationalize it, which speaks to the point that you were bringing up. The thing that's different about Mutiny is that we're focused on the B2B market, and because of that focus on that homogeneous journey, we're able to build a product that's really easy to use, that has all of the data that B2B companies care about, and we're able to recommend personalization playbooks and best practices that is highly relevant to everybody in that industry. So that's how we're able to really simplify it and make it so that it's both easy to use, but it's also just a SaaS product.
Mm-hmm. Thank you.
It seems like a really interesting wedge into the market to have just a very clear place to capture ROI, capture more leads. Over time, you of course have to expand. So how do you see your platform offering more services, personalization, and other parts of the marketing funnel for B2B companies?
Yeah, our vision is to start with the web and then expand to personalize the entire buying experience for B2B companies. Web is a really great place to start because regardless of where that customer comes from, they're going to eventually end up on the website. It's also a great place from a data collection standpoint. But once we've built this visitor profile and the ability to make these recommendations, we can port the majority of that to additional channels, and it just makes the product stronger.
How does the marketing organization, how does your product play with other marketing automation and website optimization tools that many of your customers or prospective customers may already be using alongside that customer lifecycle or prospective customer lifecycle? How do you play with them? What do you integrate with? Are you expecting your customers to log into your system and other systems, or how are you thinking about that issue?
Yeah, absolutely. So we integrate with systems that can generate valuable data. And so, systems that already are collecting a lot of user information, we already integrate with a number of them, such as Salesforce and Segment. And as we expand, we'll integrate with more of them. A/B testing is a little bit different in the sense that they solve a slightly different problem, and you can kind of think of it as an older generation version of this type of personalization, where they're just showing an A and a B and trying to find the new baseline version, whereas we are dynamically identifying the audience and showing everybody exactly whatever is the best experience for them. Does that answer your question?
Yep.
Okay.
How much data do you need? How much traffic do you need to sort of observe in order to then come up with the appropriate segments? That's why I'm sort of going back to Maha's initial question about, feels like there's a consulting project that's needed up front to identify the segments, or you need to be monitoring traffic for a period of time to understand who's coming and what buckets they fall into. Just help us understand that a little bit.
Yeah, totally. So our ideal customers usually have above 20,000 unique visitors a month. So this is a sizable group to run a statistically significant test. And it usually takes us about 1 to 2 weeks from the time they implement our script on their website. So at that point in time, they can start deploying personalization, but we'll also start capturing the data about their website visitors. Once we get that 1 to 2 weeks of data, we have a representative group that we can start to then suggest the actionable places for them to begin.
So you're taking that traffic and then you're tagging it to sort of identify like size, industry, et cetera?
Exactly. So we'll integrate with third-party data sources, so things like reverse IP enrichment and acquisition campaigns that brought them to the website, and also the company's first-party data. So information about where that visitor is in their pipeline, we can get that from the CRM, and information from the sign-up form. All of that gets compiled into a single profile, and that's how we segment the audience and create the recommendations.
Final question?
What's your pricing? How are you pricing it?
We're a SaaS subscription service, and so we charge a price per month. Right now, we start at $1,500 per month, and we are looking to introduce a startup package this quarter as well.
Awesome. Give it up for Mutiny.
Thank you.
That ends the first session of the Startup Battlefield. The judges are going to follow me backstage. They're going to deliberate. They're going to help us choose some finalists. Before they do that, though, let's have one last round of applause for our awesome judges.
Using microservices in their architectures, more APIs are created across the organization. With this increase, it can become more challenging for developers to find these internal APIs and reuse them when they're developing new software. That's where Rapid API for Teams can help. Rapid API for Teams enables development teams to publish their internal APIs into a private workspace. Developers can find any internal API, view its documentation, test it, and connect directly, or collaborate and share information about the API right in Rapid API. Team members can also subscribe to any public API available on the Rapid API Marketplace, and the entire team can see and use that subscription. This way, you only pay once for any API your team uses. Rapid API for Teams makes it easier to share and collaborate on APIs. Get started today on rapidapi.com/teams.
Our teams love building companies that create value and make a difference. As well as our investments in companies such as Tencent and Mail.ru, we're building meaningful global businesses in online classifieds, food delivery, and payments and fintech.
Bob and the team have great experience in operating and investing in large companies in India, be it fintech, be it commerce.
Because they are global and they understand consumer business, they have a very helpful and specific advice that they can give to us.
They think like entrepreneurs. They're a fantastic partner.
Our big vision at Movely is to make life better for 1 billion people, and I believe Prosus is the perfect partner to help us achieve our dreams.
Why did you come to this workshop? To learn. But quickly I realized I started unlearning some things which I've been doing very incorrectly in the past and which didn't really give me the results that they're supposed to get.
I want to be where we ask questions like why? And the big question I ask is what if? You know, it's a different way of thinking at Stanford than it is at any other university in the world.
I realized I was getting stale, so I said, you know what, it's time for me to move on and look for greater things and have more impact.
At Lockheed Martin, we're on a mission. Your mission. When millions of people are counting on you, you can count on us. To build the impossible, to invent the inconceivable, and solve every problem with speed and reliability. Every mission is an expedition of the greatest importance, both to you and to us.
Ladies and gentlemen, please welcome back TechCrunch Managing Editor and Disrupt MC, Jordan Crook.
My overly enthusiastic crowd, it's lovely to see you again. Yeah, just nothing, just chirps. Okay. I just wanted to remind you guys that the Extra Crunch stage is very lively right now, and actually at 1:55, so I think it might have just started, we have a panel on how to hire at breakneck speed. I know that hiring, like founders start off and they build their products and they're like all into the product, and then suddenly you have to go to hiring like a bunch of people, and it's a completely different skill set. So if you want to hear more about that, please go check that out on the Extra Crunch stage right now. On the main stage, I'm about to bring out my boss and like my boss's boss, like all the way up. So I'm not going to make any more jokes. Please welcome to the stage CEO of Verizon Wireless, Hans Vestberg, and your moderator, Matthew Panzarino. Warm welcome, please.
Thank you.
Welcome, welcome.
Thank you.
Thanks for coming out amidst all adversity.
Yeah, some adversity is always good. Makes you stronger. Yeah, tough morning.
Let's see. Where should we start? Oh, okay. So I'm going to start at a place near and dear to my heart. Why does Verizon own TechCrunch?
I think that if you think about where this world is going with content, and Verizon pride ourselves to have the best network, but to be honest, what's on top of the network is all the content we're doing, and especially mobile. And I think that's where it fits in, the whole Verizon Media Group and what TechCrunch is doing, what Huffington Post is doing, what Yahoo Mail is doing, and all of that. That's over the top for us. And when I think about 5G, which I hope we will come to, it's a totally new way to actually communicate with the consumers when it comes to content. And having that in-house, I think is just amazing for us to learn. But not only that, I mean, if you think about the whole Verizon Media Group, AI, ML competences in a carrier company, that's very unique. I would say we are the only carrier, if you call us a carrier, in the world that has AI and ML in-house. And the network is going virtual. I mean, so we're virtualizing the network within all those type of forces and those great competences. So it makes sense for many reasons to have that inside in order to be even stronger for our consumers.
And so why is the media group such a good test bed for something like 5G?
I said 5G, if I can just pull back, I mean 5G, which when we talk about 5G, we think it's a 4G next step. It's not. 2G to 4G was based on two parameters. Speed and throughput improved tremendously in between them. You took your phone for doing SMS and voice, and then you can browse any type of online in 4G. 5G, when the start of the design on 5G, the thinking was, how do we transform enterprises and society wirelessly? That was the idea. Of course, there's going to be a lot of benefits for consumers. And 5G has 8 currencies, not 2. So throughputs and speeds are exponentially much faster. I mean, we see already right now on a smartphone 2-3 gig on a smartphone. A couple of years from now, it's going to be 10 gig on a phone easily. The throughput is enormous. The latency, which hasn't been that important on 4G, we're going to design down to 10 milliseconds. And today on the 4G network, I would say it's 80, 90, maybe 100 milliseconds.
Sure. And 10 milliseconds is like fast touch, right? Like that's as fast as
yeah, you can do things real time that you have never been able to do before. So, and then battery lifetime, only 1/10 of what we use today in 5G. But more important, there are also service provisioning, meaning doing slices of the network. If I should do a slice of our 4G network today, it would take us a couple of weeks if I do that for a customer, say, hey, I want my 4G network, and say, we should be down to 90 minutes to do slices of the network. The other thing that we always do is the speed and the mobility speed, meaning that we can capture a signal up to 500 kilometers per hour in 5G. And then you ask me, why do you need that? Yeah, you have drones, you have high-speed trains, which today we cannot sort of capture when we have a 4G signal. So all these 8 currencies are actually a totally new test bed and platform for doing new type of businesses. It's dramatically different from anything else you have seen from 4G. Still, it's going to be a lot of great things for consumers and all these currencies, but it's also going to be much wider, this impact. I see this as a leapfrog, a quantum leap compared to 4G.
And when you're talking about the 5G implementation of Verizon specifically, what's the difference in rollout in technology and implementation on the ground versus a competitor like AT&T?
I think that, first of all, you only build the 8 currencies if you have customers that are going to use them. So let's assume I'm in a European carrier only having consumers. I wouldn't build it as I build right now. We build fiber in over 60 cities today. We're going to have fiber to every radio base station because we're going to have so much data. We're basically going to build for all these 8 currencies with the throughput, speed, the low latency, and all of that. And so that's different from anybody else. I don't know what AT&T is doing, to be honest, or at least I cannot talk about it. So I think that's a big difference for us how we're going to build a network. And just so you understand, we have 4 business cases on the same infrastructure, which is important for this audience. Number 1, the cost per bit is going down with every technology.
Right.
That is the 3G to 4G as well. Then the mobility case, you're going to go around with a smartphone with 5G. We have launched 13 cities, 13 NFL stadiums, and the NBA season haven't even started. So that's the mobility case. We continue to broaden that. Then we have 5G home. We're actually going to, instead of having a fiber to the home, we have 5G from the edge to the home, and you can have the same experience. We have that in 4 cities today. We're going to have more later this year. And ultimately, the fourth business case is the 5G mobile edge compute. That's basically when you bring all these currencies, all these capabilities of 5G to the edge of the network. So you can have this throughput, which is enormous, and the speeds of the 10 gig, I'm not sure, could be even higher, as well as a latency down 10 milliseconds. And you started doing applications at the edge for consumers, for enterprises, and society at large.
On-device AI and ML that can transmit faster.
Absolutely.
Back
I
to
mean,
the base station.
if you want to load softwares on top of the mobile edge compute, like AI, etc., so you can do a lot of processing at the edge. That's a typical use case. How you would do it. I mean, think about the factory, for example, with robotics in it. Instead of having wires to everything, you basically do a 5G factory, and all the robots can be reconfigured in seconds, and you have milliseconds of latency to them. So suddenly, you need to rethink the whole way you have done your infrastructure from the beginning.
So when Verizon's doing rollout of 5G, as it's in the process of doing right now, one of the things I think is that's important to see when you look at the rollout of 3G and then 4G is how it often rolled out in areas that were, frankly, richer and whiter than a lot of other areas first, because they felt, oh, we have the customer base here, we can sell to these customers, we know that they'll be available. Is Verizon doing work to make sure, basically, that 5G technology is available on a unilateral basis versus a socioeconomic basis that tends to favor a certain group of people?
Absolutely. 2 of the cities of the 13 that we have launched so far, 2 of them are very rural. On Saturday evening, I announced together with Pharrell Williams that we're gonna put 5G in 100 schools the next 3 years. So we're really trying to bring out 5G in the most underserved markets as well, especially when it comes to sort of clusters of schools and things like that when 5G is. Remember also, we start to deploying our 5G on millimeter wave spectrum, which has an enormous throughput and speed, but of course not as wide for coverage.
Right.
We're going to use other spectrums for that. So clearly, we see any sort of place where it's a cluster of a lot of people, etc. That's the sweet spot for millimeter wave right now. But ultimately, any spectrum we would have would be a 5G spectrum, as any spectrum today is a 4G spectrum. It's just the maturity of the industry, the devices, whatever you are connecting to.
Okay. I actually have an interesting question about, so the industry at large is kind of doing, well, the tech industry, especially big tech, has this sort of navel-gazing thing going on as far as regulation goes. So as a CEO of a telecom company, one of the most regulated sectors in business, really, how do you feel about big tech getting more scrutiny from regulatory organizations?
I think that, first of all, I mean, technology is evolving extremely fast all the time. And to regulate it too much, you would also cap technology enormously. You need to find a balance about light touch and corporate responsibility. Because to be honest, one of the best technologies in the world is the mobility, broadband, and cloud. Any sustainable, scalable solution in the world right now to address the biggest challenges on earth we have, education, healthcare, inequalities. Then you have these 3 technologies, and they evolve fantastically. There's a lot of developers, platform delivers companies. So for me, it has to be light touch, because ultimate technology is moving so fast to regulate it today. When people are working on what's going to happen in 5 years, that balance. But ultimately, it also comes down to guys like me running big tech companies, that we are responsible also how this impacts society and having a wider responsibility than we have ever had before. So, and I think we're going to be judged on it as well. I mean, how well we do that. I mean, we have 120 million wireless consumers in this country. I mean, they're going to judge us if we do stupid things. So I think that balance is how it has to be struck. But I'm not a genius on doing regulation, etc. But I think that's because you don't want to hamper the technology evolution that is so important for this planet. I mean, I just came out from the UN week talking about all these 17 sustainable development goals, how we're going to achieve them in the whole world. And to be honest, if it's not technology is going to help them, I'm not sure how we're going to do it.
Right.
Technology has to be there.
And so would you vote for Elizabeth Warren even if she's very, very regulatory heavy?
So remember, I'm Swedish.
Sure.
Yeah, so I'm not voting in this country.
That's a great out. I did say would you, not are you, but you know, I get it.
You heard my answer.
Okay, so do you think that there's a validity to a company like Huawei being under so much scrutiny for the communications equipment it's providing the country? Do you think it's right to ban Huawei from selling communications equipment in the U.S.?
I don't have insights to that, so I cannot even answer on it. I think it's important in general. I think that 5G, 6G need to have a flourish sort of supply chain with many suppliers. That's going to be important. But one thing that I think that people underestimate when it comes to the telecom industry is that it's a reason why all your phones that you have in this room actually works in any country in the world. Because you share patents in the industry. The smartest patents. So when the 8 currencies was decided as this is a standard for 5G, all the tech companies in the telecom sector, they throw in, this is the best patent to solve it. And finally say, these are the patents we're going to use to build it. Now everyone can build. So if you're in the pharmaceutical industry, if you have a patent, the last thing you do is to share with your competitors. This industry, you share a competitor and then you build. And that's why this industry is so critically important. And that's why so many people on this earth actually have a phone in their hands. So that's important. You have many people actually working with it. So from that point of view.
Got it. I think that one of the things that the people in this audience especially are most interested in is, you know, I think you talk a lot about 5G for the enterprise and the opportunities down the line. But what are some of the near-term practical ways that you think 5G will actually benefit a very young company? Let's say a company under 100 people that's just getting off the ground. How are they best to prepare themselves for this and would utilize it?
I remember I got a lot of questions on stage when 4G was coming, you know, oh, what app's going to be on 4G? And I missed it totally how much would happen in this region of the world, how much innovation it was on top of 4G. I see that the 5G platform is even more open and having even more opportunities. So I think that what companies like we are doing, we have our test beds, we have 4 or 5 innovation centers across the country where you can actually elaborate with 5G already. We had our 5G challenge, where hundreds of companies coming up with ideas. The 5G mobile edge compute, we have said publicly, we're going to launch the first 5G mobile edge compute centers in Q4 this year. That means that then you're going to see even more opportunities to start to innovate on top of the 5G mobile edge compute. So I have to come back a little bit on exactly, but I think that you need to start thinking about how you can innovate for consumers, enterprise, society on that platform with those enormously capable currencies that we have in 5G.
To bring it back to the media thing, I mean, the approach of Verizon in the media business definitely seems to be more light touch than somebody like AT&T, who's going very heavy. They've obviously bought a broadcaster and that sort of thing. Why do you think that your approach is different?
I'm not sure my approach is different. This is our strategy. You build a strategy on what you think is the best assets of the company and the DNA of the company. Others might have other DNA and other assets, and they build on that. I think that the strength of Verizon is actually our network. I mean, our 3G network, 4G network has always been the best in the market. We're going to continue to have the best coverage and the best throughputs. And we think our customers, if they're enterprise customers, consumers, small and medium business customers, government, whoever, they actually are together with Verizon because we have the best network. That's why we have a network as a service model. We basically build one network now. We have redesigned the whole network topography in order to see that at the edge, we decide what type of access we're giving that customer. Some get 5G, some got 4G, some has a fiber, some might have even a copper. We just see that we're going to get optionality. That goes for our customer of broadband as well. We give them optionality. You can choose YouTube TV or you can choose Fios, whatever. We want to give optionality for our customer on a very strong base on the network.
And do you think, in 5 years, what do you think the business mix of Verizon looks like? Is 5G the pillar that you're resting on in 5 years?
External estimates says that by 2024, external, not Verizon's, that roughly 50% of the US population will have a 5G phone. So it just showed the same thing we saw between 3G and 4G. You need to keep 4G for a long, long time. And I think that we're going to see 4G continue to live for a long, long time, and we are continuing to invest heavily in the network of 4G as well. And so I think that we're going to see an incremental revenue over time, and we have said to the market that 2021 we will see some impacts from 5G home and 5G mobility, and 2022 from 5G mobile edge compute. That's what we have said to the market. So 4G will continue to be important. I mean, we invest 17 to 18 billion US dollar every year in network. That's how important we think the network is.
Mm-hmm. And with the millimeter wave technology that you're using, that investment has to go up, right, over the next couple of years?
Yeah, so remember, we started with millimeter wave 4 or 5 years ago. And to be honest, when you build a network, it's a lot of stuff that you need to invest in way before you come to the radio base station, which is one piece of it, but not all of it. So
sort of the part that people see.
Yeah, but the fiber investment that we've been ongoing for a while, we do 1,400 route miles of fiber every month right now in this country. And I don't think that anybody's even close to build as much fiber as Verizon is doing this moment. So there's a lot of other stuff that we're already doing that is embedded in actually the delivery of a 5G experience. You need all the way from the data center all the way out to the consumer or the enterprise receiving the 5G signal is a lot of investment. We can do basically all investment from the data center up to the access, and we're already doing them.
Mm-hmm. Well, it's not yet to my house, so I'll give you my address after this. Maybe we can fast track that. I'm pretty hungry for it.
Yeah, perfect.
Okay, excellent. So I think that the last question I have is what do you think the competitive advantages to somebody building a company now are in the next, let's call it 2 years, if they wanted to build out a particular feature set that you thought would benefit the most from 5G? Would it be a compute-heavy, localized service? Would it be sending large amounts of data? Like, what customers are going to benefit the most?
I think that if I would be thinking about it and having clean slate, I would think a lot about what you will have in the mobile edge compute, because you're going to have storage, compute in that, so you can actually rethink the whole idea that you need to have that either far up in the network, in the data centers, or in the device, whatever device. Sometimes we lock ourselves as a phone. There are so many other devices that is connected. So I think that will start rethinking how do you build a new, I mean, just assume video cameras, for example. At the cost of a video camera, they have a lot of compute and storage in the cameras today because of the latency and all of that. Just imagine you can take out that, you put it into the network instead. What can you do with it, and how can you change the perception? How can you do a service on that? That's where I really would like to think about it. But the good thing, there are thousands of people that are far more smarter than me that are going to see what they can transform. And as I said, I think 4G was just dramatic when it comes to innovation on the network. 5G is an even superior platform for innovation because it has so much more currencies that you can actually build a business on.
Excellent. Well, thank you very much, Hans. I appreciate it, sir. Thank you for coming.
Thank you.
Thank you all.
I need to come up here. Can you hurry, please? I'm fired now. Okay, up next on the Q&A stage, I know you guys are all like hustling to get out of here because we don't have anything exciting coming up next. But just in case you are, on the Q&A stage, we have winning investors with Pete Flint, Brian Hirsch, and Patricia Nakachi. That will be exciting. You guys know what's coming next, right? Yeah? If you can't get enthusiastic for what's coming next, then we are done for here. Can I get anything going here? Yes. Thank you. Thank you. Our next guests are Ang Lee and Will Smith, moderated by Anthony Ha. But before I bring them up, we're going to show you a little video. Enjoy, guys. Have fun.
Who are you? I don't want to shoot you.
Fine. Mind if I shoot you?
Has this ever happened to you before? Your own government trying to kill you?
Nah, that's new.
This is a movie that will expand filmmaking in the future. The way we shot it, the frame rate we're using, and we have a digital human being.
It's really the first time that the vision of the film was technologically able to be realized. You can take someone and you can have a 50-year-old version and a 23-year-old version, and it's photorealistic.
It's not just technology, we're still creating art.
Good work, everyone. Weta is at the forefront of digital humans, from Avatar to the realism and the emotion of Planet of the Apes. They've really been building on success. There's also a lot of new innovation and new development that the Weta team pulled together for Junior.
We are creating a digital human that not only does he look convincing and believable in a frame, but he also looks believable at 120 frames a second.
Our animation team is to really get to the bottom of like what makes the essence of a performance. What are the fine little nuances?
From breathing to little ticks in the face. We've got like a little heartbeat showing in his neck as well. We've taken to an extra level that we haven't done before on other shows.
What we put on the screen has to live up to every single drop of what Will Smith gave on set. You gotta get every single little vibration in his skin to convey that sense of emotion.
And of all the people in the world, why would he send you?
Because I'm the best. You are obviously not the best.
Technology allows the audience to engage in a theatrical experience in a new way.
Ang started to experiment with high frame rate 3D because he was searching for heightened experience for the viewer.
We're shooting in 3D plus, this evolutionary format where you can see so much more in a frame, really feel like you're there.
See detail in the fights and detail in the motion that would be buried in blur at a normal film format.
The look and feel tends to speak to the younger generation, and Ang is really pushing that technology in spectacular ways.
Guys, we brought Will Smith and Ang Lee to disrupt.
Yeah!
Hello.
Yeah! Woo! Yeah!
All right, a few people have their phones out. That's nice.
Yeah.
I think you're excited. So, I got a chance to see Gemini Man about 2 weeks ago. Ang was at the screening, and he described it as a leap of faith because of the technology. We're going to talk a little bit more about that technology in a second. But first, I just want to go back to that moment for each of you when you realized this is what you were going to do, that you were going to build a young Will Smith on a computer. How nervous were you?
Well, I was actually very excited. I just turned 51 last week. So I was excited by the prospect of having a digital character do my stunts. Because my back and my knees don't necessarily want to do the stuff that they used to want to do. So the idea of a creation, when Ang explained what he wanted to do, that it is the first ever digital human, that it's not a de-aged Will Smith, it is actually a 100% digital character. And that made me, the possibilities of that got me really excited.
What about Ang? Were you nervous?
Extremely nervous. I've done. I kind of one of the person who started all this 20 years ago with Hulk. That was the first time I think anybody tried a full digital human. Then 10 years ago, I did the Tiger in Life of Pi quite successfully, more so than Hulk. And I know doing digital human in the back of our head, we don't want to believe it. We want to challenge it. I know that's the hard part, but I know scientifically in my head, I'm not a scientist, but it should work. And I call it a leap of faith because people invest so much money in this. And I tell them, I don't want the age, I want to create full digital. I think it's time. It's reachable. We think reach, but nobody has done it or proven it can be done. So I was extremely nervous, not for myself, for the investors. They put so much money in it. What if it doesn't work? What if people don't want to believe it? What will happen? But I feel privileged, but at the same time, it's a privilege to even give it a try, to imitate God's work and play with people's imagination. That's definitely a privilege.
So one of the other questions that you were asked at the screening, Ang, was what did Will think when he got to see Junior, the complete or near complete Junior for the first time? Ang said, who can say what Will Smith is thinking? But we do have someone on stage who might have some idea. What was it like?
No, when I first saw the first shot with the two characters side by side, it was really chilling. Because I'm looking at it and it's me, but it's not. It's not me. It's a completely separate character, and there are literally thousands of artists that are creating every little nuance of the movement and the color of the eyes and the wetness, and so there are thousands of artists that are creating that. So for me, that the first time that I saw that, just the artistic possibilities, what it meant that we could do in movies now, really blew me away.
Did you feel like Junior was better looking than you?
I mean, if I can be honest with you, Anthony, I'm glad you brought that up. No, there is a certain gorgeousness to age that young folks can't capture this, man. Young folks can't capture this. Where are the 20-year-olds? Are there any 20-year-olds in here? Yeah, see, y'all not as attractive as this yet. You got to grow into this.
So let's talk a little bit more about the technology. Will, you were saying, like you said, that it was not about de-aging. It wasn't just about,
right.
I don't want to use the word wrinkles, because, I mean, whatever is happening over there, it's amazing. But, it's not about just taking your real footage,
they say black don't crack. That's what they say. That's the word on the street.
So why did Will, what was it about this approach that appealed to you versus just, hey, let's do what we've seen in some of the Marvel movies, some of the Star Wars movies already? Why was this the approach you wanted to take?
For me, I look back, I'm old enough to see, what if I face my younger self? I'm just old enough to think about that even. Will, I don't know if he does. But I think the beauty is, which is also the problem, that Will is a much better actor now than before, right? So that's a problem. But in my head, we put what's inside of this man and his attractive young body, what would that creation be? It's kind of a best of both worlds. And when he faces that in such media, I'm doing the 3D with more clarity, smooth out, kind of an immersive movie. What is that like? Actually, nobody's seen that, even himself. His parents, they never see him in close-up like this. So it's a new creation that has all the best of Will and all the best of all the artists we work on. And we try to make believe, see if people will believe that or not. Will is Will. A younger age is younger age. And then, honestly, I don't really care what he thinks. What does the movie play? Do they want to invest that belief? Get him, or everything they talk about in the introduction. The scientifically, that's actually the easiest part. The study they do into aging is mind-boggling. Every cell, how emotion work, how time do to you, to everything is mind-boggling. But when you get all that right, that's just like 10% of the work. The other 90%, you just scratch your head. Why? What's that? How God created the world? It's nearly crapshoot. That's the hardest part. How you take that along to play in such media and make believe. That's a new world and also an old world you try to reinsure.
And so, like you're saying, what we see on screen, Junior is basically a purely digital creation. But Will, you were on set wearing the dots, wearing the rigs. You had to play a younger version of yourself. What was that like?
Yeah, it's really a difficult undertaking to try to play naivete, right? Because it's like once you know something, it sits in your body. It's like. Like once you have sex, right? You just walk different, you know? You just got a different swagger, you know? So, but like to go back to the mindset and try to remember what were you feeling? What were the emotions before, right? It's a difficult undertaking as an actor to take your mind, take knowledge away. You can always put new things in. You want to play a doctor, so you can learn and you put these new things in and you learn how doctors move and how they think. But to go back to play youth was a very difficult undertaking for me.
How much of that was memory and how much of it, because obviously there's an incredible amount of footage of you in your teens, in your 20s. Did you have to watch a lot of that to try to do this?
Yeah, so what was great that Ang did is he essentially looked through my entire filmography and he created takes of things. He had 6 Degrees of Separation and The First Bad Boys and The Fresh Prince of Bel-Air and Men in Black and Independence Day. And he went through and he grabbed these things and he sat me down and I was like, yo, this is great. This dude's a real fan. And he's looking. And he was like, this is very good. Notice how your eyes communicate the simple essence of innocence. And I'm like, yeah. You know, that's what I was doing back then, man. And then he went over to the next one. He says, this is very, very bad. Don't do this in my movie. I was like, you know, and he just went through all of the films. But what we were able to do is we were able to create a dialogue. We actually sort of created a language. And in that process, I saw the depth of what he was trying to do, right? To try to make a digital character communicate a brief moment of uncertainty, but to do it with binary code, like to be able to try to create something that to have a computer capture that essence was a powerful undertaking.
And so once Will had done his work on the set, you guys, I think you said it was basically a 2-year process with Weta Digital, and they basically took what you did and they built Junior. Talk a little bit more about what that process of working with Weta was like. As you said, it's sort of unprecedented. What were the big challenges?
2 years, 1 year is in prep and shooting, and the other 1 year is post. You want to be a good citizen while shooting as you planned it. So if a big movie star comes in and say, I don't feel like doing that one, I want to kill him, because we're planning a long time. He's part of that planning as well, too. So we're guessing, educated guess, that's it, very good guess. And then we do mock-ups, we try this, try that, we did a lot of tests, we did our science. Then we developed methodology on the shooting days, which is precious, the most expensive time, how we capture it, layer by layer by layer. It's very complicated. Other than the clumsy 3D cameras, and a lot of technicians, and 3 rooms for a technician. They all look busy. I don't know what they're doing. So it's very complicated. Plus, Weta people. They're the people who pull the magic. There are like dozens of little cameras measuring this and that. And they all look busy. I don't know what they're doing. And we shoot layer by layer and layers. So it was like one shot. We shoot many times, as you remember. It's very inconvenient. But a good thing, this man has good work ethic. He should go about sometimes with him that way, without him, just so we can have all the layers that's clean. And then there comes the really painful part, which is painstaking, rather. You got 500 artists in New Zealand and try to make it work. Some shots will take like a year to realize. I've said that the hardest thing is everything looks right. You still take maybe 9 months try to figure out why you will want to believe that a young Will Smith is doing that character and that is genuine to be studied by this. How does that feel, the flow of the story? I think it's really surprising. To make him look alive is not the hardest thing. I thought that was the hardest thing, but making him match how we're imagining him being a better actor, doing those things, the look alike, something in the texture and the lighting and angles, you just couldn't figure out. You just keep trying. sometimes you find a little tricks. And also, I think on top of that, why this guy get to pay the big bucks for so long? The Will Smith's charm. That's the hardest thing. Why he did certain thing and people love him? Why he menacing and he play like a Terminator type of guy and you still want to feed him chicken soup? Like, what is that secret? Is that in the corner of his eyes? Raise the eyebrow? Is the corner? You just keep trying until you sort of feel that. And also you have to understand when people watching 3D, the difference between people are much larger than 2D. So then you have me saying one thing, the supervisor saying another, the editor said, the 5 people, they all tell, it's very difficult. But that's also a privilege that you get to figure that out.
Yeah, the thing that was really, for me, you all right, buddy? You fell? You good? Okay. All right. Security. No, the first thing is it's 120 frame and 3D. And so it's so sharp and you're so close and it's so clear that the actors couldn't wear makeup. That's how close the camera could detect makeup, and it would leave a film, over the skin. And Aang was like, you don't believe it. So in the, you get, raw, it's wide open. And what Aang kept talking about that I loved is to keep people a reason to go to a movie theater where you can see something and experience something that's different than you can on your big screen television at home. And the revitalizing and the elevating of the cinema-going experience. And I love, Aang was saying, people calling it high frame rate. And he was like, no, I like to refer to everything else in the cinema as low frame rate. And that, and that idea to try to really capture and to be at the forefront of a new way that people watch and consume films.
You see through people. That's the beauty of it. I think close-up is the best thing of this media. You can detect them as if you're in live. So their performance has to be adjusted. The way they prepare a character and living a moment has to be really adjusted. I do believe, as harsh as it sounds, it seems to be punishing. You have the real high frame rate, the sharpness and all that. At the same time, you have more to work with. It's a double-edged sword. At the same time, it's intimidating. On the other hand, you have so much more to gain. You can work on it. Things, it just got blurred out before. So as long as you be careful, it's very exciting, actually. It's scary, but it's very exciting.
Because, I do want to talk a little bit about what, at least for now, we're calling high frame rate and 3D, because I think there's...
I don't really want to say that, something, right?
I told him not to say it, Aang, and he said it anyway. He said it anyway.
Right.
It's stroke-free.
And so I think there's been, with some of the initial films, like The Hobbit, and then with Billy Lynn, which you made before this, I think there's been a little bit of skepticism. There's been some people who said, hey, this doesn't look like a movie, this looks like a soap opera, or I don't even know what this is, but it doesn't look like a movie. Why do you think there's that disconnect that you see all these artistic possibilities and people look at it and they say, I don't like the way this looks?
I think, I hate to say this because we have a new media, we don't know what to do with it. We're not good at it, that's all. Someday we'll be good and people enjoy it. You'll create a different form of art. It's definitely a different art format. But what we know is film. That's all we know. So we're imitating something 40 years ago. I think that's the problem.
So part of what you're doing
and
now
also,
is figuring it out.
The compensation you did for a lower frame rate or the graininess of film, that associate with a lot of artistic approach or even negotiation that creates the most tremendous art experience. Movies, we love movie lens. So that's the part you hook on, not the media, but it's the artistic endeavor in dealing with our media, the story you tell, the beauty you create, that's fantastic. But now you're having different media. If you do the same thing, of course it doesn't look as good. You have to find the thing that belongs to this media, which I think involves a more lifelike kind of beauty. Why we look at something and say, that's beautiful, why it's not? We have to get to the bottom of it and find the beauty that belongs to digital cinema. Maybe it's dimension, maybe it's contrast, maybe it's more lifelike, but it's I found some of the shots I do in 3D is a lot more beautiful than 2D. It's like there's no way you can film water, you can do justice in water. There's no way you can do that close up unless you have clarity, you have dimension, because that's what your eyes do in real life. But when you're that close to life, how do you create art? Can you dream with clarity? Some really existential questions. But we have to give us some time. We'll get there. I believe this is a new media that's worth grabbing, and that's digital. It's not technology. Technology is a tool. Like, 100,000 years ago, there's no such technology as oil painting or watercolor, or even as language if you go back. So give us a chance to learn how to do it, how to act in it, how to make it look pretty, and how we tell stories, how we make believe, how we do art department, how we even pull that focus, which is impossible. You go through the focus puller know him better than I do. When Will is about to do something, he has a bigger filmography than I do. And he just knows like half a beat ahead of time while he's tacking along all the digital data along with him. While he's like 1 second behind, we'll have to be half a second ahead of what he's about to do. And every eyes goes to different places. Pulling focus is impossible, and you can see it. How did he do that? What kind of a technology we need to develop to accommodate this kind of artistic endeavor? It's a huge question. So give us some time to figure it out.
Actually, give us till October 11th when Gemini Man comes out. Make sure you go see that.
That's right. So changing subjects slightly, Will, last year you launched with Keisuke Honda this VC firm called Dreamers VC. So you are now a venture capitalist. You are a startup investor. Why did you want to do that?
Well, I met with Keisuke and we just hit it off immediately. And we felt like there was a beautiful intersection between being able to create businesses, but also to stay focused on solving problems of the world. So our relationship started to develop, and then we said Keisuke had a few banking relationships in Japan that were looking to make their way into the United States. So the relationship worked out well, and I had already been investing, and he had already been investing, and our values were in alignment. So we came together, and a lot of people that felt the initial ideas jumped in. Just Water was a company, one of the companies that we started. We invested in Boring Tech. So we want to solve some of the world's problems. We want to do well by doing good.
So outside of movies, you've mentioned a couple of companies, and they're very different. What are like the kinds of technologies that you're excited about?
Well, actually, we're here at TechCrunch. We should probably see what's going on in this space. I'm wide open. I'm wide open.
That's my cue, because we told Will that this is a startup conference. He is a startup investor. He wanted to meet some of the startups. We couldn't do the Comic-Con thing of like putting a mask on you and having you walk around. So we're going to bring some startups onto the stage. These are startups from the Startup Alley. They're going to get 40 seconds to present. So it's going to be extremely time intensive. I'm going to cut them off. They found out like 2 or 3 hours ago.
Oh, wow. In movies, we call that the elevator pitch. In movies, can you make the elevator pitch?
Yeah, so let's bring out our startups for the elevator pitch. Are they ready?
Oh. I love that. Okay.
Are they here?
Hey!
There they are.
How you guys doing? Hey.
Okay. So we are going to start with Airbnb. Presenting for Airbnb is Christian Ramey.
Christian, what's up, man?
I'm good. A bit stressed.
All right. Are you nervous?
Yes, very nervous.
Very nervous. All right, don't worry about it. This is it's only an opportunity of a lifetime, and everything rides on this. So just relax into that. Relax into that. All right. Oh, there's Jordan. Okay, where is it? Where are you taking him, Jordan? Over there. Okay, so that's the mark. All right. All right, just loosen up. You're going to live or die on this moment. Go for it.
Okay.
All right.
40 seconds.
I'm Chris from Airbnb. Cities are congested with traffic jams, and the last mile is always the least efficient part of a journey. Meanwhile, people have bicycles sitting at home that are underused. At Airbnb, we want to promote bike sharing as a means of transportation while generating revenues for the bike owners. We have developed a smart bike lock with a GPS that can be installed on any bike such that anyone can start a bike sharing fleet in just a few minutes. You can install it on your bike and start to make money by sharing it. And we just take a small fee. Thank you.
Will, you got questions?
All right, so it's similar to like the Uber vibes of bikes. How is it different from the was it Bird? What was the company that did the
Bird and Lime? Yeah.
Yeah. So what?
Scooters, right?
What do you think you're improving on?
So we don't provide the bikes, so we use the bikes of private people, and they can make money with it, and we share the fee.
Okay, all right. I like that. Anthony, do you have anything?
No, I'm good. Airbnb, well done.
Okay, I like that.
Thank
Good
you.
job.
Join them.
Good job.
And while we've got our next company coming up, it's Bidder Construction App. Presenting is Cody Sheehan.
Cody! What's up, Cody?
How you guys doing?
I'm good. How you feeling? You good? You're nervous? All right. You're not. You got to use the microphone. You got to talk in the microphone, Cody. All right. All right. So listen. So this is good. You're very handsome, Cody. So that's already working for you. Okay. Yeah, I heard somebody when you walked out. Somebody went woo. All right. So you're already in a good place. So you should sell your handsomeness along with your product. Okay.
Sounds good.
You got it. All right. Go.
Hi guys, I'm Cody with Bidder. Bidder connects Latino construction workers with jobs in the US. Our mission is to empower Latino communities and bring efficiency back to the $1.3 trillion industry. In 2019 alone, we project over 1 million new immigrants entering the country. And at the same time, there's a 79% mass labor shortage. Currently, our app serves 40 location-based construction crews at an 84% retention rate. This underserved, deskless workforce is missing the technology to help them connect with homeowners.
You're out of time. Will.
Okay, hold on. No, all right. So I like that idea. I like that, the idea. So trying to solve the problem. All right. So the app is already up and running.
It is.
Okay, what cities, what states?
So right now we're focusing on Houston, Dallas, San Francisco, and San Diego.
Okay. So how do you handle the clearing of the workers, documented or otherwise? How does that function?
Currently we're in a really large swing in one direction, and I believe that in the next year or two, we're going to be pushing in the opposite direction. And this is the time where Bidder can capitalize on that swing and that change of momentum.
Mm-hmm. How are you interfacing the company with the workers?
So we're a two-sided marketplace where we have an app which is also in English and Spanish for the workers, and then we have the app which is the homeowner user interface.
Got it. Okay, so it's direct it's the homeowner so it's not like...
Could also be larger construction jobs. We're kind of small to mid-sized jobs.
All right, so what's the majority right now? Majority is homeowner to worker.
Yeah, the majority would be that way.
All right, so how do you monitor how the jobs went, how it went with the people? How are you...
So as the jobs get called into our system, we input them into the database, and the construction workers in live time can view the new jobs and place bids.
Mm-hmm. Yeah, cool. Any questions? You guys have anything?
Good, I think we should bring up the next one.
Okay, next one.
Bidder.
All right, I'm taking too much time.
Thank you so
Bidder
much.
Construction App.
All right.
Next up, we have Moodbit. Presenting from Moodbit is Miho Shoji.
Oh no, Moodbit.
Oh, sorry, it's Soshionato Kofi Frimpong.
Kofi, what's happening, Kofi?
What's going on?
What's happening?
Yeah, so did you know that 75% of people check out your company's social media channels before even applying for a position at that company? Why is that? Because in order to attract the best talent and engage and retain the best employees, companies need to effectively showcase their culture. At an affordable monthly contract, Socionato customizes and matches companies with freelance employer brand teams that create content showcasing company culture, workplace environment, and diversity. And with over 250 freelance employer brand teams on our platform, Socionato wants to tell the stories behind the people and the culture that make companies great. And we're excited about this $10 billion HR tech industry. Thank you.
Woo! Right on time. Nice.
Okay, I'm in. No, so yeah, as you can imagine, that's something that's really close to
your content background.
Yeah, that's right. So as I built out my social media team, that was the idea that I wanted to take back my storytelling from from the Daily Mail, right? So I wanted to take back my storytelling, and I think that's hugely important. So how is it working between, how do you interface the company with picking the person that they're going to use to?
Yeah. So obviously a lot of companies, they care about social media for their products, but they forget, the HR team sometimes forget about the actual culture and people that are used to attract talent. So we customize and match them with a team. The team usually includes like a creative director, a project manager, and then videographers, photographers, and they integrate with the HR team to create, employee testimonials, company announcements, new things that are happening with the company. And some companies, even like Netflix, for instance, they have a whole separate channel showcasing their entire employee brand. And we want to bring that to, enterprises that don't typically use content to attract and maintain, employees and things of that nature.
All right, that is wildly expensive. I know that firsthand. How are you cutting down costs to be able to deliver
it is
that?
expensive. We're definitely targeting like Series B funded companies and larger enterprises, but we're still more affordable than, say, like a creative agency that's going to bang them over the head with that. So that's why we have like these freelance employer brand teams, and our freelancers that are part of these employer brand teams, they have experience working with large companies and enterprises. So even though our prices are still expensive, it's a better option than, say, some of the other options with larger creative agencies that might want to be involved in creating content, showcasing their workplace environment.
Thank you, Kofi. That was very good.
All right, Socionato.
Yeah, that was very good.
You got one more.
We got one more, and I'm taking a lot of time. Sorry.
No.
How are you feeling? Welcome.
This is Moodbit presenting as Miho Shoji.
Yes. Hi, everybody. How is your mood today?
Spectacular.
Great. My name is Miho Shoji. I am the co-founder and CEO of Moodbit. We are a people analytics company focused on employee sentiments to improve engagement and retention. Companies in the US are losing more than $600 billion every year because of disengagement and turnover. We integrate our AI platform to internal communication platforms like Slack, Gmail, or Microsoft platforms. So we can understand their employee sentiments, and managers can have real-time scores of the sentiments, and they don't have to wait for the results of surveys, once or twice a year surveys. But on top of that, the analytics is not enough. We are providing to the managers with action plans so they can have happier employees.
Okay.
Great.
All right, yeah, Anthony's like, that's it.
No, I'm trying to be the bad cop so you can be the good cop.
All right. Thank you very much. I know we have a red 000. I will speak to you backstage. Thank you very much.
Ask one question.
I'll get to ask. Okay, yeah.
All right.
I saw.
That's the 000 for the 40 seconds.
Oh, for the 40.
Right,
okay, because it was white and then it turned red.
Either that or they didn't tell me something.
They didn't tell you.
We're good.
Okay, so you are the CEO. How many people are you working with right now?
We're a small team. We're 7 people.
You're 7 people. So what have you done so far, right, in terms of working in the workplace? What have you?
We create the concept. We create the product. We launch the product, and right now we are working with enterprises as Accenture, or we have a partnership with Deloitte and Ernst & Young.
Okay. All right. I'm sorry. All right. Oh. Yes, I'm sorry. I got distracted. I'm very sorry. But yes, I will speak to you backstage. I'm sorry. I got distracted.
All right. Give it up for Moodbit. Okay. So I don't want to put you on the spot, but now seeing these 4 pitches, are you comfortable saying, is there a favorite that you would like to bring up here for a selfie with you?
I think Kofi did the most beautiful and aggressive.
Kofi at Socio.
So
yeah,
we get
come on up, come on up. This is your moment, man.
And I think also, you know, that was really the best pitch. So we're gonna rock a selfie, but this selfie I'm gonna let you use for promotion because I'm gonna invest 10 grand in your business.
Wow, there you go.
So we can use that.
Making some news.
All right, yeah. This is part of my business. I like that. Great energy. I love that. Thank you all. Thank you all. Thank you very much. Thank you very much. Thank you so much. Thank you.
Big round of applause for our startups, please. That takes some guts.
Great work, startups.
Great job. You guys can go ahead and exit.
All right.
Good job.
Will Smith, Ang Lee, we're getting the hook. Let's go.
Thank you all. Thank you guys very much. Thank you. Thank you.
Thank you.
Thank you.
Thank you very much. Thank you so much.
You surprised me, man.
It's my girl.
I knew
That's my girl right
It's
there.
my man right
I
here, man.
feel you. I feel you.
You too. I really like you as well. And Shirley, you're cool.
Yeah, okay,
You're
whatever.
Good. Yeah. Woo! Ha Okay. He just called me his girl, so I can die. We're safe with that. Okay, we got to keep things moving because that went way over time. So without any further ado, I'd like you to please give a warm, warm welcome to our next guest. From Andreessen Horowitz, General Partner Chris Dixon, and your moderator, Josh Constein. Let's go.
So I wanted to start this panel with a cryptocurrency joke, so here it is. Litecoin. Okay, only a few people got that, but in honor of our previous guest, I wanted to make one Will Smith joke. So what does Will Smith say when he asks for Bitcoin, but somebody pays him in dollars?
I don't know.
Oh no, you did not shoot that green shit at me. Okay, so less of a laughing matter is Libra, Facebook's cryptocurrency that some people are worried is going to crater the world financial system. Yep. And the French finance minister said we cannot authorize development of Libra on European soil. But you are a Libra Association member, and Andreessen Horowitz is. Yep. So do you think that Libra is actually going to launch in the next year or two?
Yes, I do. So maybe stepping back, I could say, so we're very excited about cryptocurrency, and the way we view it is in the context of the history of computing. So if you go back to the history of computing, every 10 to 15 years is a new kind of major computing cycle. Mainframe computers, PCs, the internet, smartphones. We're in a period now where a whole bunch of interesting new computing platforms are getting built out. So for example, virtual reality, augmented reality, self-driving cars, bunch of stuff in AI is very exciting, and then we think blockchains are also a new type of computing system that has a lot of interesting possibilities. When you create a blockchain, there's a lot of different possible applications. So people have probably heard of Bitcoin and Ethereum. Those blockchains make certain sort of technical trade-offs that make them good for some applications and not for other applications. What Libra's doing, which we're excited about, is they're designing a blockchain from scratch that's built to optimize for payments. And what does that mean? It means you need, for example, the stability of the currency. So a currency that is denominated in something like dollars. So when you pay a merchant, they actually get the dollars, and also something that has very high throughput. And we think they've done a really good job on the design of that. There are all sorts of, as you said, regulatory and other kinds of questions.
But do you think it's going to launch in the next year or two?
I do. Yeah, I do. I think, I don't know if there will have to be changes made, and it's going to be a dialogue with regulators and the partners and various other kind of stakeholders as to exactly what the design will be. But look, this is crypto is a global movement. China has said that blockchain is a national priority. It's happening all over. All of these kinds of projects and things are happening all over the world. The benefits could be immense. So for example, there are something on the order of 2 billion people who have smartphones today but don't have access to sort of the modern banking system, as an example. And many of those people use applications like WhatsApp. And so to provide a payment system that's, sorry, I think my sound's going out, to provide a payment system and to include those people in the financial system, while also providing a way for software developers and entrepreneurs to build applications on top that serve those people. It's a very powerful idea. It's very exciting to have a company the size of Facebook kind of supporting that. I hope that it's beginning of a process whereby more large tech companies get into this space. To me, I know you're a fan of VR, like I am. Facebook's doing a lot of investment there. I would love to see more companies do investment there. Generally, at our firm, we are very much pro-innovation. We're pro-entrepreneurs. We want to see new technologies develop, and so the more people that are getting involved, the better. And it's awesome that Facebook is making such a big investment here. And yeah, so I do think it'll launch. And I do think it'll launch. I think there's a dialogue. It's complicated. First, it's creating an association, which we're part of, which is happening now, and then that association will have a dialogue with regulators and with various other stakeholders, and make sure that what is created is something that benefits sort of all different constituencies. And then that may involve changes to the project.
What changes do you think the Libra Association would be flexible with? What could change that might help regulators come to terms with?
Well, I think one thing is, if you look at how it was received, a lot of people thought they were trying to create a new currency that was sort of a supranational currency. I think it's much better to think of it as a payment system.
So what would change to make people not think that?
So, for example, denominating the currency in U.S. dollars. I'm giving a hypothetical example, but that's the kind of thing. I don't think the intention was. My understanding is the intention was never to create sort of a new currency. If you see some of the various comments around it, it's much more focused on the payment rails. Providing a payment system that, one, lowers fees, two, includes those 2 billion people that aren't currently included, and three, allows a platform where developers can build on top of it the way they build applications on the App Store or something like that, right? And so.
Got it. Okay, so most recently, we've heard that Visa and MasterCard are considering how to pull back from the Libra Association because they're not really enjoying all of this legal scrutiny. What do you think about that? Are they kind of traitors or just lacking courage?
I don't know the specifics of what they're doing. I think I would say just generally, it's when you create these new things, there's a tension between existing companies that have have some kind of stake in the status quo, and new technologies that, so I don't know, imagine if you tried to create YouTube back in whenever YouTube was started in, I think, 2005 or 6, and tried at the time to work with, incumbent media companies. There may have been challenges. What I think tends to happen over time, if you look at things like YouTube now, all the media companies have presences on those networks. Sometimes it takes, first, the way or Twitter or Facebook or any of these things, right? Sometimes it first requires kind of building something and getting people to use it, and then to really get the buy-in of the larger kind of incumbent players. So, but clearly, there's a big consortium. It's complicated. There's a lot of different interests. That's something that needs to be managed.
But given all of the scrutiny and all of the toxic brand that Facebook has developed, is Andreessen Horowitz still comfortable connecting its brand with Facebook's through the Libra Association?
Well, so there's a very important thing I want to say about blockchains, which is, I wrote an article in Wired about this if you're interested. It's the phrase I like to use is blockchains, instead of an era of don't be evil, it's an era of can't be evil. And what I mean by that is the whole concept of a blockchain is it uses a game theoretic mechanism whereby it doesn't matter what the creator of the blockchain, their intentions are, or if they change their intention, it doesn't matter because it's baked into the code what the rules of the game are. And those rules cannot change, and they're open source, and they're openly auditable. So I would say, regardless of what someone might think of Facebook, it's sort of a separate question. As long as the blockchain is architected in the correct way, you don't need to know. You don't need to trust their intentions. That's kind of one of the exciting things about this whole movement, is I think over the last 20 years, I think a lot of people feel like they made a kind of a deal. Like when you first joined Facebook or Twitter, whether you were a user or a media company, you made kind of a deal with that, an implicit deal, sometimes a real deal, like a terms of service and private, but sometimes an implicit deal that this is how the thing is going to operate. So if you go talk to a media company and how they feel about Facebook, they may feel like at first Facebook was very helpful, and then later on, the rules changed, right? So one of the very important features of blockchains is that the rules are baked in from the start. They're transparent. They cannot change. Bitcoin was created by a pseudonymous person, Satoshi Nakamoto, that no one knows who that person is. It doesn't matter who that person is because the rules are baked into the network. That person could change, his or her mind. They could change their intentions. So I would just argue that like one of the key features here is that that you don't need to, right? You don't need to sort of understand or even care about the motives of the people behind it.
So that works when there are rules written because the rules can't change. But we've seen a lot of problems stem from when the rules aren't written and what actually happens to those companies. And so most recently, the SEC only fined EOS maker Block One $24 million for their not quite legal securities sale from its ICO that raised $4.1 billion. So that's a 0.5% fine. Do you think that that's fair, and is that going to embolden bad actors?
I don't know the details of that, and the way these things work, it could be one of many. I don't know what's like. It could be the beginning of a process. I don't know.
It's supposed to not be. There's no disgorgement.
We're not involved, so we're not involved with that project, and I don't know the details. But I will say that we think we have from the start. For example, this whole ICO craze in 2017, we never participated in that. We never invested in any companies that did any of these ICOs or sort of unaccredited investor sales. We have believed from the start that it's very important to work with regulators, and so like the companies we're involved with take regulation very seriously in all the jurisdictions they're in, and we spend a lot of time on it. And like my partner Katie Hahn, like she's an expert in it, and we have a bunch of people at the firm who do it. I don't know enough about the details of that.
But do you think low fines for violations on the lots of money raised might just lead bad actors to be like, well, sure, if the rules aren't perfectly clear, I'll just break them because who knows, and worst case scenario, I get a tiny slap on the wrist.
Well, I think one thing that would be nice is if the rules were clearer, because one of the frustrations we have right now is just that there aren't, basically we've sort of asked for guidance and looked for more kind of clarity on the rules, and so some of these, I think some of these issues are, look, I'm sure there are bad actors who are doing scams and things like this. But I do think some of these situations were just simply the lack of clarity in the rules, so I don't know whether EOS was one of those cases, but I do think like there have been a number of cases where people thought they were complying with regulations and just didn't understand what they were because none of it's been clarified, frankly.
Speaking of that, when there's so much cryptocurrency snake oil out there, and obviously there's plenty of projects where it's just obvious it's not going to work, there's a lot wrong with it. But when you see a legitimate project that otherwise seems like it has real potential, what are those final red flags that you're still seeing in this day and age that dissuade you from wanting to invest or get involved?
Well, so I kind of feel like crypto today is a little bit like the early internet in that there was this sort of gold rush, right? And if you go back to the 90s, there were a lot of bad companies created. There were a lot of kind of these IPOs and other things that probably should never have, companies that never should have IPO'd. But there was also Google, Amazon, PayPal, Yahoo, and that's our view of the current crypto world, is that there's a lot of things which we don't agree with how they're doing things, maybe they shouldn't exist, but there's also a lot of really, really high quality entrepreneurs, some great technologies. Out of this, we believe there will be iconic new companies that are built.
But if I'm a company out there trying to be like, I want to be a legitimate company, I don't want suddenly people to say like, oh, I'll just back away. What are some red flags that they could get rid of or fix in their companies?
Well, I think one of the core, what we believe is one of the core things that works in the startup world is a long-term focus where the employees, the founders, the investors, and the users are all aligned around a goal. And so, for example, there are all sorts of best practices that have emerged over the years with traditional startups about how to issue equity and how to treat your users and all sorts of other kinds of things, and take a long-term kind of win-win perspective on things. And that some of that has been lost in the crypto world. So we try to only work with entrepreneurs who have that attitude. We have that attitude. We have a venture fund that invests in, and it's a 10+ year venture fund, a very long-term perspective. We don't trade things. We buy, we invest, and we work as partners with the founders. What we do find is there's a lot of people just don't know. It's such a new area. They don't know what the best practices are. And so for that reason, for example, I wanted to mention that we're going to run a startup school in February and March for crypto-specific kind of startup school that will take what we've learned over the last 7 years as kind of best practices in the category that I think haven't fully propagated out and people don't fully understand, and try to kind of share them with people that come to this class, and then we'll also put everything on YouTube and everything else. This is just a purely educational thing. We're not taking equity. We're not charging. This is something we feel like we're now far enough into this crypto movement that there are best practices, but people don't fully understand them yet. It reminds me of I've been involved in startups for 15 plus years, and I used to be an entrepreneur. And back in the 2000s, there was all sorts of like, how do you build a product? How do you find founders? How do you raise money? And then there were a whole bunch of people like Y Combinator and a bunch of bloggers and other people who did, I think, a really great public service, which is they took all these best practices and they promulgated them. And so we're trying to do our part here on the crypto world and sort of say, here's what we've learned. Here's the best way to sort of think about regulatory, about organizational building, about business model, about go-to-market, about technology, and here are the best practices we've learned, and sort of share them in an open source way with the world.
Is the hope that these companies would then raise money from Andreesen if you
potentially they don't have to. I mean, we hope sort of in a karma building way that they would like us and come talk to us if they did that. But we generally, the way we look at these things is if we we're kind of good community members and provide value to the community that people will see that and hopefully want to work with us. But there's no requirement or anything like that.
So you spoke about trying to get there to be better, more legitimate rules, more clear rules, so that people know what to do and what not to do. But in May, you guys, Andreessen Horowitz, hosted officials from the Treasury Department, the SEC, and other regulators, along with your portfolio companies. It was kind of a closed-door meeting that people were a little bit surprised about because it's not usual for all of those regulators to get together with a private company like that. So what was the message that you were trying to convey to them?
Yeah, we were trying to create a dialogue. So you have these two...
A dialogue about what?
Over, like, what's the best way to balance innovation and sort of regulatory concerns. And to, I think what we saw was we engage with both constituencies, and we saw was a lot of misunderstandings. And so we held this event. By the way, we put everything on the we videotaped the whole thing and put it on the internet. So it was pretty open. And it was a widely attended gathering, as a regulatory term, meaning it was a whole bunch of people, including people outside of our firm. But the idea was to just sort of start a dialogue so that people. Look, if all you do is read the kind of the news media reports about crypto, you see scams and hacks, and it just looks like this big, big messy thing of all these scammers and things. That's not our at all.
It is a big messy thing.
There's a lot. There is messy stuff there, as there was in like the early internet. If I talked to Mark Andreessen about this a lot, and there was a lot of crazy stuff happening back in the 90s. He was right, and he saw it firsthand. So there is that certainly does exist, right? But we think that there is a lot of value in the technology, and we think I think it's important. I personally believe it should be an important national priority to make sure that we're the leader in it.
What was their biggest pushback about that? Saying like, yeah, we get that you want innovation, but here's why the regulation and the safety is more important. What was
well, I think a lot. I think there's different dimensions. That's a great question. I think partly it's just sort of an understanding, like why are you doing this? So I gave a talk. It's online on our website, A16Z. Like I gave a talk just explaining why are we excited about this? Just sort of we had a bunch of entrepreneurs explain what they're doing, and just to see that there's real societal value potentially in these technologies. And so that's one layer, sort of creating just a sort of shared understanding. And then I think there's a lot of just frankly technical questions. So there's if you look at the way that the regulatory frameworks work around securities and commodities and the SEC and the CFTC, there's 70 years of knowledge kind of baked into these rules, and they've seen various eras and all sorts of stuff. And so there's just a lot of sort of also technical questions, like what is the best practice? What should, because we believe the right business model for these companies is to, it's in many cases to have sort of coins and tokens associated with their projects, and to give those to employees, and to have, so for example, our standard thing is like we'll invest, we'll buy tokens, they'll use that money to fund the company operations, the employees will be incentivized that way, kind of analogous to stock options. And then at some point over time, with the right vesting put in place and the right lockup rules and things like that, there might be opportunity for other people to participate in that. But there need to be all sorts of safeguards. You can't have sort of what are effectively unregulated security offerings. And so, so I think there's sort of both like a shared understanding dimension to that is what we're trying to do, and then also sort of start to begin to work out some of these more technical questions of like what is the right regulatory framework.
So just finally, one of your big investment theses is following nerd energy, or the places where engineers are really geeking out and oftentimes building something that suddenly becomes mainstream important. What areas are you seeing losing nerd energy, and which areas are gaining that nerd energy?
Yeah,
right
I by the way, I say that, I've written blog posts about this. I use the word nerd, by the way, very affectionately.
Oh, me too,
Okay, so this is like a positive thing. What I mean by that is sort of, you look at the history of Silicon Valley.
Which ones are the ones, we don't have too much time, so I just want to see, like, which ones are gaining nerd energy?
I mean, I think to me, the by far the biggest kind of nerd energy thing is crypto. So that's why I'm sort of all in on this. And there's just a ton of really smart people, and it's misunderstood, and it skews, like, all the really smart technical people are in it, like, are really in it, and they're deeply passionate, and they, like, it's off the charts. I think, like, VR, I know it's in the trough of disillusionment right now. I think the Oculus Quest is a breakout product. I love, like, the Oculus Quest subreddit is one of my favorite things to read every day. So I don't know. I think that's, like, a really interesting area. I think
any areas we might not think of? I think, like, crypto and VR have been around for a minute, but.
Yeah, no, I think some of these things, some of them have, like, AI used to be one, right, or machine learning specifically, but that has obviously transitioned into the mainstream. I'm still very into hardware. I know hardware is out of fashion in the startup venture world right now, I think, I think, I don't know, like, I personally spend my weekends, with Arduinos and 3D printers, and I love all that world of sort of open source hardware, and I think it's very exciting, and I think that's sort of not, as in right now, I guess.
So quickly, just to recap some of the interesting points, Chris does think that Libra is going to launch in the next few years, but one option might be changing its denomination from Libra to US dollars to make regulators a little bit more comfortable with it. And obviously, there's going to be big companies that have a stake in the status quo that might be interested in pulling back because they don't need it to succeed. But after this whole gold rush, if we can focus more on the long term and get everyone aligned, from the investors to the employees to the users, with the right incentives, crypto might be able to last a little bit longer. But we're going to need stronger rules and to answer all those technical questions of regulators. But if you're looking for the next big area, augmented reality, virtual reality are still in, but there's plenty to build in cryptocurrency. So hope you guys find whatever the rest of the future of green is.
Can I say one last thing, which is, if you're interested in the crypto startup school, if you go to a6z.com, we have a place where you can put in your email address, and we'll send more information when we have it.
Great.
So
thank you guys all for watching.
Thanks.
Thank you. Okay, up next, we have a very special news announcement. So please welcome to the stage Brex CEO Enrique Dubugras and your moderator, Kate Clark.
All right, welcome. We're so happy to have you. I know you have some news you want to get into, but first things first, why don't you just tell everyone what Brex is?
Thank you, Kate. Thank you for having me. So my name is Enrique Dubugras. I'm the co-founder and co-CEO of Brex. Here at Brex, we build financial services that help ambitious companies grow. My co-founder Pedro and I, we started Brex back in March 2017. Since then, we launched our first product, which was our corporate card for startups. And then we kept launching products that were tailored to our customers. such as our card for e-commerce and life sciences. But since the beginning, we always knew that Brex wasn't only a corporate card company.
So what's the long-term vision for Brex then?
So at Brex, we focus on one problem, which is moving money. I'm originally from Brazil, and we used to say in Brazil that you measure how developed the country is based on how fast you can do three things. One is get an office, two is set up internet, and three is open a bank account. When we moved here to the US, getting an office with internet was quite simple, but opening a bank account, that took weeks. And even after we got it, we had so many issues with it. Like, it seemed like the interface was built in the 90s. They charged us so much money for wire transfers. And it seemed like there was multiple systems between wires, ACH, card, check that seemed to not integrate with one another. Have any of you actually had a positive experience with your business bank account? Because it's been a while since banks actually worked for businesses. So that's why we built something better.
Okay, so opening a bank account sucks. Do you have a solution for those of us opening startup bank accounts?
Yeah, so today we're announcing Brex Cash. In Brex Cash, we focus on two main problems. The first one is your process for moving money is complex and slow. With Brex Cash, we made it fast and easy. In under 1 minute, you can just send wires and ACH, which is dramatically faster than any other bank. And then you can see those same payments in one single dashboard. So no matter if you're paying through card, ACH, wires, checks, in one single place, you can see and control everything that you're paying. The second problem we're solving is financial services are very expensive. The average cost of the wire in the United States is $23. With Brex Cash, we made it free. And not only we made it free, we actually reward you for making those payments. So you earn points for every single payment that you make. Traditional banks, they usually separate between checking and saving accounts, so you earn less interest on your money as a whole. The average interest rate for a savings account in the US is 0.1%. With Brex Cash, we simplified it into one account that you earn 1.6% on all your money all the time. So with Brex Cash, it's like this modern interface that we charge you no fees to pay, and we have an industry-leading yield.
Can you show us what it looks like?
Yeah, of course. So this is the dashboard. Very easily, you can add funds from another bank account. So let's say you're transferring to a Brex Cash account. You choose how much, let's say $1,500. And then you just review it, make sure everything is OK, and boom, done. Everything is now available. You can use this $1,500 immediately. And then sending money is also very easy. So you type who you want to send it to. So let's say Genesis Labs. You choose between wires and ACH. And if it's already pre-filled for you, if you already sent that transaction before, let's say we want to send the same $1,500. And then you just review everything, make sure everything's OK. And boom, it's done. Money out.
Great.
Super simple, super fast.
Great. Well, you guys can all read about Brex Cash on TechCrunch.com right now, but we are out of time. So thank you so much for joining us.
Thank you so much.
Okay, quickly, because we are behind. On the TechCrunch stage, if you are interested in getting into Y Combinator, you should go check this out, How to Get into Y Combinator with Ali Rogani, CEO of YC Continuity, and Michael Seibel, CEO and partner at Y Combinator. But now, we are going to be talking to Slack. So please welcome to the stage the co-founder and chief technology officer at Slack, Cal Henderson, and general partner at Spark Capital, Megan Quinn, as well as your moderator, Kate Clark. Warm welcome, please.
All right. It's been a year for Slack, probably the most important year in the company's history. So I want to talk about the direct listing. I want to talk about everything that happened this year. But I think we should start rewinding a little bit and talk first about Glitch, the game that Slack began as, or Tiny Speck.
Yeah.
Can you just tell us the moment you realized that Glitch wasn't going to work?
Yeah. So I mean, we started the company to work on this video game, and we spent 4 years on it. And I think, really, in retrospect, like the last year, we knew that it wasn't working out, and I think that was hard to, hard to admit to ourselves that the thing that we wanted to build wasn't going to work. And it was also in that kind of like curse of not being so unsuccessful that it was obviously a failure. And so we sat on the fence for too long of like the next thing we do is going to really, move the needle, bend the curve, and then we'll be successful. So I think we were a long time coming to the realization that it wasn't going to work out, and make that difficult decision to stop doing it and to kind of wind the company and the product down. That was a really tough choice, and it was like a really difficult time.
Yeah.
Both from a realizing that what we wanted to do wasn't going to work, and also having to like lay off a whole bunch of people that we'd convinced to come work at our company, at our startup. So it was a harrowing experience.
There was no aha moment for you?
Not really. It was we'd been talking about it for some time. It was a kind of, not even a decline, just we never managed to get the ramp that we needed. And we would have this conversation periodically of, should we continue? Should we do the next thing? What would success, or turning the corner look like? And it was much more, we realized we had quite a few months of runway left before we'd have to make the decision to raise capital or not. And we didn't want to hit the end of our runway there, basically.
So Megan, you've been an investor in Slack for years now, and you first connected with the company in 2013 via DM with Stuart Butterfield, who's the CEO, co-founder of Slack. Can you tell us what that message said?
So I first connected with Stuart at the beginning of 2013. I was about 6 months into my role as a partner at Kleiner Perkins, but I had previously been the head of product at Square. And he, I think out of the blue, sent me a DM that said, want a job, F-U-C-K, that VC thing. And I didn't take him up on it, obviously, which was, in retrospect, maybe a mistake. But I did get together with him to learn more about the product and became a beta tester then in the beginning-ish of 2013. And as I've mentioned to you, if anyone here has used Slack, you can understand why Slack is in single-player mode is not the most enthralling of products. It's like shouting into the void. But I was really excited about it, and I continued to stay in touch with Stuart for a number of years.
What did Stuart say to you in that coffee meeting you had, what was it, 5-6 years ago?
He was just talking about his idea and plans for Slack and how it came to be. Obviously, it was a tool that the team had been using while building Glitch. And he wasn't an enterprise SaaS guy, but he was a product persona, and he really understood and empathized with people who, in the workplace were looking for new ways to communicate and, had found something that worked for Cal and him and the team, and we were excited to get non-sort of Glitch folks on it. So I think at that summer, you should correct me, Cal, I think there was like 30 beta customers at that point before they ended up launching out of beta on Valentine's Day.
Yeah, I mean, we'd really, it was, as you said, because it's not a product that one person could use by themselves, it was a real uphill battle getting our first few kind of test customers. So it's not convincing somebody, it's convincing somebody to convince their team. And so we kind of went around like friends, companies in San Francisco and like spent time trying to convince people. It often took like 3 or 4 meetings of going to somebody's office and being like, please use our potentially shitty product. But I mean, those kind of initial users and alpha testers were huge in the development of the product, and us kind of understanding what it was we needed to build. We had a pretty clear vision of the kind of product that we wanted to create, and it worked really well for us as a team. But just getting into the hands of other people and watching them work immediately, brought a whole bunch of things to light about the design of the product that we would need to evolve. And we spent that much of 2013 in that kind of iteration phase of like, it works for us, but let's make it work for other teams as well. And at the time, there was other teams that were just like us. It was smallish software companies based in San Francisco, who were very early adopters of technology, but still like that. Finding that product market fit was really what we spent most of the first year doing.
Okay, let's jump to present day. So in June, you guys completed a direct listing. Highly anticipated, tons of headlines. It was only the second really of its kind following Spotify, which did it a year prior. Which one of you guys wants to take the difficult task of explaining to the audience what a direct listing is?
Well, I'm happy to take that one. So as a company, we wanted to become a public company. There are a lot of kind of advantages to us of being a publicly traded company and kind of the rigor and the scrutiny that comes along with that. But we didn't need to raise capital. And the usual process of the IPO is taking on additional dilution to sell new shares to raise capital, for the business. We already had enough capital and didn't need to raise. So it's much of the same process, and you work with the same banks and end up kind of with the same outcome. But we didn't raise capital, and we were able to offer liquidity to our employees and shareholders much sooner as well. So there isn't the same lockup period around it.
So there's been a lot of talk about direct listings lately, especially just in the last few months since Slack did it. A lot of VCs on Twitter, a lot of VCs blogging about it. There was a conference yesterday about direct listings, bringing together much of Silicon Valley's top investors, which you were there, of course. What's your take on direct listings?
Yeah, I mean, as someone who invests in companies who are upending the status quo, there's something sort of innately appealing about a financial vehicle, an instrument that is upending how things have been done for a long time. But I do think it's important to underline that direct listings aren't for everybody. And as Cal mentioned right off the bat, one of the unique things about a direct listing today, at least, is that you don't raise capital. So it's really only appropriate for companies that don't need to raise capital as part of their public offering. But there are other requirements, too, I think, that are still being sussed out by the market. Like, you have to have a product and a business that I think people can easily understand, and you have to have an executive team that's willing to get out there and pound the pavement and tell that story, because you don't have research analysts who are assigned to cover you. And I think, frankly, most importantly is you have to have shareholders who are willing to sell, because you need something that's actually going to trade on that first day, and you need enough of it that there's not going to be a crazy amount of volatility. So there are a number of requirements for a direct listing, but there are also a lot of benefits. I think some entrepreneurs feel like it's a more transparent and egalitarian process. You can put all your materials online. I think that some folks find it appealing that, rather than having underwriters line up investors and set the price themselves, you just let the market have at it, and what may. I also think, as Cal mentioned, there's no lockups. You don't have this wall of fear at some point of time in the future. And so there are a lot of benefits as well. And of course, yes, the same banks are involved. The fees are less, but there are still the banks that are involved.
One of the things you said backstage was that many of the companies you work with, direct listings are at least part of the conversation now when they're discussing IPOs. So what are your predictions going into the next few years? How many more of these do you think we're going to see?
I think Spotify and then Slack have opened the door for more direct listings for sure. There have definitely been rumors as recently as this week of other big companies that are going to go through that door. So I think we'll continue to see more of them. I think what's unproven right now is to what degree you need to have brand recognition, or more importantly, what degree you need to be super scale for it to be an appropriate vehicle. There can be great companies, great businesses, but maybe they're only going to be valued at $1 billion at max. And is the direct listing the right vehicle for them, or do they need some more of the support and infrastructure of traditional banks? So I think that you will see more of them. I can't predict, 5 years from now, is it going to look like 50-50 or whatnot? But I do think that there's going to be more explanation around alternative paths to public markets.
So when Slack launched, it was this very innovative tool to communicate with employees at your company. But since then, there have been many copycats, as there often are with companies like this. One of those was Microsoft, which launched Teams. I think it was maybe 2016, 2017, so years after Slack launched. And you guys had published an ad in the New York Times kind of playfully, right, sort of saying, welcome to the market, it's not easy. I'm wondering, has the sentiment around Microsoft and I guess the force of Teams changed at Slack?
It's, having Microsoft in the space is definitely, a company to be very aware of, right? They're a very capable, large company with incredible, track record on the sales side. On the one side, I think it's been good for us as a kind of market validation that, sure, there's a lot of other small companies that have tried something like Slack, but if Microsoft is building a product in this space, it's a clear marker that this is a category that is going to continue to exist into the future, and that there's strong belief that this kind of tool is the kind of thing that, every enterprise is going to want at some point. I think, we have, uniquely maybe for an enterprise software company, we have from the beginning really focused on the user experience and what it is what it is like to use Slack. You know, a lot of our, or most of our early growth was driven from people just picking it up and trying it and finding it useful, you know, and liking it. Which is definitely not the way people used to build enterprise software. And I think we are continuing to take that approach to making a really great experience that people love to use. And I think that can be a strong competitive advantage for us in an enduring way.
I just have to add, if you go to Google Trends right now and you look up Microsoft Teams, the top trending associated terms are, how do I uninstall Microsoft Teams? How do I get rid of Microsoft Teams? So there are definite benefits to owning your distribution channel, but also from a consumer standpoint, some real drawbacks.
Right, but that's the thing. So Microsoft can bundle Teams. A lot of people use Microsoft products, and they have the upper hand, or they have an advantage in that they can just sort of be like, take it even if you do desperately want to uninstall it. So I think many see that as sort of a threat to Slack, and I think partially why maybe some are bearish on Slack, on the Slack stock.
Yeah, the majority of enterprise companies in the world are Microsoft customers, right? Like the vast majority. But many of those companies are Slack customers too. So I don't think that we see, their distribution power is great, but one of the goals with the product is that we want every bit of software that your company uses to be made a little bit more useful, a little bit more valuable by using it with Slack. And if you're an enterprise company, some of those tools come from Microsoft, and we want to make them better using them with Slack. And a whole bunch of them don't come from Microsoft. You know, the trend over the last decade in software in the workplace is that of kind of proliferation of category and proliferation of tools. You know, that the average kind of medium-sized company today is buying 1,000 different software tools to use in the workplace. And an increasingly smaller portion of that over time is coming from Microsoft or the very big vendors. So we see part of the vision of the kind of integration platform in Slack is that we want those 5% of apps that come from the very big software vendors and the other 95% of apps that you're using to be productive in your marketing team, in your sales team, in your accounting team, in your accounts payable team. So that's kind of how we look at it.
So one of the things you mentioned, you were able to do a direct listing because you guys were so well capitalized. You'd raised, what, $1 billion and a lot of money as a private company, and one of your investors was SoftBank. So I do want to ask, going into the IPO, SoftBank owned 7%, and there have been many conversations in the last couple of years around SoftBank and the fact that much of their capital is from the Saudi Arabian government. So I'm just curious how you have felt about Slack taking money from SoftBank over the years.
I think like the way that I feel towards the actions of the Saudi Arabian government there, it's definitely that because it's the anniversary of the murder, that's abhorrent. Obviously, how we think about it's a very hypothetical question because the situation today is we're a public company that's very well capitalized.
Right.
If we were still a private company and we needed to raise capital today, raise a large amount of capital, then we would use all the information that we could when assessing and doing our due diligence on each investor.
Which is to say you may very well not have taken capital from SoftBank, knowing what you know now.
We would have a lot more information today than we did when we took that capital from SoftBank.
And Megan, similar for you. I mean, you co-invest obviously with SoftBank. You did on Slack. You were first an investor before them. I'm not sure if you've co-invested in other cases, but how does that feel? Is that something that you want, and how do you feel about SoftBank and its role in Silicon Valley venture capital?
I tend to say that if we are looking at the same deal as SoftBank, one of us is looking at the wrong deal. They're traditionally looking at extremely large investments. 100 million is famously the minimum, but 200, 300, 400, and they're really capitalizing. And I think some people argue overcapitalizing businesses to an extent that it's just not appropriate for us. We're writing $30 million checks, and so we really think about venture growth as opposed to sort of that late equity that they're doing. I have general views on sort of raising that much capital. It's not necessarily even specific to SoftBank. There are other vehicles for raising that amount of capital that I think that we're seeing a little bit of a backlash against right now. I think it's really important to understand your business and understand how you're going to put that type of money to work before you raise it. And I think that we've seen some loosening of that over the past few years that I feel and sense that there's a tightening around now.
If SoftBank went away today, do you think that would be a net positive or negative on the ecosystem? for both of you, either one of you.
It's hard to imagine the Japanese tech ecosystem without SoftBank, so that's kind of hard to say.
I wish they weren't writing quite such big of checks. That's for sure. It does feel like a lot of companies have raised more capital than they really know what to do with responsibly. So I can't imagine a world where there's no SoftBank, but I can imagine a world where potentially SoftBank isn't sort of writing the types of checks that they're writing today.
And last question I'm going to ask about SoftBank, but I'm curious, what kind of value would you say they added to Slack?
Oh, the expertise in the market in Japan is huge for us. You know, they're the kind of market category leaders in understanding enterprise in that market, which is a very important market for us. It's one of our larger markets as well. And that was why they were such a strategic investor for us.
So we are rapidly running out of time, but I do want to end by talking just quickly about notification fatigue. So before we get into it, could you just tell us what Slack is intended to be used for?
Intended to be used for work. We work teams and collaboration in the workplace. So regardless of the kind of industry you're in or the kind of role that you fulfill, if you're in a role where you communicate with other people in the workplace, then Slack's there for that.
So, I mean, as you know, many people do say Slack has been detrimental to work because of constant notifications. So some have written that it's actually ruined productivity, which is maybe an extreme or hot take. And Megan, you said you're shaking your head because you're a power user of Slack. You like Slack. But I guess how can we do you think people are using Slack wrong?
You know, I think that a lot of this sentiment comes really because of the rise of the smartphone in the workplace. You know, that's really changed completely how we work over the last decade. And because you have this device with you all the time that's always connected, it's very easy to always be in a state of semi-working, where you're never like you used to be at work or not, and now you can always be in the workplace. And I think that that's a general global trend rather than something that's more specific to Slack. But I think we're very cognizant of that and have built features around the product to try and put those controls in the hands of the users. So that's things like do not disturb hours when you know you don't want to be notified of things, or being able to hook up Slack to your Outlook calendar so that when you're in a meeting or when you're traveling, your status is automatically there in Slack, so people know whether you're available or not. Or other custom status or fine-grained notification preferences to put that control back in the hands of the user. Because I think that there's the kind of social aspect or societal aspect of it, and then there's what controls can we give users to have, to be able to control when they want to be interrupted.
So is it possible that people aren't leveraging these tools that you've created to help them manage their notifications?
To the extent that that's true, that's our fault. We're the providers of those tools and can always do a better job of educating our customers around how we think Slack can best be used and set up.
I will say as a minutely active user, if that's a thing, one of the things that Slack has really enabled is actually the reduction in using other different types of applications and having to constantly go check lots of different types of apps, because the nature of Slack as an integrator means that I can gather insights and data and information right where I'm having the conversation with my team about the very things that we would have to be going off and pulling from elsewhere. So I do think that's another feature and functionality of the platform that's really been extremely powerful for me.
Yeah, I think that as there has been that kind of explosion of software, categories and of software in the workplace, the work has become fragmented, and it's part of Slack is pulling that all into one place, so that all of the different work that happens across your organization is in a single pane of glass.
Well, I wish we had more time, but we are sadly out of time. So thank you both so much. I hope you'll come back.
Thank you so much.
Thank you.
There we go. Don't miss me this time, Cal. There we go. There we go. All right. On the TechCrunch stage at 3:45, how to build a subscription product with Alex Friedman, co-founder of Lola, Yuri Kim, partner at Forerunner Ventures, and Sandra Olin, founder and CEO at KiwiCo. Make sure to check it out if that is of interest to you. For now, we are going to bring back out a familiar face and another familiar face and a brand new face. So please welcome to the stage co-founder and CEO of Brex, Enrique Dubagras, co-founder and president of Clearbank, Michelle Romano, and your moderator for the third time in a row, Kate Clark.
Hello, welcome. We're happy to have you guys here. Two of the fastest growing fintech startups, I think, constantly brought up to me amongst VCs and founders. I think you guys have in total raised $500 million in venture capital funding. But there is an elephant in the room that I want to address before we get into the conversation, and that is Stripe. So if you guys pay attention to the fintech ecosystem, you've noticed some news coming out of Stripe. I mean, of course, you two are well aware. I want to start with you, Michelle.
Yeah.
Stripe launched something called Stripe Capital a couple of weeks ago to provide financing at a flat fee to their thousands of existing customers. So maybe you could explain sort of how that differentiates from Clearbank and what you provide.
Yeah, of course. And so Stripe's been a great partner of ours, and we kind of knew this was coming. And at the end of the day, like, Sequoia didn't go out of business because Andreessen launched. And so I think it's kind of losing sight of the fact that it's incredibly difficult for founders to raise money for their companies. And so my background was I had bootstrapped 5 different companies before this, ended up selling one to Groupon, and then getting asked to join the cast of the Canadian version of the Shark Tank television series. And it was there that I kept seeing all of these founders give so much of their companies away to basically go buy Facebook and Google ads. So the first deal was actually done on the show when I remember telling a company that I would just give them the $100,000 that they were wanting to give 20% of their company up for. And I said, look, give me 5% of your revenue until you pay me back $106,000. And so this really wasn't dead. Like, I wasn't charging very much for my capital, but there was no personal guarantee, something we both share. There was no fixed payment timeline or compounding interest. It was truly like, if you were using my capital to go buy ads, I get paid back a little bit faster because that was a revenue-generating activity. And if the business slowed down, I just wait it out. And so I think, I don't think we ever expected there to be this much demand for our product. Like, we'll invest $1 billion into 2,000 different companies this year. And I think that's because 40% of VC dollars are now going straight to Google and Facebook, which means founders are using the most expensive capital, which is equity, to do something that by definition is repeatable and scalable. And I think that's kind of the differentiation there.
And I want to talk more about that, but first, a couple days after Stripe launched Stripe Capital, they launched the Stripe corporate card, which is actually pretty similar to what Brex offers, which is a credit card for startups. So my first question for you is, did Stripe copy you?
So, we knew it was coming for a while, between venture capitalists in the Valley, we always hear this stuff.
They're gossiping.
Yeah. The similarity was quite surprising, and let's put it like that. But I think that, for us, I like to say this, there are 44 banks in the US that are worth over $10 billion each. So it's different than companies that have network effects. Financial services is a kind of, non-winner-takes-all industry. So, I think they can be successful, we can be successful, and, Amex and Chase are going to be the ones that are going to lose the most share.
Are you concerned, though? I mean, Stripe is a $35 billion company. They have thousands of customers. They've been around years more than Brex. Certainly a big threat.
Yeah, I think that, every time an incumbent kind of launches a product, the insurgent has to compete. And, for them, I think it's the 8th product out of a lot in a big global battle with PayPal and Adyen and like all these guys. For us, is our entire life. We're going to focus all our life and attention now on 2 products, which is Brex Cash and Brex Card. And, we think we can do a better job there.
So not only are we seeing competition from Stripe, though we do see a lot of startups kind of launching in the space. I mean, I think since I've been covering Clearbank, I've certainly noticed, just the other day, a $200 million round for Circle Up, which I think provides capital to D2C brands. Similarly, because these companies are trying to raise VC and they're losing so much equity. I mean, did you expect to see so much happening just in such a short period?
Yeah, I mean, the space has blown up, but I think that the challenge has always existed for founders. And I think one of the things we're not talking about, and we have a lot of data advantages that I think will be that, data has told us so many interesting stories about these companies. I mean, we've backed 8 times more female founders than the VC industry average because we're literally just looking at unit economics and data and finding that. The other stat that I find crazy is that 80% of venture dollars are deployed in 4 states in America, California, New York, Massachusetts, and Texas. For us, we've deployed in 43 different states. And I think ultimately what's happening is that no one's talking about how dilution is at an all-time high today. Like, if we looked at this recent crop of IPOs, most of the founders owned less than 10%. When you looked at when Bill Gates took Microsoft public, he owned 49% of that company. And so you kind of wonder, like, is there a PayPal mafia if they all own 2% of the company? And ultimately, I think that's probably reached a peak. And what's driven that is acquisition costs, which I don't think people are fully appreciating, is that technology used to be a huge moat. It was really difficult to build a website and set up servers and do all that. But now that that's so simple, it's really about acquiring as many users as possible, which led to bigger and bigger rounds, which led to more dilution for founders. And ultimately, I think that we're going to have to separate those two things.
I mean, you both raised quite a lot of venture capital, though, yourselves. I mean, in total, Brex has raised $300 million?
I think 380 or something.
Okay, yeah. So you've raised a lot of money. At this point, how much of Brex do you own?
So, we don't disclose the ownership percentage, but we definitely suffer dilution over time. I think we were always fortunate by being second-time founders in a big markets to, and a lot of trust from investors to reduce dilution over time. But we definitely talk to a lot of founders, and they have exactly this problem, which is, I've been in business for 4 years. I own like 3% of my company. I don't know what to do, right?
Right. Yeah. I mean, one can assume just because you've raised so much so quickly that you may have suffered from some of that. Are you unhappy with the amount that you own?
I'm very happy.
You're happy. Okay. All right. That's good. Would you say that venture capital is broken?
The way that I see it is that, and we get this question all the time, we're like, are you trying to disrupt VC? And there's part of that's true, but I think I would look at uses of capital. Like, VC used to be true risk capital, right? You want to go like solve a crazy disease or hire 100 data scientists to do something, like true 0 to 1 risk, where this whole thing could be worth nothing at the end of the day. Like, that's equity level risk. But like, come on, if you're investing $1 into Facebook and know that you're getting $4 in sales out, like, that's not true risk capital anymore. That should be funded with a different asset class, which is what I think we can build. And ultimately, I think a lot of VCs saw that as well, is that there can be different asset classes depending on what your use of funds is.
But what about this diversity issue? I mean, you already brought it up once. You've already funded so many women using this model, and people from states that are relatively untouched by venture capital funding.
Right. Venture capital is a human-to-human business. It is me getting to know you, understanding what is incredible about your business, and taking that bet. And human-to-human businesses can only expand so quickly. It's kind of bizarre, because this is the entire reason we're in technology, is because we get this instant scale that comes with being able to do that. And so when we built our system, we had to use data science and AI to effectively do what VCs were doing on the LTV to CAC and the unit economic basis, but do that at a lot more scale. I mean, the other thing is, like, there was 9 states last year that had 0 companies that got venture capital funding. I mean, this is America. The logical conclusion of that is that there was no good entrepreneurs in those 9 states. It's that the system, venture capital, hadn't reached that far. And so I think that that we can be a little part of that solution. And I mean, we're both serving all of these SMBs, which are half of the GDP of America. Like, we got a lot of ground to cover.
Right, certainly a big opportunity there. Let's rewind a few years, though. I want to talk about Brex going through Y Combinator, which was 2017?
Winter 2017, yeah.
2017, so 2 years ago, 2.5 years ago, you entered Y Combinator as a virtual reality startup.
Yes.
So what was the thinking? What kind of VR startup, first of all, were you hoping to build? And at what point were you like, I'll do a fintech instead?
So, we had a payments business in Brazil before, which is a payment processor in Brazil. And we sold that company, moved to the US, and we were tired of fintech. We were, traumatized by the regulation, all these big banks, and everything was so hard. And we got to Silicon Valley, and we're like, we're in the bleeding edge of technology. Let's build something very bleeding edge. And that was VR at the time. A little bit in, we were like, nope, this is really hard. Let's go back to our fintech thing, which is a type of hard we already know.
Right.
And
I think you know versus the devil you don't.
Exactly. And I think the story of the foundation of Brex today, I can actually evolve it a little bit, because this product that we announced today was actually the first product we thought about doing.
Okay.
And we thought about it, and we're like, well, Brex, it wasn't called Brex at that time, and neither Cash, but this product that helps startups, keep their money and make payments. But at the time, we were like, who is going to give us their money if they never heard of this Beyond thing and Y Combinator?
Probably good thinking.
It makes no sense. No one is going to trust us. So that's why we decided to go with a strategy of building, a charge card before, in which we're building a brand by giving people money, and then later on we could actually, help them and take their money.
And for you, Michelle, you and your co-founder, Andrew, at what point did you realize that you were so passionate about founder equity that you wanted to build a business around it?
The funniest part is me and my co-founder, Andrew, were totally different on this issue. I mean, he had raised a ton of venture money for 3 different companies before. I had bootstrapped 3 different companies before. And so he kind of understood how hard it was. He's like, look, I basically got hired. I had to spend 3 to 6 months on the road. Every time a founder raises money, even if you have the best company, you do 100 meetings and get 90 no's from incredibly intelligent people. Every single one of those hurts in a different way. Mm-hmm. And so I don't think any of us go into business. I mean, you were there being let's solve the problem that every founders have. I'm sure you didn't start Brex to go raise a bunch of money and do 1,000 investor meetings. And so I think that's how we think about if we can just make that a little bit easier for every founders, we can actually empower way more people to be founders, because it's still one of the biggest gaps is how do you get enough capital to get big?
So since you have both grown so quickly, I want to know, just as human beings, what has been the most difficult part for you in building these fast-growing, fast-scaling businesses?
I think for me, the most difficult part is probably, it's a mix between, I would say, the pressure and the people aspect. So, when we raise at these really high valuations, everyone is like, oh, wow, we raised at these super high valuations, right? But the way it kind of feels is more like, oh, wow, now this company has to be at least $10 billion before anyone is happy.
Yeah.
So I think the handling kind of the pressure and expectations from, everyone is quite personally tough. And I think from the outside, it seems like you're on top of the world. But in there, when everything is breaking and all your employees have a lot of expectations on you, it's, it's a lot of grind.
Yeah, I mean, it's the founder journey is at its best incredibly messy. I always say that, in any given week, there's going to be 2 things that are going to blow up. I'm going to have no idea what those are going to be, but it's going to be how do I fix these now? And I think, I share a lot of that. There's a lot of expectations. There's a lot of pressure on knowing what's going to happen in the economy, what's going to happen what's going to happen with every competitor, that ultimately rolls up to you. And I think probably what's hardest as we've scaled for me is I've always run little companies where I have really deep relationships with the people I work with, and now there's just as you scale, I mean, we added 100 people last quarter, so there's just less and less of that that you get to have. And so, we got to figure out new systems to communicate and create those relationships, but it's not easy.
So in the 2 years that Brex has been around, and for much of the 4 years that you guys have been around, people have been talking about the threat of a downturn.
Yeah.
I mean, it seems like any day now there'll be a recession. At least that's how it, people talk about it. Yeah.
One tweet away, one something away.
Exactly. So
we could all sneeze, right?
Yeah. So obviously you guys do rely on startups existing in the first place and raising and spending money. So how do your business models work in a recession?
So I can take it first. So in our case, if someone actually tells you they know exactly how it's going to be in a recession, they're probably lying, because those recessions are completely different, based on how you look at them, right? They had very, very different aspects to it. So there's only so much you could do. So we have basically 3 things. One is our underwriting model is real time. So we're re-underwriting every customer every day. And the way recessions happen, they're not, hey, today's a recession. Now, the stock market may go up and down, but the spending and the defaults and all the things that actually impact our business, they're more gradual over time. So I think that's the fact that our underwriting model is re-underwriting every customer every day is a significant advantage that we have. The second thing we can do is raise a bunch of money and keep it in a bank account for safe days, which we do. So, a lot of people ask, oh, why did you raise so much money? We don't burn that much because we have kind of a good business model. But we always have a lot of money in the bank for, if someday this so-called recession hits.
Right, you're building a war chest.
Yeah, we have it there, right? And I think the third thing is just being very mindful that it may happen and having your plan in case of okay, if this happens, what will we do? And have it all planned out.
Yeah, I think I share a lot of the same views. I think there's 2 things that are really unique about where we are in the market today. So first of all, we've been on the longest bull run in a long time. And the second critical fact is that employment is at an all-time high. And it would be highly unusual for us to get a consumer-led recession when employment's at an all-time high. What's probably more likely, because literally, you look at the stats, people are coming out of the woodwork that we didn't think would have jobs. These numbers keep going up. But what could happen, and what's probably likely, is that this is an investor-led recession. Equities take a tumble, and ultimately what that typically means is VCs pull back. And so we think that there is going to be way more great companies that we can fund if some of the VCs stop writing checks. And the second thing that I think a lot about, and one of our investors was the CFO of Google during 2008, and he was pretty clear. Ad prices dropped by 20 to 30%. And so ultimately, if you have capital and if you know what you're doing and have those conditions happen, I think there's a situation where some of these companies could do quite well. And we share the same view. Obviously, we raised a lot of capital this year because if you have capital in a recession, I think that there can be some really good companies we can back.
So are you heading back out to the market to raise some more money?
So, we talked about this in a panel that we did at the office. I think like growth stage companies, they're always raising money in some sort, right? So, if the time comes of the right investor is not when we need the money, it's more when it's opportunistic.
So you are raising then?
So we're not actively going out and raising money, but we always keep in touch with a lot of investors.
Fair enough. Stripe, right after they announced their news, they announced a huge capital infusion. So I think often we see companies launch these big new products, and then that follows a whole fresh new round. So we'll be keeping a close eye out. But I'm also curious, have you been approached much by companies looking to acquire Brex?
Oh yeah, all the time.
Oh yeah?
Yeah. We always get the head of corporate development from some big bank or big
wants
company
to have coffee
emails.
or something.
Yeah, wants to grab coffee. And for us, we're pretty clear, like we're never going to sell this company. And the reason for that is we think we can have so big of an impact in this industry that's just ripe for disruption. And I personally don't like starting companies. It's really hard. Like, you know how it is. It's like very grindy, and no one wants to work with you, and no one wants to give you money. You get 1,000 no's. It kind of sucks. So, I like running companies, and Brex is doing really well, so I want to keep running it for a long time.
So maybe in 6-7 years, we'll see a Brex IPO?
Maybe.
And what's the long-term vision for Clearbank?
Yeah, it's the same thing. Like, it's such a grind, and we just found such good product market fit. I mean, I have worked on so many projects with so much effort that didn't work for so long in my career. When you have something that's really working, you're like, okay, let's take this all the way to the moon. And so I think we're just going to keep trying to be innovative and grow this thing out. I think there's a lot of founders that could use your product.
And Andrew, your co-founder, did compare Clearbank to SoftBank at one point. In an interview with me, he said, we want to raise billions and billions. We want to be like SoftBank. Is that really what you want to be like?
No, I think what he was saying is look, SoftBank has transformed these growth rounds, and certainly in many ways replaced what was earlier stage IPOs. And in our minds, like, there is just half of the GDP of America is produced on SMBs, and largely those have been funded in incredibly poor ways because we didn't have good data. Like, make no mistakes, banks didn't take personal guarantees because they wanted to be mean. They actually just didn't have the tools and the data sets and the automation to underwrite this in a way that actually made sense. And so if we've cracked that nut, we think we have a massive market, not only in America, but globally, because if you think it's hard to get funding here, it is way harder. I mean, this everywhere else on the planet.
Yeah, Brazil is really hard.
Well, one thing I want to ask, we're almost out of time, but I do want to ask, you mentioned SMBs. Of course, you guys are both supporting SMBs. Brex recently opened a restaurant, and I'm told it was because you wanted to understand better how SMBs operate. Is that really the thinking behind opening a restaurant? Or to help us understand why that was something you needed to do.
Yeah, I think the restaurant had multiple reasons. I think the first reason was we have our members lounge right on top of it.
Yeah.
And we wanted to do something for that community of South Park, and that was a restaurant that everyone loved, but just happens to be in the venture capital nerve system of San Francisco, which is super relevant to our business, right? So when we were founders, we went to South Park all the time and had meetings there all the time. So it made a lot of business sense as well. And I think a bonus is that, as we expand to more verticals, we get to understand how an SMB operates, right? So we can see what are the struggles and the issues, and we get to learn from it.
Is it fair to say that perhaps you've raised so much capital that you're kind of just throwing it around and able to open a restaurant? I mean, that's certainly out of the norm for a fintech startup.
Yeah, I think, a lot of times, people are like, oh, credit card just for startups. They go out of business. That's so dumb. And, now they're copying us. And then they say, oh, billboards, they're just blowing money. That's so dumb. And then, I'll think
So we're going to see a bunch of startups opening restaurants? Is that what you're saying?
I think that people will see that the restaurant isn't like, oh, it's blowing money, as they thought the other things were as well.
Okay, fair enough. All right, well, we're pretty much out of time. So thank you both so much. It was a great conversation.
Thank you so much.
Thank you.
Awesome job. Okay, on the Q&A stage at 4:15, we're going to have Getting Into FinTech with Enrique Dubagras, Michelle Romano, and Angela Strange, who's general partner at Andreessen Horowitz. So if you just absolutely have not gotten enough of Enrique, that's where you need to go. In the meantime, we're going to be talking about beef, or not beef. Please welcome to the stage from Impossible Foods, founder and CEO Patrick Brown, and your moderator, John Schieber. Warm welcome, please.
Hey, y'all. Thanks for sticking around this afternoon. Thank you, Pat, for coming out. There are any number of things that we can talk about, but I think the first thing to talk about is really why you're doing this. You had an incredibly successful career as a geneticist and a professor at Stanford, and now you're taking on the meat industry. Why?
Pretty simple. I mean, I about 10 years ago, when I was trying to figure out what I could do next that would have the biggest positive impact on the world, I very quickly realized that by far the most destructive technology and the most destructive industry on Earth is the use of animals as a food production technology. And I was, in retrospect, kind of embarrassed that I didn't already realize this, but at the time, the UN Environmental Program had actually already published a monograph that came to that conclusion. And at this point, I would say there's probably a significant majority of all environmental scientists would say the exact same thing. This is by far the most destructive technology on Earth. Huge source of greenhouse gas emissions, biggest user of water of any industry on Earth, biggest polluter of water by far of any industry on Earth, occupies a land footprint that's approximately half of Earth's entire land area, bigger than North America, South America, Europe, and Australia combined. Land actively in use every year, raising animals for food, at a tremendous cost to biodiversity. It is overwhelmingly the biggest and virtually the only driver of a catastrophic meltdown biodiversity that we're experiencing right now, where the total number of living individuals of mammals, birds, reptiles, amphibians, and fish, and probably insects as well, is less than half today what it was 40 years ago. In fact, it's about 60% lower total number of living wild animals on Earth compared to just 40 years ago. And if you read the World Wildlife Fund report on that, it's very clear that it's virtually entirely due to our use of animals in the food system. The problem was, I just want to say one more thing. The problem was that people are not going to stop wanting to eat these foods. So you're wasting your time if you're trying to get people to change their diets. And that meant you had to figure out a way to make foods that delivered everything those consumers want.
There was an article in the New York Times today where someone was talking about the meat industry, and an expert was quoted as saying, if everyone gave up hamburgers tomorrow, the same number of cows would still be raised and fed. So why start with ground beef if ground beef really isn't sort of the driver of why people are, of what people are actually sort of consuming meat for?
Well, I didn't read the article, but I'm surprised by that conclusion because more than half of all the beef produced in the U.S. Today is sold as ground beef. And about 25% of the beef produced in the U.S. can't be sold in any form other than ground beef because it's basically too unappealing as a whole cut. So, in fact, ground beef sales are a very important component of the business model of the beef industry. And the goal that we have is to reduce and eliminate the economic incentive for covering the entire friggin' planet with cows. Right now there's 10 times more cow biomass on Earth than the total biomass of every wild land vertebrate that's still alive. So this is what we're doing right now. Our goal is to basically eliminate the economic incentive to do that anymore, to keep tearing down the Amazon to create more room for growing cows, because demand goes up, the Earth's not getting any bigger. The only way to produce more cows is to deforest the Amazon. So that smoke you see coming out of the Amazon is the secondhand smoke from your burger. I think this is a very good strategy, and I would even say that because the beef industry has pretty crappy economics, I don't think it requires a huge amount of disruption to their business and to their economics to significantly reduce the incentive to keep growing the cow herd size.
Well, but the issue there is that ground beef is very, very cheap as well. Can you compete on a cost basis with this stuff at some point, and how do you do that?
Oh, absolutely, absolutely. I think the starting point is to realize that there's a structural advantage to the way that we're doing this. And it's represented in the fact that, for us to produce a burger, and we have a publicly available audit LCA on this, requires a low single-digit fraction of the land area, like considerably less than a 25th of the land area to produce a cow, about an eighth the water input, 1/12 the fertilizer input, and substantially because you need so much less land and water and so much less resources, also less labor input. Okay, well what that means is that the fundamental economics are vastly superior. The only thing we don't have that they have is scale and a pre-existing infrastructure. But at scale, there's just no question that we're going to be better.
I mean, that's a pretty big benefit for the industry. Like, how much does it cost you to make an ground impossible meat versus the same size of burger meat?
Well, I can't give you the exact data because it's kind of confidential information. I mean, I would, but my CFO would kill me. So, but I can say that basically, our product is being sold in lots of mass market places, Burger King, White Castle, Fat Burger, tons of these burger chains that sell their burgers at a price that's affordable to mainstream consumers. It's great for their business. It's hugely profitable for them, and we're not losing money on those sales either. So you can draw your own conclusions, but basically, and we're at a very early stage. 3 years ago, we were operating out of effectively a garage,
right.
And so we've gotten our economics to the point where we're competing in this mass market, low-cost burger market, and we've only at a very early stage in bringing our costs, optimizing our costs.
Speaking of fast food, earlier this week on Monday, McDonald's launched their pilot test with the PLT, the plant lettuce tomato burger, using Beyond Meat's stuff. Does that preclude you now from selling to McDonald's, or how does that sort of pitch work with?
I don't want to talk about like the dynamics of that business, but I guess what I'll say is the way that we think about this problem. First of all, is the only competitor we care about is the incumbent industry, which right now owns 99% of the market. All the plant-based producers put together are like 1%. So it'd be ridiculous for us to be trying to compete in that space. But secondly, the way that we think about this is that our whole focus is on just making awesome products that don't just, we're not trying to outperform veggie burgers, we're trying to outperform the cow. And if we focus on that and produce the most delicious, healthiest, affordable ground beef on the market, I don't think we're going to have to beg McDonald's or anyone else to put it on their menu.
Right. Speaking of the product portfolio, I was in your offices yesterday and I tried some of the fried chicken that y'all were working on out there. I was wondering, when you think about the product portfolio and what comes next, how do you make that calculus about what the roadmap should look like, given how much demand you have for the ground meat substitute right now?
Yeah, that's a very complicated question. I mean, it's a multidimensional optimization problem. First of all, we are trying to choose products. Our goal is to, solve the biggest environmental problem that our planet has ever faced, which is the catastrophic impact of this industry. And so that requires us, first of all, to be able to make any product that is currently providing economic incentive for this catastrophe. But we also, chose beef deliberately because beef production is by far has by far the most destructive impact on the environment. That's why we're pushing on that right now. Meanwhile, our future is in our R&D operation, basically. What determines our success, like I say, is not, we have awesome teams, sales, marketing, finance, every aspect of business, and we have to be great at manufacturing, all those things. But ultimately, it comes down to we have to make products that consumers prefer to the products that come from animals for the purposes for which they're currently using the animal products. So it has to, in that niche, do a better job. And that's only going to come from R&D. And that's why we have, we have 120 people on our R&D team. We're going to approximately double it. And these are some of the best scientists in the world. Because this is a really hard problem, and it's so high stakes. But we want to have that, the know-how and the technology platform to be able to make this entire gamut of products. And then it comes down to other factors that just includes our bandwidth for scaling manufacturing and just scaling the team and so forth.
What's the thorniest problem that the R&D team is wrestling with right now?
Wow. Well, I guess what I'll say is that we figured out, I would say, like 95% of the flavor chemistry of meat and animal tissues relatively early on. And a lot of it comes down to, heme as the catalyst that converts these simple precursors, amino acids, sugars, and vitamins and stuff like that into this unique explosion of aroma with meat and the bloody flavor and all that stuff. But there's still a ton to learn there, too, because we don't want to just make something that, is a good version of beef flavor. We want to figure out what's the absolute pinnacle that we can deliver that outperforms anything a cow can do, and a bunch of other stuff. So there's tons more work there. We are looking at, and then texture is a whole other issue, and it's equally challenging. And we have a lot of people working on developing materials that are from sustainable plant sources that have a great nutrition profile and have the physical properties and juiciness, texture, asymmetry, and stuff like that of all these animal tissues. That's a hard challenge. That's a very material science challenge that's very hard.
When you say juiciness and texture, is that trying to get at something that approximates like a muscle meat, like more like a cut of steak?
Oh, sure.
Yeah.
And we've made steak prototypes. We're not not near scaling them, but ultimately that's something I think for us to really take away the economic incentive for growing cows, we definitely have to have something that can compete against cow-derived steak. Well, so that's. But there's a ton of these problems to solve, and the fact is they're all hard. And then there's, but they're all solvable.
Right.
I knew that when I started, and I know it even more firmly now that these are hard problems and they're solvable problems. And we're also looking at our supply chain. Like our goal, if we're successful in 10, 15 years, we will be responsible for a substantial fraction of the world's, not our impossible foods, but us and the people we enable to food supply, which means we have to really think about food security. We have to think about what plants should we get proteins from, and how do we optimize, how do we create a system that is optimized for food security, optimized for, thinking about community scale and stuff like that. And we have work going on that because that's such a long lead time. We need to be working on that now.
So there was a lot to unpack in that answer, and there are sort of three things that I'd like to touch on. You mentioned nutrition, making a product that's more nutritious. Every time I asked someone or told someone that I was going to be talking to you, they wanted me to ask you about whether the product is healthier than a beef burger, and the push now is that it's not healthier at all than a beef burger. So how do you respond to criticism about the fact that the Impossible Burger is not good for you?
Well, we basically make all our nutrition information and everything we know about our ingredients freely available to anyone on our website, and answer any questions about it, and then you can decide for yourself. But I would say that one of our core principles is that we are never going to sell a product unless we have critically reviewed all the data and believe that it is better for the consumer than what it replaces. We are not making health claims for the product, but we internally have a very high standard for that. So our product has matches the protein, matches and actually slightly exceeds the protein quality in terms of the digestibility and amino acid content of a cow burger. It's lower calorie, it's lower fat, it's lower saturated fat. It has the same iron, it has the same bioavailable iron, the kind of iron that red meat has that makes it appealing for people who need a good iron source. It has the same micronutrient profile, and we're constantly optimizing that. So, I mean, consumers have to decide for ourselves, but I can, say with confidence that this product is someone who's currently eating the cow product is no worse off eating our product, and in many ways better off. And the thing to keep in mind also is that we're not trying to make the food to fulfill all your dietary needs in one burger. We're trying to make a product that will be better for the consumer in that niche in which a burger occupies, which will not be replaced by a kale salad or whatever. It does a better job of delivering nutrition to the consumer for a product that has to perform as a burger.
Now, you've also said that you've talked about the need to scale dramatically on the supply chain side. You're adding more R&D folks. And you've also said that you plan to take a double-digit portion of the beef market within 5 years and then push that industry into a death spiral. It seems like you would need a lot of cash to do that. The other thing is, so does the next financing event come from a public offering? Are you looking to IPO? Is that going to happen soon? Or how do you get the money to achieve these goals? Well, first of all, you're right. It's a hugely ambitious goal. It will require a lot of resources and so forth. And we'll have to get those resources either from investors or from getting our profit margins to the point where we can scale at the velocity that we want to scale with the profits we make from our business, which it'll be a while before we're at that point. So we'll definitely have to raise more money. I would say we are not looking in the near-term future toward an IPO. As anyone here probably knows, there's a lot of complications that come with that. We have our hands full growing our business, doing our core job, and we have great investors, and we have a lot of private investors who are willing to bet on us and so forth. So at this point, it's not something that we need, and we can just take our time about it, basically. And so when you think about what comes next on the product roadmap, if you look out 5 years, what does the Impossible Foods product portfolio look like? I'm not being evasive because that's a very complicated question, and it depends on a lot of things that how things proceed in the future. We're building, in the R&D space, we're building the capability and advanced prototypes for a lot of products that would compete in that space. But the thing about scaling right now is that scaling manufacturing it's a big deal. It's totally different from scaling an app or something like that. Like you have to right now. If we believe as we do that our sales are going to be like 10 times what they are today in 18 months or so, that means that we have to be investing right now to grow our manufacturing and supply chain, not just a little, but by a lot. Okay, that's just kind of that's a huge challenge just for our existing product, where we have very strong demand signals that would justify that.
and being a small company, you know, we need to focus on doing that really well. And when we have more resources, I think, you know, being able to launch new products, we want to have them all ready in R&D. So when the opportunity arises and we have the resources, or when there's, you know, a huge market opportunity that you know, justifies it, we're ready to go.
Would it not make sense, if that's the goal, to work with the traditional meat industry? They have a bunch of money, they have a bunch of infrastructure, they know how to scale, they have a logistics supply chain that's already worked out. If a company like that was to make a credible offer to acquire you, or any company that's got scale, you know, massive amounts of money, would that not be a more effective route?
Well, first of all, in terms of being acquired, I mean, let's put it this way. We're not going to let ourselves be acquired by anyone who we don't believe is as firmly committed to our mission as we are. And so far, we haven't seen anyone who meets that description and is willing to put all the same resources into this that we would go after and get. Right now, I would say absolutely the current players in the meat industry don't even come close to meeting that bar. So that's not of interest. They have way too much to lose from our success. And I don't think they wish us well. In terms of working with people who are connected to that industry, well, we just entered into a partnership with actually the manufacturer that I think is responsible for producing most of McDonald's, you know, beef burgers. A large fraction of their business is serving the, you know, animal-based meat market. But the interesting thing is that their technology and their business model is agnostic. So in other words, it's not like our success would come at the expense of some other part of the business. So we look at that differently, basically. We don't want to put our fate in the hands of someone who has any kind of conflict about our success. Right. But if it's someone who's engaged in the food industry and the meat industry or whatever, but where there is no such conflict, like it's all upside for them, and therefore they have no incentive to put risk on us, right. Yeah, that's great.
We are out of time. I could talk to you all afternoon about this stuff. It's fascinating. I really appreciate it, sir.
Yeah,
thank you so much. Thank you all for listening. Thank you, sir.
Great.
Companies transition to using microservices in their architectures, more APIs are created across the organization. With this increase, it can become more challenging for developers to find these internal APIs and reuse them when they're developing new software. That's where Rapid API for Teams can help. Rapid API for Teams enables development teams to publish their internal APIs into a private workspace. Developers can find any internal API, view its documentation, test it, and connect directly, or collaborate and share information about the API right in Rapid API. Team members can also subscribe to any public API available on the Rapid API Marketplace, and the entire team can see and use that subscription. This way, you only pay once for any API your team uses. Rapid API for Teams makes it easier to share and collaborate on APIs. Get started today on rapidapi.com/teams.
Our teams love building companies that create value and make a difference. As well as our investments in companies such as Tencent and Mail.ru, we're building meaningful global businesses in online classifieds, food delivery, and payments and fintech.
Bob and the team have great experience in operating and investing in large companies in India, be it fintech, be it commerce.
Because they are global and they understand consumer business, they have a very helpful and specific advice that they can give to us.
They think like entrepreneurs. They're a fantastic partner.
Our big vision at Movely is to make life better for 1 billion people, and I believe Prosus is the perfect partner to help us achieve our dreams.
Ladies and gentlemen, please welcome TechCrunch senior writer and your Battlefield host, Anthony Ha.
So I apologize, I do not have a world-famous movie star coming on behind me, but I have something better, not almost as good, better, I screwed that up, better, which is awesome startups, specifically 4 regular Battlefield startups and 1 wild card, which I will explain when the time comes. Before we do that, though, I have to bring out our expert judges. First up, we have Shaheen Farshi, who is a partner at Lux Capital. He's passionate about AI, robots, space, cars, engines, pretty much anything you'd find in an episode of Star Trek. Next, we have Lindy Fishburne, managing partner at Breakout Ventures and founder of Breakout Labs, the seed stage program for hard science at the Thiel Foundation. For the last 8 years, she's been investing at the intersection of technology and biology. Next, we have Pete Flint, managing partner at NFX. Prior to NFX, Pete founded Trulia, a leading online real estate company. Next, we have Roger Lee, a general partner at Battery Ventures. Before joining Battery, Roger spent 10 years as an entrepreneur and operator, facilitating the first ever retail transaction on the internet at the age of 22. Next, we have Kara Nortman, a partner at Upfront Ventures. Before Upfront, Kara co-founded the children's e-commerce company Moonfire, and also spent 7 years at IAC. And last but not least, we have Hiro Tamura, a partner at Atomico. He focuses on consumer, financial technology, and software, as well as leading Atomico's investments in late-stage venture. All right, as Hiro takes his seat, let's give it up for all of our awesome judges. And now it is time to bring out our first startup. That startup is OmniViz. Presenting for OmniViz are Dr. Catherine Clayton and Dr. Lin Chang.
Cholera has no borders. As a PhD student in engineering, I learned that in Haiti, there was no cholera for 100 years until the earthquake happened in 2010. After the disaster, cholera spread through the country, creating outbreaks and deaths to this day. But Haiti's not alone. There are 5 million cholera cases every year in 41 different countries. And this leads to $3 billion in losses from productivity, human cost, and therapy. It takes 7 days to detect 4 cholera in water. From the time a lab sends somebody out to get to the sample, bring it back, do isolation, enrichment, polymerase chain reaction, serology, TCBS streaking, and a secondary confirmation. This is a long time that takes expertise, and it's expensive. But what's worse is that this leaves communities vulnerable to the water that they drink, that they cook with, that they bathe in. So I decided to solve this problem. I took my PhD technology and research, and I started OmniViz, where we put the power of the lab in the palm of your hand. And we do this by detecting 4 cholera in water anywhere in the world in under 30 minutes. We're revolutionizing disease detection. And we do this with an easy-to-use system. We have a hardware component, disposable test kit, and a smartphone that works seamlessly together to detect cholera accurately and affordably. The hardware acts like the portable laboratory. It has a heating unit in order to do DNA amplification, and it has microscope lenses to see down to the nanoparticle level. The test kit has reagents inside for DNA amplification. And when the test kit and the hardware come together, we amplify for the cholera toxin gene. When that's amplified, we create longer strands of DNA, and the solution becomes more viscous in nature. And that's exactly what we're measuring, is the change in viscosity that's occurring. We have 2 pending patents for this viscosity technique, and we're more sensitive than the status quo. We also have the smartphone component. We're able to see where and when cholera has happened and notify people so that they can come in and eliminate the outbreak before it's too large. Move to demo. If I'm a field worker, I take this entire system with me out to a water source. I fill the disposable test kit with water, and I launch the smartphone app. I begin the test. It tells me to start heating the sample, and during heating, that's where DNA amplification is taking place, and that change in viscosity is occurring. But after the heating, what it says is to move that test kit over to an imaging region. We take a video, and when we're taking that video, what we're looking at is the movement of what's happening inside. We analyze that with our proprietary algorithms, and from that, we're able to see the result. In this case, it's clean water. We can also see the GPS coordinates and timestamp. Move to web page. Also, somebody can go onto the web, go onto our portal, and see where and when cholera is happening, and have these large data sets. Move to presentation. Move to presentation. Thank you. When the solution is contaminated, it looks like this, but we couldn't bring cholera onto the TechCrunch stage today. What's happening in the background is we have a contaminated solution where things are moving very, very slow in nature, or a clean solution where things are moving very, very fast. I inspired my PhD advisors to join me as founders of OmniViz, and our team together brings expertise in microfluidics, global health, biotechnology, and consumer electronics. Rapid tests, which are our competitors, are very, very inexpensive, but they are highly inaccurate, whereas cell culture methods are very accurate but expensive. We do a B2B sales model where our hardware is a single-time purchase and our disposable test kits create the recurring revenue as their single use. And we have letters of intent from 5 of the largest companies and NGOs within the cholera space. But we're not stopping there. Cholera is a $2 billion market for water detection and surveillance. But the word OmniViz means to see everything. So by using our novel IP, we change out the chemistry in our disposable test kits, and we can detect for many diseases in many different markets. OmniViz mobilizes the lab, rapidly detecting pathogens, saving lives. If you're an NGO, a water quality expert, or a research hospital, go to omniviztech.com. Thank you.
Judges.
Well done. So do the NGOs and the other customers that you're speaking to have a budget or a line item allocated to these types of in-field diagnostic and testing devices?
I would love to hand that question to Lynn.
Let's see if this works. So yes, we're not inventing a new need. These are customers that are currently already water testing. They're just taking a much longer time, costing them much more money. We're expediting it, and we're adding one really important feature, the data. So this allows us to get in front of the infectious disease. We can alert people ahead of time before anyone's actually fallen ill.
Whoever feels it in their heart.
Can you talk a little bit more about the validation testing that you've done with your specificity in the 7-day test? And do people feel the need to do yours quickly and then still do the other as a backup, so they have to pay for both?
So what we do is we work with the largest cholera hospital in the world. They're known as ICDDRB, and they are located in Dhaka, Bangladesh. So when we measure things and when we do our pilots, we want their gold standard to be our stamp of approval for our test, because we respect what they say and we know that they are the best and most original researchers within cholera. We have tested over 400 tests to date on sensitivity and specificity and accuracy. We have an accuracy of 94.4%, a specificity of 95.7%, and a sensitivity of 93.1%.
So, incredible business. Can you share a little bit about how you might evolve into a platform into these other areas, and just what does it take, and kind of what limitations does the current device defined for cholera inhibit your ability to move into other areas?
So we're starting in water testing. Cholera, we want to do it right the first time. We want to help these communities, but we can see that we can change certain components in the test kit, meaning our DNA primers, and we can look for other diseases. The next ones that our market really points to is hemorrhagic E. coli, which comes in water, and typhoid. And so with those, it's a change of the chemistry. For asking, have we kind of tested these other things? Absolutely. In the laboratory setting, we've tested quite a few diseases in water and a couple in blood as well. And so we're going to be starting there, and then when we go into blood, that will be seeking FDA approval or a CE mark, depending on where we go.
Great. So congrats on all the success. It's super inspiring. Just to follow up on the first question, how much do one of the NGOs spend right now on these types of water treatment devices? And what's the process like to convince them to work with, to go away from one of the existing vendors to move over to you guys?
Right. So a single test for cholera right now takes $100. And for the lab equipment, that's tens of thousands of dollars. And then when they want to go out into the field and start measuring where they've tested these water sites, that's a GIS mapping system, and that's $2,000. We're aiming for a disposable test kit of $10, so 1/10 the cost per test. And then we're aiming for a hardware device and smartphone together to be $1,000. So half of the price of a mapping system and quite a bit cheaper than the laboratory.
But you know how much they're spending today? So pick one of the NGOs, and what would the actual budget be for this specific product? For like the water treatment product?
In-field cholera testing.
Yeah.
I'll hand that to Lynn, and she can talk about numbers every month as well.
So those numbers change so much depending on what region you're in. So let's take ICDDRB, which is the largest cholera hospital in Bangladesh. Because they have to take a water sample back to the lab. And if you know Dhaka, transportation there is a headache. So at most, they take 4 to 6 samples a day. With our product, you can do a lot more. It takes about 8 people to do this. So you're not only paying for the time and the transportation and the lab cost, you're also paying for the people hours. Off the top of my head, it's a really difficult number because cholera is seasonal there, so there's no hard number. But we have calculated that for a small customer, we're estimating 240 test kits per month. For a medium-sized customer, such as ICDDRB, they would be purchasing 2,000 test kits per month. And these are numbers that we've asked them and they've confirmed.
Hiro, you had a question earlier?
Yeah, it's great, mission-driven. What you're working on is really fantastic. I just want to get a sense of what is when you talk about Bangladesh or different markets, what is the sales kind of journey that you have to go to get your customers on board? How long does that take? Love to know a little bit more about that.
Because our founding team is so heavily academic, and ICDDRB is the most respected research hospital in the world for cholera, they've actually reached out to us. So we have a pilot partnership as well as a research partnership with them. We also have letters of intent with them. So this has been an ongoing relationship. I'm actually going back to Dhaka in about 3 weeks to complete some final studies.
And as you grow and scale, when you have to reach out, what do you envisage that motion to look like?
Answer quickly.
Yeah, sure. Do you want me to go? Okay, so right now, word of mouth, academic conferences, reaching out to RFPs, response for proposals is another big one. Putting papers out there. They found a lot of our journal papers out there in scientific reviewed articles, so that's been fantastic to have on our side.
Yeah, NPR found us.
NPR found us, exactly.
All right, give it up for OmniViz.
Well done.
We have another startup coming out. That startup is Ozone AI. Presenting for Ozone AI are Ben Coleman and Lyndon O.
Facebook told us the future is private, but the average user has no idea what data they're generating or who can see it, let alone how to actually secure their data. Data harvesters like Facebook and Google earn nearly $1 trillion a year. What is their product? It's you. Data control should be a fundamental human right, with equal data rights for all. Until now, we've surrendered this right to giant corporations. I asked Facebook for my personal data, and I found out that over 3,000 companies are following me and paying Facebook to do this, and this is happening forever. Introducing Ozone. Take back control of your data and take back the billions that big data is earning on you. How does it work? Simply sync your platforms like Facebook and Google to see all of your personal data organized in simple categories, fully anonymized and encrypted. Sorry. Ozone offers a reverse subscription model where companies you approve can pay to subscribe to your anonymized data. For each subscription, you receive a monthly payment directly into your Venmo, PayPal, or bank account of your choice. Our patented technology encrypts your data, and only you have the private key. Ozone then runs encrypted machine learning to match only the data you want to share with offers that are targeted for you. What's in it for the businesses? Pick a zip code, age, gender, and category, and Ozone will return pre-approved audiences that match your targeted profile. Companies can engage these audiences in targeted ads and direct marketing that has a high likelihood of approval, high likelihood of conversion. This is ethically sourced data that's controlled by the user. We have a simple freemium model where consumers get simple, free tools to organize and secure their personal data, and companies get pre-approved audiences and only pay for conversions, not just eyeballs like on Facebook. We've poached users directly off of Facebook and have 2 live paying enterprise customers. We're also beginning a proof of concept with a tier 1 media company that's looking to ethically source consumer data from their 100 million monthly unique users. My co-founder Lyndon and I met in the Google alumni group. We come from the belly of the beast as alumni of Google and Facebook. We've also founded and sold companies in the cybersecurity and machine learning spaces. Moving on to the demo. Here we see Lyndon is logged into his Ozone account, where we can see his real-time earnings tied to data he's synced from platforms like Facebook and Google. We can also see real-time offers and discounts based on targeted ads. For example, Lyndon can save 15% on United Airlines because he's chosen to share his travel history, including his regular flights between San Francisco and New York. Ozone uses encrypted machine learning to match offers with Lyndon's anonymized data. At the top, we see offers that are matched to Lyndon's activity on the Ozone app. On the bottom, we see offers that are matched to Lyndon's interests that are derived from his anonymized third-party data. We're especially excited to launch our intelligence portal, which shows Lyndon where he's spending his money, as well as which companies are paying to subscribe to his anonymized data. On the activity feed, we can see every Ozone activity organized by company and dollar amount. Here's where it gets really exciting. In the account slide, we can see Lyndon's projected lifetime earnings based on his own data, as well as every platform that's either synced or unsynced. This $112,000 represents Lyndon's alternative retirement savings. We're working with a tier 1 bank to connect this directly into 401k contributions. Back to the slides. There are a few companies in our space, but none have solved the privacy versus monetization paradox as we have. They either have weak security, give away too many rights, or are missing our patented technology that protects user data forever. We have a number of patents pending that give us a 2-year head start at the intersection of machine learning, privacy, and identity. With Ozone, you can take back control of your data. Sign up today at ozone.ai.
Judges.
Yeah, I'll hop in with the first question. First of all, thank you. Great presentation. I'm curious, what do you view as the initial target consumer profile? Who do you think will be the early adopter? And then what do you want to test to, I guess, drive mass market adoption?
Yeah. We're targeting the US market right now. The average internet user that's just curious, they want to see what kind of exhaust am I leaving? What data am I generating every day? What kind of advertisers are seeing my data? And how do I see it in a language that I understand? So this is basically anybody who is maybe a little bit less data savvy and would like a little bit of visibility into what they're doing every day.
So is it more of the discount shopper, you think, or more of the security-obsessed consumer?
It's probably more the discount shopper. We're targeting users who have maybe casual curiosity and data privacy, but are not obsessive about privacy practices.
And just piling onto Kara's question, has there been other attempts to do this in the past? And granted, the timing for this now may be great, given all of the kind of public attention to the issue. But historically, the two big challenges have been trying to convince people to care about it, because this is a trade-off most people are comfortable making. They give up some privacy in return for various media properties and services. And when you actually look at how much they can make, the amount of money they can make is questionable. It ends up being a handful of dollars per year type of thing. And so how do you guys think about those dynamics and convincing enough people this really is worth it, and that economically it's in their best interest?
Yeah, we're treating this as a public utility. It's totally free for users. We're trying to give them the simplest possible way for them to solve for things like data amnesia. What am I doing every day and I forget that I do these things? I kind of want to know who's following me, and we'll make that easy for them instead of having to download a giant file and sift through JSON files manually. And then beyond the free tool, we give them the opportunity to make a little bit of money, even if it's, let's say, $500 a year. $500 a year is enough to cover the cost of, say, your cell phone bill for the average college student. And it's not a huge amount of money right now, but data is growing exponentially for every user, and the privacy problem is getting bigger and bigger for every user, and this is a small step for users to take back control.
Data has shown that the value of personal data can be up to about $2,000 a year. We think it's actually much more than that when you can start engaging targeted users with specific questions, interests, surveys, actions. And so for us, we've been working to prove that ourselves in our POCs.
I think many of us would prefer Google and Facebook to be opened up, perhaps more than broken up. But you've got to imagine that there's Facebook and Google don't really want to play ball with this. So, can you share how you navigate or force them, or what regulatory change is kind of coming down to actually that they will participate in a platform like this?
We have a built-in escape hatch. So assuming that we're able to access the developer API for Facebook and Google, all we need is an OAuth token for the user. In the absence of access to the developer API, any user can still access their data. We would simplify the process for the user to basically pump their data directly into our pipelines. And if Facebook and Google were to deny users access to their own data, that's a big problem that they have, and we're happy to take advantage of that.
So you think it's doable? Or is it live and working that you can suck in all the data in real time?
Yes.
Yeah, and I'll say that we do have some strong supporters within Google and Facebook. But we also think that ultimately when they realize what we're doing, we're extremely accretive to what they're actually trying to do. People spend more time on Google, more time on Facebook, create more data exhaust, create more monetization.
We think of it as users are building inventory every day as they're using free consumer tools like Gmail and Facebook Newsfeed. And that inventory is just ported over to Ozone, and then we're operating essentially a market on behalf of the user.
Hiro?
You guys mentioned ethically sourcing, and to the extent that you could share with us your thought process where dependence or demographic that is younger come onto your platform or your service? How do you think about, what is the cutoff in terms of either age or, how do you think about,
Yeah, I mean,
where do
taking
you
back
draw
a
that
step,
line?
a big part of our platform is community. So we're going to come out with almost like a regular daily wiki in small social media kind of bites to start educating less technical users on what we're doing. We're going to follow all the same best practices as Google and Facebook as far as age cutoffs for everything, so we're not going to reinvent that. But we do believe a big part of our platform is educating users of all ages on how they could better protect what will become the largest asset of all.
Last question.
What type of critical mass of users do you have to attract the first advertisers to be paying you and making offers on the platform?
So at the previous company that I ran, I ran a vendor to a large research company that would run remote surveys countrywide in countries like Brazil and Nigeria and Tanzania. Target sample they looked for was about 5,000 to 6,000 to be able to, what they claimed was accurately extrapolate for the entire population of the country. And these are long, extensive surveys asking personally identifying questions, like, are you willing to invest more in private education for your child? Are you confident in the state of healthcare in your district, in your city? And we found that 5,000 to 6,000 was more than enough for a billion-dollar research company.
All right, we are out of time, so let's have one more round of applause for Ozone.
Thank you.
All right, let's bring out our third startup. That startup is Leo Aerospace. Presenting for Leo Aerospace are Dane Rudy and Bryce Pryor.
In recent years, companies like SpaceX and Rocket Lab have lowered the barrier of entry to space, supporting all kinds of new technologies, including microsatellites. These microsatellites can get down to the size of a loaf of bread, and they are revolutionizing how we use space to impact life here on Earth. In fact, in the next 10 years, almost half of all satellites will be microsatellites. They are tracking global climate change in real time, enabling the next generation of IoT connectivity, and even providing vital insight in the wake of natural disasters. But for the companies that use these microsatellites, getting to space is just half the battle. Because they are forced to ride alongside dozens of others, they must compromise on every aspect of the launch. To start, these customers must pick from preset schedules of launches. Often they are forced to schedule a launch up to 1.5 years in advance. Each scheduled launch also has an assigned destination. And these satellites are often forced or dropped off far from where they want to be and must spend upwards of 6 months slowly moving to their final orbit. And finally, integrating so many customers onto one launch is incredibly complex. And this introduces a number of restrictions that limit what satellites can do. Adding up all these pain points can lead to 2.5 years between when a launch is scheduled and when a satellite is operational. And while these companies are waiting, they're burning capital, deferring revenue, and adding to a growing backlog of satellites that are just waiting to get to space. This model is what the space industry calls ride sharing. Microsatellites have to literally share a ride to space. But what customers need is the experience that you and I know is ride sharing, where you can call up a ride that takes you where you want to go, when you want to get there, no compromise. And at Leo Aerospace, we are fundamentally committed to providing our microsatellite customers with a dedicated launch service that they've been asking for. And this all starts with the vehicle. Now, in creating a vehicle to provide this type of service, our first thought was to just shrink the rocket down to match the size of our customer. The problem is when you launch a rocket from the ground, you can only make it so small while still having enough energy to reach orbit. And unfortunately, at this size, it's just too big and expensive. One of the reasons for this is due to atmospheric drag. And so if you could launch your rocket above 95% of the Earth's atmosphere, you could make it small enough to cost-effectively launch an individual customer. And that's exactly what we do. Introducing Leo Aerospace's premier high-altitude launch platform, Regulus. Regulus is a fully reusable and autonomous vehicle that allows us to launch rockets from 60,000 feet in altitude. By launching at this altitude, we can reduce the size of the rocket to just half of what it would be if we would launch it from the ground. Let me show you how it works. Regulus is fully mobile and fits into a standard shipping container. A series of burners ignite, heating the air within the balloon envelope. The hot air balloon carries Regulus away from the transport truck. Regulus is capable of fully autonomous controlled ascent. A sensor suite on board allows it to ascend to its final altitude of 60,000 feet without human control. Our proprietary rotational control system activates. This orients the launch platform and stabilizes it during the launch sequence. Our first stage ignites, launching the rocket from the platform. Our first and second stages use a solid motor architecture. This architecture is safe, it's shelf-stable, and it's mass manufacturable. Inserting each satellite into its precise orbit is vital. For fine-tuned control, we use a third-stage non-cryogenic liquid propulsion system. Because we tailor each launch to an individual customer, they can begin operating their satellites immediately. And while the rocket is deploying the satellite to orbit, Regulus descends autonomously back down to the ground. Here, another rocket can be loaded for another launch, or it can be all packaged up and shipped home. With this platform, Leo Aerospace can provide a launch within a matter of weeks to any low Earth orbit and support a very high launch frequency. Finally, microsatellite customers will have the dedicated launch service they've been asking for. Leo Aerospace made history in 2018 as the first and only company to receive authorization from the FAA to launch a high-powered rocket from a reusable balloon platform. This series of successful launches validated major subsystems and also provided a clear regulatory path for us moving forward. And while we were testing these systems, we realized that our platform could do more than just launch rockets at altitude. And that's why we are working with NASA JPL to assess how our technology can be used as a testbed on the path to Mars. We are working to flight qualify our platform next year up to 60,000 feet, and this opens the door to a $2.6 billion high-altitude platform services market. Leo Aerospace is under contract with the US Air Force, and we have identified over 100 scientific payloads in their backlog. We are working to launch the first of these in our suborbital launch test also next year. This milestone also provides validation to our commercial customers and allows us to begin taking contracts for orbital launches. Finally, we will launch our first payload to orbit in 2022, opening the door to a $5.6 billion associated launch market. As a team, we bring experience programming flight operations software at NASA, performing propulsion work on the James Webb Space Telescope, and leading combat operations as a US naval officer. Go to leoaerospace.com. Join us on our mission to revolutionize access to space. With that, I'd like to leave you with some footage from one of our recent tests. Thank you.
Cool. Okay, judges. Ryan, go ahead.
Well done, guys. What is the payload range you're targeting, and what is the cost per kilogram for launch to a sun synchronous or any other orbit?
Yeah, of course. So our baseline payload capacity is 25 kilograms to a 550 kilometer sun synchronous orbit. That's what all of our markets and numbers are based off of, so the smaller end of the satellite market. In terms of the price per kilogram, we're looking to price competitively with current rideshare models. But in conversations with our customers, they've made it very clear that the sort of dedicated launch where they can pick where and when they're actually going is a premium service in their eyes, and they're willing to pay more for that.
We've looked at a variety of space tech companies, kind of broadly defined, and have been hesitant to invest because of the capital intensity of the category. And typically, you need hundreds of millions of dollars, maybe even more, to kind of get to scale. Do you guys have a sense of what type of capital you guys are going to need, not just to kind of get some of the initial tests done, but actually, get the product actually working, get through all the science risk? These are typically multi-year sales processes into the government that's really, really long and expensive to get them to engage. So what is the actual kind of scale of capital need to be for you guys to be successful?
Yeah, I'll let Bryce take that.
Yes, so you're absolutely right in the fact that space tech companies are generally very capital intensive. Most space launch companies have raised on the order of hundreds of millions of dollars prior to getting to orbit. Rocket Lab raised $288 million, Relativity just close to $140 million, Vector had raised $107 million. And so with our projections, though, we foresee being able to get to orbit on the order of tens of millions, not hundreds of millions of dollars. And we have made strategic decisions to enable us to actually pull that off. For example, for any standard launch program, 70% of the R&D cost goes into the engines of that program. We are not building our own engines. We are sourcing those from industry suppliers. We have great relationships with those suppliers who are already building up facilities to be able to support our needs. And with regards to your question about multi-year sales cycles for government, things like that, we are already actually writing contract proposals right now with the US Air Force with identified customers and end users who are begging for our technology to be able to pull off suborbital launches next year.
Could you maybe walk us through what is it that is most proprietary about your system or platform versus where you're using existing components and parts?
Absolutely.
Techniques?
So a lot of our proprietary technology comes in the integration and operation of high-altitude balloon and rockets together. It's a complex problem. For example, the US Air Force tried doing it back in the 1950s, and they successfully did it. But the way that they did it was by launching the rockets through their balloons, exploding it. It was non-reusable, and it was pretty hazardous. In order to do this autonomously and reusably, there's a lot of proprietary technology in there that allows us to do that.
You guys, obviously, to get to 60,000 feet launch is, it's probably not tomorrow. How long do you guys think that's going to take? And what in lieu of revenues, what are the KPIs that you guys are tracking that you think are most important in your journey to get to the 60,000 foot launch?
Absolutely.
Yeah, so to address the timeline, we're looking to get up to that 60-foot launch early to mid next year. In terms of the KPIs that we're tracking, there's obviously a lot of development and technical milestones and different testing programs that we work in partnership with the FAA's Office of Commercial Space to safely license the vehicle both in parts and as well as when it's together. And in terms of other KPIs, we're also focused on 3 different customer segments. Commercial, defense, and civil is how we think of those 3. And so they each obviously have very different sales cycles, and we construct KPIs in regards to each of them.
Other questions?
I guess, is there any environmental issues? Just like, on the one hand, you talk about sort of convenience and predictability, but I imagine balloon launching is very dependent on kind of weather and climate. So, how do you have any sort of confidence level that you can hit the windows based on the sort of dependability that you have on the environmental factors?
Yeah, so environmental conditions are always a factor, for any launch vehicle. And so our system is designed to fit within the bounds of any sort of environmental factors that you would typically see with a launch vehicle.
But to add on to that, because our platform is entirely mobile, if we know that, say, there's a hurricane coming up with Florida, that's going to postpone any launches happening from Cape Canaveral, well, we can move to the West Coast and launch from there. Or we can move to Australia or New Zealand or Europe or literally anywhere with this system, anywhere that you are licensed to fly in the airspace. Obviously, we work with all local governments, but I mean, we can even fly this thing off of large barges and things like that.
Can I ask one follow-up question?
Yeah.
How much will it cost to get the first rocket in space with your first paying customer?
Answer quickly.
Yeah, so that's the largest cost, the non-recurring engineering going into developing and regulating and licensing that vehicle. The costs severely drop off after that.
Is it 10 million, 50 million? Like, what is it to actually have like a real revenue-producing customer?
I will say tens of millions. Yes, low tens of millions. Happy to discuss that offline.
All right, give it up for Leo Aerospace. Okay, we are going to bring out our 4th startup. That startup is Molecule One. Presenting from Molecule One are Piotr Bierski and Maxis Wlodarczyk-Prusznicki. Come on out.
During our time as medical students, Maxis and I witnessed many people suffer from untreatable diseases. This has always led us to 2 questions.
Why does the drug discovery and development take 12 years? And what can we, having a background in both chemistry and mathematics, do to fix this? For each drug that makes it to the market, as many as 20,000 drug-like molecules need to be made in a laboratory for testing, in a process called chemical synthesis. Designing how to synthesize a given molecule is highly inefficient and prone to errors. It involves chemists manually digging through tens and hundreds of scientific publications. Chemical synthesis is the overlooked bottleneck in drug discovery. Until now. Introducing Molecule 1, the future of chemical synthesis. Molecule 1 leverages artificial intelligence to design novel chemical syntheses within seconds instead of hours or days. First, the user inputs the structure of the molecule they want to make. It is then analyzed by our patent-pending technology. The system tries to find a way to make it from commercially available molecules. Finally, found ways are ranked according to user-preferred criteria, presented to the user, and supported with lab-tested evidence. Let me show you how it works. Move to the demo, please. Can we move to the demo, please? Thank you. First, let's input the structure of osimertinib. We chose a marketed drug as the design target, as we cannot publicly show structures that are property of our clients. Maxus picks search parameters that are typical for late-stage drug discovery: medium quantity, short shipping time of starting materials. The design process has been launched. You can see that the first results are available within just a few seconds. The system is based on deep learning. It utilizes information about previous experiments to find out what kinds of transformations between different molecules are viable. It is then able to propose novel synthesis steps. Viable steps are then assembled into multi-step pathways that lead all the way from starting materials to the desired product. The search has finished, and the best result is shown to the user. On the left side of the screen, we see the molecule, one that the user wanted to make. With the 8 of different colors, the user is able to trace each atom from the target molecule all the way back to starting materials. Let's take a look at a particular step. It is possible to dive into lab-tested reference for this step. This helps the chemist to easily proceed with the design synthesis into the lab. Back to the demo, please. Thank you. A process that used to take hours and days can now be done in under a minute. A process that needs to be iterated thousands of times for just one drug. The synthesis target osimertinib is used to treat aggressive forms of lung cancer. It brought $1.9 billion in revenue in 2018. The product that you have just witnessed in action is the work of this exceptionally talented team, which every single day bridges the gap between chemistry and technology. Software of our competitors does not utilize AI to leverage chemical datasets for synthesis planning, and often has trouble generalizing to novel molecules. Also, their software looks and interacts with the user like it was created 15+ years ago. Our initial focus is the drug discovery ecosystem, which craves for the utilization of recent advances in artificial intelligence, including future applications like fine chemicals or agrochemistry. It's a $500 billion market. We use SaaS, paid by number of seats or data points, and we have an enterprise tier with custom integrations and optional on-premise deployment. Molecule One has several partnerships with industry leaders. eMolecules, the leading marketplace for molecules. AWS, with whom we are exploring a joint project at a Fortune Global 500 pharmaceutical company. We have another trial scheduled with such company. We have a trial scheduled with another such company within 2 weeks, and right now our software is evaluated by a medium-sized drug discovery company. Make medicines faster. Cure patients faster. Go to molecule.one today and optimize your synthesis pipeline.
Judges.
Thanks for that. Can you tell us more about the data that you've been training on and the data that you're feeding into the system?
Yes.
And how it gets smarter, and does it get smarter across customers?
Yes, absolutely. So the basic version, the one that you saw today, is based solely on publicly available data. The main source is are chemical patents and reactions that are extracted from there. Of course, we wanted to get smarter with time, and we want the customers to be able to utilize their own data. So we built the system in such a way that it will accept more reaction data and get smarter with that.
Just a follow-up question on that. So do you have data on the success rate or kind of efficacy of that, and kind of what are there perhaps theoretical limits that you can do with that existing data?
So it's kind of hard to do that without a wet lab, so we had to resort to some other measures. One thing we did was planning synthesis for molecules with known synthesis and ensuring that the software doesn't have access to these known synthesis. So we tried to figure out whether the software is able to recreate the synthesis from other information. And it was able to do that in about 85% of cases. So that's one, and we performed a lot of experiments to validate our machine learning models and see whether they are actually learning stuff about chemistry or just recreating stuff from memory.
And do you have any, what the traditional or substitute benchmarks are?
Excuse me?
And do you have any, and how would that compare to perhaps a traditional or other sources that these customers might be using?
So the thing is that if you use traditional source like our competitors, it's very hard, for example, to plan a synthesis for a novel molecule. So it's practically impossible in most of the cases, and that's what we want to do, because drug discovery needs new molecules. You can't just recreate molecules that have been constructed in the past. And comparing to the traditional pen and paper approach, it's much faster with a similar accuracy rate.
As you're going into early customers, target buyers, et cetera, what is resonating for the early adopters, and what are the biggest objections you're getting to early adoption?
So the problem with our ideal customer is big pharma, and the problem with them is the long sales cycle, and the biggest reason for that in our case is that they have data security concerns. So it's hard for them to trust a small company with their data that are proprietary. So one example how we're mitigating that, apart from employing security policies, is partnering with guys like AWS, who already have a relationship with the big pharma guys and help us to overcome those initial problems.
Are you finding early advocates who are helping you break through, or like what is the profile of the kind of individual within these companies that are the most willing to experiment?
Chemists, especially medicinal chemists, because it's medicinal chemists who do all these novel molecules. I would say that bigger companies are better because they have more time to experiment on new stuff, and with smaller companies, you just need to. They have too much to do except for trying out new stuff. So, yeah, I would say that.
Is there a particular type of disease that you guys are finding that customers are utilizing you guys for?
I'm sorry, could you repeat?
Is there a type of disease that you find that customers are utilizing your service for?
So we're disease agnostic. The important distinction to make here is that we design syntheses for so-called small molecule drugs, so not antibodies, not receptors. And another important distinction to make is that we're not a what company. There are companies like Atomwise, which design structures for Alzheimer's drug, etc. We take those structures and design the processes to make them.
So, oh, go ahead.
Good, no, go for it.
So there are many companies that have generated multi-billion-dollar exits by taking a molecule through clinical trials. However, I struggle to think of a single company that's doing, or that has been doing synthesis or high-throughput screening or testing that's been able to achieve that kind of outcome. Why is it that you've chosen to leave the money on the table for the companies that take these through clinical trials, or the food and chemistry companies that make products out of these, as opposed to doing that yourselves?
Answer quickly.
I would say capital intensity, because what we're doing is basically software, so much less capital intensive. And regarding what you said, that it's hard to spot an exit in this, it's because the necessary technology has emerged only very recently. The neural nets we're using were designed last year or even this year, and we're constantly trying new stuff, so that's the reason.
All right, one more round of applause for Molecule 1. So our next startup is not a regular startup Battlefield company, but instead a wildcard company. And what that means is they were in the startup alley. We plucked them out of the startup alley. Every other Battlefield company has gotten months, or at least known for months, that they're going to come on stage. I think My Milk is maybe known for a day. That said, we've had finalists and winners come from the wildcard, so this could be just as big as anything else. So the company, which I think I just spoiled, is My Milk, and presenting for My Milk are Sharon Huramati and Ravid Schechter.
So when I gave birth to my first baby girl, I knew that breastfeeding is one of the strongest health-promoting activities, so I knew I will breastfeed. But breastfeeding is difficult. So in my mind, it was supposed to be this naturally occurring, fun process, and although I had many magical moments, reality was really different. Breastfeeding was tough. So I saw a lactation consultant at the hospital, but I realized that while I was very strictly monitored all through my pregnancy, when it comes to breastfeeding, there are no objective tools to assess individual breastfeeding at all. So I was instructed to count diapers and time breastfeeding sessions. I've read all the information I got at the hospital and researched tons of content online, but eventually I was left with tons of uncertainty. Is my baby breastfeeding well? Do I produce enough milk for my baby? Why is my baby crying? I would have paid anything to get some control and peace of mind. And my story is not unique. So today, almost all mothers initiate breastfeeding. But mastering breastfeeding is really challenging, and most mothers don't stand with breastfeeding for as long or as exclusive as they originally desired. So today, over 100 million mothers initiate breastfeeding. How do we get them to continue? So the main reason mothers report to stop breastfeeding is I did not have enough milk. This is largely preventable, and this is why we've built My Milk to help mothers like us be proactive about their breastfeeding success. So we've basically transformed human milk to this powerful data source that reflects on the breastfeeding progress and breast milk production maturation. So the breast milk really changes in those first hours, days, and weeks after birth. It has a unique dynamics of changing from early colostrum to mature milk. And this is where the Miley comes in. So meet Miley. Miley is a mobile health device and app for improving breastfeeding through direct breast milk sensing. Let's switch to the demo. So basically, for the first time ever, a mother can introduce just a few drops of milk into the Miley Scan device and application and receive immediate feedback about her breast milk supply and breastfeeding establishment process. With additional information she provides to the system, she receives additional actionable insights in the form of visual and textual reinforcement, tips, and alarms for improving breastfeeding. And she can share this unique report with a lactation consultant through the application. Let's switch back. Next slide. Next slide. Okay, so let's see the tech behind the Miley. So in MyMilk, we've basically established the first human milk dedicated clinical laboratory where we've tested tens of thousands of data points for various breast milk analytes, looking at this difference between early milk and this progress to mature milk in the first weeks after birth. And the Miley is the first device to take this from the laboratory directly to the hand of the breastfeeding mother. So basically, the Miley device senses the electrochemical properties or the electrical impedance of a tiny human milk sample. This information correlates well with the information we've accumulated in our laboratory with a change in milk composition. So this information is transmitted to the smartphone device using Bluetooth, and then our app calculates where the specific sample at on this continuum from colostrum to mature milk. And then it gives visual indication regarding whether the sample is delayed or advanced relative to expected from the specific age of the baby or the time that has passed since birth. Okay, so our competitive landscape includes both breastfeeding, tracking, and diaries apps, and telemedicine services apps. There are also technologies assessing directly the milk flow from the mother to the baby. And there are companies like Everlywell that offer direct-to-consumer laboratory testing, assessing anecdotal nutritional analytes in breast milk. MyMilk is the first and only integrated solution that generates, utilizes our unique milk sensing abilities together with our consumer-centered or patient-centered mobile health solution. Okay, so in our beta pilot, we've successfully tested the system with lactation consultants that have scanned over 500 mothers using the system. They love the system. They say it's like science fiction and a new valuable tool in their toolbox, and that the mothers love it. So our business model is basically selling the device plus disposables and the use of the app, and also offering premium services such as telemedicine services and advanced lab testing services. The go-to-market strategy is through lactation consultants and also direct to consumers. And in 3 years, we see many of our customers coming through the healthcare system when integrating our technology to the healthcare system for enabling continuum of care. So Ravid and myself, So Ravid and myself have both graduated as PhDs from the Weizmann Institute of Science. Our team includes both software professionals and laboratory professionals, mostly mothers, striving to improve women's health and the health of generations to come. So in Miley, we know that Miley will become a must-have device for improving breastfeeding of all breastfeeding mothers, and we're excited to launch as pre-sale here at Disrupt. Thank you.
Excellent. Judges.
As a long-term consumer of this product, once upon a time, I wish I had it. I'll jump in. There's no time in my life I've been more goal-oriented or had more challenges, so thank you. I'd love to know exactly What is the aha? Like, what is the specific thing that I would tell a friend of mine that's just had a baby, that's nursing for the first time, as to why you have to use this product?
Before Miley, you basically had no objective sense of what's going on. After Miley, you know. So you both get the aha moment of knowing what's going on. Maybe you won't get it on your first measurement, but while you go on and continue measurements daily and receive these insights and start acting upon it, then the magic kicks in.
Can you, and again, I think there's nothing that's like more akin to a new mother's identity than figuring out how to do this. So it's a really powerful moment. But give me maybe an example of an insight or two in the first week that you might be using the device.
So we can tell both a lactation consultant and a mother. So this technology is also missing vastly from the healthcare system, and also lactation consultants, which are the go-to person when it comes to breastfeeding assessment. They don't have an objective tool, and this is why they were the first ones that we've approached when assessing our beta device. And they say this is science fiction that became true. I mean, I can't believe that you know what's going on with these mothers from miles away through your cloud. So this was really a wow moment with our lactation consultant. So we can see whether this mother is breastfeeding or introduces large amounts of formula. We know that there are differences between breasts. We know when the mother is experiencing severe pain only by understanding the specific analytics of her milk on the spot.
And are you making like different dietary recommendations or different recommendations as to when to introduce formula?
So yeah.
Okay. So most of the establishment of breast milk is a behavioral process of education of the breast to produce the milk. So by introducing early feedback about how the number of breastfeeding, if she need to increase between breastfeeding expression, if she need to include night breastfeeding, and so on, the system can alert her as early as it can be.
But in the laboratory, we do have breast milk compositional analysis and nutritional analysis done as a direct-to-consumer laboratory testing, basically being like the 23andMe for breast milk. So we do that as well in the laboratory, and we plan to move some of these capabilities to the device soon as well.
So is the key window that first 2 weeks when you're seeing the changes? And then do I continue to use the test throughout, or is it really just at the beginning that there's this moment of change?
So the first use case or first like real value proposition is for these first days to weeks after birth. We look at it as the first 6 weeks after birth mainly, but we will include additional sensors into the system that will enable achieving additional information such as nutritional recommendations, taking more and more of the technologies that we know how to do in the lab and put them in the device itself. And also there is ability to upsell through the application and receive those advanced testing, laboratory testing.
Thanks.
As a parent, I understand the importance and also the willingness to spend against this, your child's nutrition. Can you just talk through how you think about the potential lifetime value of customers using this service? And it sort of feels intuitively that $300 is sort of insufficient given the complexity of the device. And so what are the options for you to increase the lifetime value per customer that you can generate?
So when we're talking about $300 lifetime revenue, we're basically looking mainly on these first 6 months after birth. But when it can be vastly extended, when we extend beyond breastfeeding to other maternal and infant-related healthcare and well-being issues in the first 2 years of life. So we see breastfeeding as a very early stage when we can gain or give real value proposition to the mother, and then we can offer additional values through there.
Which could be, 10 times that 300, or do you have any ballpark
So we
number?
calculated up to 2,000, but I think there is really, this is the upper limit when it comes to direct sensing, whether it's any biosensing with a device, but then when we have such a large consumer base, we can basically bring it up anywhere.
All right, we are out of time, so give it up for our wildcard company, My Milk. And that concludes session 2 of the Startup Battlefield. The judges are going to follow me backstage where they're going to help us choose our finalists. Before they go, though, give it up one more time for our judges.
Well done.
Why did you come to this workshop? To learn. But quickly I realized I started unlearning some things which I've been doing very incorrectly in the past and which didn't really give me the results that they're supposed to get.
I want to be where we ask questions like why? And the big question I ask is what if? You know, it's a different way of thinking at Stanford than it is at any other university in the world.
I realized I was getting stale, so I said, you know what, it's time for me to move on and look for greater things and have more impact.
At Lockheed Martin, we're on a mission. Your mission. When millions of people are counting on you, you can count on us. To build the impossible, to invent the inconceivable, and solve every problem with speed and reliability. Every mission is an expedition of the greatest importance, both to you and to us.
Ladies and gentlemen, please welcome back TechCrunch Managing Editor and Disrupt MC, Jordan Crook.
And the crowd goes wild. Thank you. You guys are too tired to laugh too. But we have so much excitement coming up. Did everybody have a good day so far? Yeah, me too. Okay, we got one more panel, and I bet you guys are as excited as I am, so I'm not going to dilly-dally anymore. Please welcome to the stage, from Snap Travel, Hussein Fazal, from SC30 Inc., Bryant Barr, and Stephen Curry, and your moderator, Megan Rose Dickey. Big round of applause, please. Hit me with it. Hit me with it.
Respect.
That's your suit?
All right.
Yeah, so the stage is bigger than the last time we were
Yeah, I was at the
right?
pier the last time, so this is definitely bigger and a lot more people.
Yeah, we upgraded just for you, obviously. So.
A lot of upgrades going on in my life right now.
Yeah, definitely.
Chase Center and all. Appreciate
Yeah, absolutely. So thanks so much for joining us here today. I think everyone's very excited to hear about your journey into the startup ecosystem. Obviously, these days we're hearing about a lot of athletes and celebrities alike investing in tech startups. So maybe we could just kind of kick things off with hearing about why you're interested in startups.
Well, first, it's just about opportunity. I haven't been here for 10 years. You start to meet people, kind of get into the scene a little bit and understand how I can bring my personality, my team along and really learn how I want to kind of go about it. And at first kind of started just pure intrigue and wanted to kind of get your feet wet and learn. We had to have a history of a startup of our own, so being on that side and now from an investment standpoint. And so it's just exciting to be able to meet amazing founders that are purpose-driven, have similar mindsets and missions that we do, and align with them and kind of go on that journey. Right now, obviously being in the NBA, that's just a very short period of my life, and so from 21 to hopefully I can play for like another 6 years, and then you think about what do you want to do the rest of your life, and we're hopefully setting up the groundwork and the framework for success in this space and doing it our way and really enjoying the ride. And I've again been fortunate to have a great team behind me that's on this journey with me.
Yeah, so you and Bryant were college roommates, and actually backstage you told me that you're the best friends.
Exactly. Two guys in the wolf pack. Yeah, we're good.
Nice. So can you kind of walk me through? So you and Bryant work closely together at SC30,
yeah.
and you landed on Hussein's startup Snap Travel as your third investment, I believe. So can you kind of walk me through how you were introduced to Hussein and what led you to want to invest?
I'll let Brian talk about how him and Hussein met, and I'll kind of chime in at the end of how our first kind of interaction went. But
yeah, we met through an investor, someone that was leading around in Snap Travel that I had met a few years previously. And I was sitting down just having a conversation about companies he was looking at, things that he was seeing. We were talking a little bit about how we were thinking about getting into investing. And Hussein had a meeting with him right afterwards. And so we were up here in San Francisco. Hussein walked in. And Yash said something to this, like, hey, just tell them a little bit about what you're doing. So we spent 10 minutes talking, and one thing led to another. We probably spent the next 4 to 6 weeks kind of digging in. We started getting into a due diligence process with Snap Travel, and then ultimately ended up participating in that round of funding.
Go ahead. I had a huge dilemma because Brian, anytime you bring something, I know that that they hit it off, and there's a great opportunity there. Kind of hit me in the heart a little bit. He was a Raptor fan, and so I was like, I like you, but I don't like your team that you're riding with.
As part of the investment, you let us win a championship.
Whoa,
yeah.
It's not but I got to go to his office in the office space in Toronto and meet the entire team that's making Snap Travel, a success, and did a Q&A and kind of got some FaceTime with them and see exactly what was going on and how they were building. So it's a pretty cool, introduction and opportunity there.
Yeah. So Hussein, what was your pitch like to Steph and to Bryant? Like, did you tailor it in the exact same way you would to a more traditional VC or angel investor, or what was that like for you?
I mean, it's pretty similar. Obviously, I spend a lot of time talking about the product. So it was just showing Bryant.
Hussein's mic's not on.
Yeah,
his mic's not
can
working.
we check Hussein's mic, please?
Keep talking. That's
it. Yell.
Test. I thought people came to listen.
They did come to listen to you, but we'll wait.
This work?
Keep going.
Can you hear
All right.
None of your mics work.
All right.
Okay.
So people do want to hear me.
There
speak.
we go.
That's cool.
They do.
No, I mean, for me, it was just a standard pitch. I just showed Bryant the product. He liked it. He was obviously really into it. And just to kind of, for the benefit of everybody in the audience, what Snap Travel is, we allow you to book a hotel room over messaging. So you can pick up your phone the same way you'd message a friend. You can message Snap Travel. You can say, hey, I need a hotel in San Francisco tomorrow night. We have a bunch of machine learning technology that will go and pick the best deals for you and present you with hotel deals. So I did the standard pitch and the standard demo to Bryant. He liked it enough to go through the due diligence process. And then, like you said, we went through about 4 to 6 weeks of due diligence back and forth before he was sold. We brought it to Steph. Steph liked it. And then we got together in Toronto.
And so, yeah, is that generally how it works? So Brian, do you kind of do the first round of due diligence, and then Steph, you decide if you're wanting to invest, or sometimes is it the reverse, or generally, like, how does that working relationship entail?
I think we've tried to fine-tune a strategy in terms of that process. So obviously Brian is out, the workhorse, taking meetings, getting introductions, going to pursue companies that we're interested in, and then we kind of put that decision through our filters that we've designed that I think work for us, and we check the boxes. Some most of the time they're not all checked. You kind of get a majority. Sometimes it's right on the line, and then we have a conversation around it. Obviously, I get to meet the founders, meet the team in most cases, and you try to make as many educated decisions as you can, and hopefully we're building that thesis around and that strategy around what we're trying to do and have some successes along the way. So we're still young. 8 investments in, so it's pretty cool that to build it and fine tune it as we go, because we're obviously always about learning. And Brian, you can probably speak on exactly what it's like in the field representing SC30 Inc. in the investment space.
Yeah, I mean, it's we're 12 months in, so I think it's a constant work in progress. I think we have a vision for where we'd like to go, and it's how do we make consistent strides to that. But we almost think of ourselves as a small fund, like it's investing Stefan's capital, but in terms of how we go about our investment process, due diligence, Hussein can speak to that. We're not writing a check because a reputable institutional VC is leading around and saying this is a good bet. Like we're treating this as, hey, we have to make sound investment decisions. How do we think about it as a fit for Stefan and our overall ecosystem? Where can we add value? We want to make sure that when we're investing, there's actual tangible things that we're doing, right? I think with a lot of companies, they see a celebrity investor and they think of tweets and Instagram posts. Like he's not just a customer acquisition vehicle. That's not the way that we want to consider how we can add value. And so we want to make sure that when we're looking at companies, we believe it's a good investment. We believe in the founders. We believe in the team. You're betting on the team at the end of the day. And then we want to make sure that within our ecosystem of brand partnerships, the media relationships that we have, other portfolio companies, and then even on the foundation side, that we're able to find ways to add value into the companies we're investing in.
Yeah, and I can speak to some of that value. So there's a few things that SC30 has been super helpful with so far. So first of all, on the consumer side, for a lot of people, they could only afford maybe 1 trip a year or 2 trips a year max, and they probably haven't heard of Snap Travel. So when they go and they Google and they say, hey, should I spend $1,000 and book a hotel with Snap Travel, and they go see Steph as an investor, that gives them the confidence to go in, make a booking with us and feel like we're a large, legitimate company. Also on the consumer side, Steph wore a Snap Travel hat during the NBA Finals, right? So walking into the stadium.
That's when you know I really believe in the company. Right?
There you go.
We're a Toronto-based company in the finals against their team.
In the post-game media conference, right? Millions of eyeballs, right? But beyond the B2C side, there's also the business development opportunities. So when we go to China, for example, and we chat with Ctrip and Alibaba and Tencent, the fact that Steph's an investor in our company, it opens up doors and it gets us meetings that we otherwise wouldn't get. They're like, oh, Steph's an investor. You have a strong brand in China. That opens up doors, gets us meetings, and helps with business development. Even being here on stage today, right? The fact that Steph's here is probably the reason why I'm on stage.
No comment. But Stefan, other than, of course, so you wore the Snap Travel hat. That was probably, sounds like that was really great.
Yeah,
really great for you,
awesome.
Hussein. But other than kind of like repping the brand and whatnot, like what kind of value do you see yourself bringing to Snap Travel or just any of the other startups in your portfolio at this point?
I think Brian alluded to it a little bit, but across the 4 pillars that we work in, there's a lot of opportunities to leverage the entire platform. Whether it's introductions, whether there is the kind of usual tweet or post or whatnot, or whether it's a video you send in to kind of rally the troops internally and create that internal morale or excitement about what you're building, what you're doing. There's a lot of different ways that we can be creative and have that cross-pollination across the ecosystem that for us is exciting because there's a mutually beneficial play there. And we've even seen it now. Aisha and I and my wife just started our new Learn Play Foundation, and a lot of things that we've started to think about now in this space is how can we leverage that to impact obviously the community here in Oakland and create a nice wave of momentum through these type of opportunities. So again, 12 months in, we've had a lot of cool experiences in that front. I can only see it getting bigger and better.
So are there particular sectors that you're most interested in within the tech space?
There aren't any specifics that we're interested in. I think Brian kind of talked about it in terms of just it's founders, right? It's the team. It's the people that you're putting your money behind and your belief in. And so there are some categories that we kind of stay away from. But I think
what are those categories?
We call it the life sciences and and blockchain, and those are the 2 that are really kind of stand out. But in terms of other things, it's just about using our strategy, our filters to make these sound decisions, believing in the team, and really digging in. This isn't like something that we take lightly. Brian talked about our due diligence that we do, and sometimes we've heard some feedback from founders and like, your check size doesn't match your due diligence that you're putting into it. And that's how we're trying to build I like that. That's a compliment to us and to our team in terms of what we're trying to truly build, over the long term, and setting that foundation for sure.
Yeah. So are you able to let us know like just how much money you've invested in tech startups at this point?
I mean, we won't talk publicly about each of our investments, but every investment is at least 6 figures, like healthy 6 figures. I think that's kind of what we're comfortable with sharing. So it's not a nominal size check, but we're certainly not like stepping up to try and lead around anytime soon.
Okay. Yeah, and then in general, are you looking at like Series A, Series B level, or I guess specifically like which level are you looking to get in at?
Yeah, so across our 8 investments to date, it's been Series A, B, C. We want to see a reputable institutional lead investor, someone that we can lean on a little bit through the due diligence process. For us, this is an educational process as well. Like there's a lot that we don't know as 2 people that are relatively new to the space. And so how do we surround ourselves with people who have done it for a lot longer, who have had more reps, who can help us dig a little bit deeper and understand things that we might be missing. We want to see verifiable market traction. Like, have you hit product market fit and are actually ready to throw some gas in the fire and start to scale the business? And so we'll pay a slightly higher valuation to pull that risk back a little bit to where we're a little more confident that the ways that we can add value, whether it's through relationships at a customer level, building that team, et cetera, can actually move the needle for the company, and they're ready to do that.
Yeah, and you mentioned just needing to kind of educate yourselves around startups, around Silicon Valley. So Steph, what is your process for making sure that you're really like up to date on everything that's happening in the ecosystem and that you're not going to miss out on a big opportunity potentially?
Well, honestly, just leaning on my team. Obviously, I have a full-time job that requires a lot of my attention and a time investment. But when it comes to having that kind of perspective around, who we connect with, who we can kind of lean on to make those sound decisions, where I can kind of put my confidence in the time and investment that I want to put into it, because I am, like Brian would tell you, I'm all in on our weekly updates, our kind of periodical updates on the portfolio companies and how they're doing, and how different sectors are moving and things like that. And so that process is still formalizing on a consistent basis, but I'm all in, and that's been the fun part about it.
And how available do you make yourself to the founders in your portfolio?
A good amount. I mean,
yeah. Hussein, do you?
Yeah,
do you agree?
I concur. It's actually a lot more than I expected. Initially, when I was primarily dealing with Bryant, I thought Steph would just kind of show up and say hi and shake some hands, kiss some babies. But he actually spends quite a bit of time, and there was a SC30 Summit, which we hosted a few weeks ago, and Steph was there for the entire time, 3 days, and it's been a lot more involved than I would have expected. So it's been awesome.
Yeah, I mean, Steph digs in. In terms of trying to be up to date with everything. The summit that we had was across our entire ecosystem. Every founder from our portfolio companies was there, along with people like Under Armour, J.P. Morgan Chase, media partners, et cetera. A couple of weeks ago, we went to the Forbes Cloud 100 event. And not just to the dinner, but we strategically set up about 90 minutes before the dinner to meet with 5 different companies and just sit in and kind of dig in and get to know what are you doing, all enterprise companies, so a little bit different than things that he might have seen before, Series A to companies that are $1 billion plus that are probably on the road to an IPO in the next few years, just for him to understand what does that spectrum look like, and what does it mean when you're a company that's raised at $1 billion valuation versus a $50 million valuation? And so he's maybe being a little modest in terms of how he's carving out time to make himself available. And then on a weekly basis, he knows companies that are coming into the funnel. Hey, we're here from a due diligence perspective. Here's how we're working down in the funnel. We're getting close to talking about terms and he sees that the whole way through. And then when we send an investment memo to him at the end as like final recommendation, and then we pop quiz him to make sure that he's actually reading it, and he hasn't failed yet. So we'll get him at some point.
Is he getting 100%?
Yes.
Yes.
I'm talking about myself.
Yes.
No, it's fine.
Nice. And so you've made 8 investments to date, and so why is it that you're not disclosing the names of the other like 5 investments? So we know of 3, and then what about the other ones?
Actually, why are we not? Why would you say? That's a strategy.
Yeah, I mean, so we made
I'm
3 investments last year that were all made public. Up until that point in time, Stefan wasn't really investing in that space, right? I mean, maybe here and there, something that would come up. We wanted people to know that we were actively looking to begin investing from a venture perspective. I think as we look at the companies now, we don't want to be so quick to jump into the easy ways of promoting a company, and so we're doing a lot of things behind the scenes. We want to. It's like, to us, it's a little bit of a dating process. It's like, let's get to know each other. How do we find ways to add value, and let's make sure that when we talk about the relationship publicly, we are able to stand up proud and say, these are all the things that we're doing to support this investment in this company. And sometimes that takes longer to build up. And so rather than just issue a generic press release of, hey, we made another investment, that doesn't really move the needle for anybody. But how do we continue to work and build strategically to say, this is a way that we're actually leaning in, building material value for you and your company, and then let's talk about it.
Yeah, Hussein, was that kind of your experience with them? Like, I guess from the point of receiving the investment to then publicly talking about it?
Yeah, I mean, there's definitely a period where we got to get to know each other. They have to understand the business until I think they're both very comfortable with making it more public and making the announcement.
And so, Stefan, how many investments are you generally looking to make? Like, do you have goals in place? Like, okay, by the end of 2020, I want to be invested in this many companies. I want to put this amount of money into them.
We've broken it down pretty much into a kind of year-to-year basis, setting aside a certain allotment that Brian talked about, our check size, and kind of spreading that across multiple investments. It takes time to do due diligence. It takes time to kind of source these deals and these opportunities and make sound decisions. So I don't ever like setting a quota for the year just so we get to the end of the year, say I want to make 8, and you rush to get the 2 just to hit the goal. But there's a kind of a soft quota between 4 to 6 a year where you're trying to be active in the space and make sure you're taking advantage of opportunities like Snap Travel, like we had, where we had introduction, we went through the process, it made sense for both sides, and we got it done. So that's an active process that's going on constantly.
Mm-hmm. And I think one of the things you guys are looking for, as you mentioned before, is the market traction. So when we came to Brian with the Snap Travel opportunity, we were at a point where we had already driven over 100 million in sales over messaging. So it's not a small business by any means. The product market fit was there. We've been growing double-digit quarter over quarter. We have plans to get to $1 billion by 2021. So there's the types of companies where there's been a lot of market traction, and I think that's a lot of what they're looking for.
Yeah, and I think as we build the portfolio, we want to do it, and I think a very selective, kind of meticulous manner. The goal would be that as we make a bet in a company like Snap Travel, we'd say, here are the assumptions we made. Here's our hypothesis as to why they'll win, right? And we want to be able to look back 3, 4, 5 years down the line and be able to say, okay, they won. Were we right? Did they win for different reasons, or maybe they didn't win and we missed on those? And so that we can continue to iterate over time. But to Stefan's point, we don't have LPs, so we're not forced to deploy capital. Mm-hmm. So if we were to come to Stefan and say, hey, I think we should make 10 investments this year based on what our pipeline looks like, we can do that, right? If we see 2 companies that we really like, we can do that. And so there's a nice comfort in knowing that we can push if we want to, and we can pull back if we're seeing things that aren't of interest.
So there's an ongoing issue in Silicon Valley just regarding the lack of diversity and inclusion. I'm wondering if you have any goals in place around investing in people of color or women or other underrepresented people in the tech ecosystem.
I think it's very important. It's part of who I am and kind of I think the inspiration on the basketball court, how that can bleed over into true impact and change in the investment space and in the tech startup space. I never like to talk about things that I'm actually not doing, but in terms of what I've been trying to do in leveraging, my basketball platform to create opportunities for women in the game of in the game of basketball. We've been able to, build women-only camps that I've been happy to, or been proud, I should say, to have that experience, and it's been really rewarding. Trying to find like-minded people, like-minded, CEOs, and like-minded, opportunities that have that is a core value for them as well. And so it's on our radar. We don't have a standard kind of ask in terms of what that is for each opportunity, but that's a question that comes up.
Mm-hmm.
Like, how do you approach this? Is this important to you? Are you actively making changes within your organization that reflect what opportunity and change should be there? And then that gives us confidence to kind of get behind you as well.
Yeah. How diverse would you say your portfolio is right now?
So I think the way that we look at it, and when we first started, I think to Stefan's point, we understand the importance of, are you investing in founders, whether it's minorities, women founders, et cetera. And one of the things that, as we started exploring how we get in the space, we spent a lot of time, and I continue to do that, whether it's female VCs or female founders, and trying to understand their perspective. And one thing that we quickly learned was, to make an impact, it doesn't necessarily need to be a female founder or a minority founder that you invest in, but what are they doing throughout the entire company, right? What does that board look like? What does their executive team look like? What does the entire employee base look like? And I think Snap Travel is a great example. Maybe you can talk about it a little bit in terms of what the makeup of your company is like, but it is a question that comes up throughout every due diligence process of, hey, what's the structure of your board? What's your executive team look like? And we're still trying to understand and learn. We don't necessarily write a big enough check to say, you have to do this. We can walk away, and we will do that if that's not being represented appropriately. But we're still trying to figure out where we can push for our check size versus some of the other stuff.
Yeah, we're fortunate being in Toronto, being in such a multicultural city. Over 50% of our employees are immigrants outside of North America. Over 60% are visible minorities. And it's something that we put a lot of importance on.
So we're just about out of time, but so Stefan, you kind of alluded to this earlier, but that the investing could kind of be a post-NBA career full-time. Is that how you kind of see your trajectory going?
Yeah, I think the opportunity and the visibility we have as NBA athletes especially, and you can talk about guys not just in basketball, but athletes all across sports have kind of approached the space. Our earning potential is in a very short window, but how can you leverage that into opportunities that can set you up for great success post-career, those relationships, that learning experience that we talked about, and just kind of, taking advantage of the now so that you set up later. And that's been a really cool experience. I've had some teammates that have been extremely interested. We want to get to a point where we can kind of be a leader in that front and say, this is how we do it. This is kind of the framework for being, successful in this space, and have that be a proven concept, and bring people along on that journey, down the road. So that's the long-term goal, and I've been really proud of what we've been able to build so far. So hopefully more to come.
All right, so you've certainly given us a lot to think about. So thanks so much for your time.
Thank you.
Thank you.
Yeah.
Thank you.
Guys.
On the way out, on the way out, on the way out. All right. Before you get up and go, just a quick note. I don't know if you're familiar with TechCrunch. It's our premium product, and we're running a deal right now, so it's $12 for the first year. It's steal, folks. I'm telling you, it's a steal. It's got a lot of how-to guides for launching and scaling your company, so be sure to check it out. Normal price is $150 a year, so go check that out. Call time's 9:30 tomorrow. That's when we're going to get started. I can't wait to see you. You guys have been just so much fun as you all run to the exits while I'm talking. Love you too. Bye.
Disrupt.